Ladies and gentlemen, good morning. It is a real pleasure for me to welcome you to this fourth biennial conference on financial stability, jointly organized by Banco de España and the Centro de Estudios Monetarios y Financieros, CEMFI, to promote the research and discussion of topics in the field of macroprudential policy and financial stability. This event is being hosted here in Madrid in a hybrid format and live streamed through our YouTube channel. In the course of today and tomorrow, this conference will feature 34 speakers with wide-ranging backgrounds in central banking and academia to address some of the most current, pressing, and emerging financial stability issues from empirical and theoretical perspectives, as well as from economic and regulatory standpoints. To this end, a dozen working papers, carefully selected from over 100 articles that were received in response to the announcement of this conference, will be presented and discussed. On Friday, the conference will include a closing policy panel on crisis management and deposit insurance in Europe. I trust that given the variety of topics on offer in the menu of this conference, members in the audience will find something to their taste. The organization of this event has been made possible thanks to the work of a scientific committee co-led by Ángel Estrada from Banco de España and by Rafael Repullo from CEMFI, as well as colleagues in the Financial Stability and Macroprudential Policy Department with the support of our communications and protocol teams. I shall note that this is the last conference that Rafael Repullo organizes in his capacity as director of CEMFI. After an extraordinary career on CEMFI, at the help of CEMFI, spanning more than 3 decades, Rafa is leaving an enduring legacy at the Banco de España, of which this event is another fine example. The conference will now open with the keynote remarks by the Honorable Jerome Powell, Chairman of the Board of Governors of the Federal Reserve System of the United States, and this will be followed by a dialogue on current issues and challenges between Chairman Powell and Pablo Hernández de Cos, Governor of Banco de España and Chairman of the Basel Committee on Banking Supervision, which will be moderated by Cornelia Holthausen, Director General for Macroprudential Policy and Financial Stability at the European Central Bank. In conclusion, let me thank you for your interest in this conference, wish you all very fruitful discussions over the next 2 days, and for those of you visiting us on this occasion, a pleasant stay in Madrid. And without further ado, I would like to give the floor to Chairman Powell.
Thank you very much for your kind introduction. Thank you, Pablo, for the invitation and chance to be here. Good morning to everyone. And let me also welcome Ambassador Reynosa. It's a pleasure to meet you and be here with you today in beautiful Madrid. So today I will briefly discuss the current economic situation and the stresses that emerged in the U.S. banking system earlier this year. I'll have some brief remarks and then we'll sit down and have our conversation. I will then turn to the evolution of the financial system since the Great Recession and conclude with a few general observations. And I'll highlight how global efforts to boost resilience in the financial sector over the past decade have been an important success. I'll also discuss how recent developments have revealed residual vulnerabilities that we are going to address and the need to be vigilant for emerging risks. U.S. economic growth slowed significantly last year, and recent indicators suggest that economic activity has continued to expand in the U.S. at a modest pace. Growth in consumer spending has picked up this year, and some indicators in the housing market have turned up recently. At the same time, activity in the housing market sector remains far below its peak in early 2022, reflecting the effects of higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The U.S. labor market remains very tight. Over the past 3 months, payroll job gains have been robust. The unemployment rate has moved up but remains historically low. There are some signs that supply and demand in the labor market are coming into better balance, including higher labor force participation, some easing in nominal wage growth, and declining vacancies. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. Inflation, however, remains well above our longer-run goal of 2%. Over the 12 months ending in May, total personal consumption expenditure prices are estimated to have risen 3.9%. Excluding the volatile food and energy categories, core PCE prices appear to have risen 4.7%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Since early last year, we have raised our policy rate by 5 percentage points. That's 500 basis points. We see the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is also facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. Tighter credit conditions are a natural result of tighter monetary policy, but the bank stresses that emerged in March may well lead to a further tightening in credit conditions, and the extent of these effects remains uncertain. At our last meeting, the Federal Open Market Committee decided to maintain the target range for the federal funds rate at 5 to 5.25%, while continuing the process of significantly reducing our securities holdings. We made this decision in light of the distance we've come in tightening policy, the uncertain lags in monetary policy, and the potential headwinds from credit tightening. As noted in the FOMC's Summary of Economic Projections, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year. When bank stress emerged in March, we acted in concert with other U.S. government agencies to address it, enabling the Federal Deposit Insurance Corporation to resolve 2 failed banks in a manner that protected all depositors. We also used our liquidity tools to make funding available to banks that might need it. In addition to our discount window, we established a new facility under our emergency lending authorities called the Bank Term Funding Program. Our provision of liquidity through these tools supported the stability of the financial system without restricting the use of our monetary policy tools to firm the stance of policy as part of our efforts to reduce inflation. The banking system remains sound and resilient, deposit flows have stabilized, and strains have eased. A little more than a decade ago, the global financial crisis required extraordinary interventions by governments around the world. Stabilizing the U.S. financial system required coordinated efforts by all parts of the government, including $700 billion in taxpayer funds to recapitalize banks, a suite of Fed emergency liquidity facilities, as well as government guarantees on bank transactions accounts and money market mutual funds. Despite these efforts, the Great Recession brought misery to countless millions. As the crisis slowly receded, authorities in the U.S. and around the world implemented a host of reforms. The goal was to build a system that could withstand severe shocks, including unanticipated ones that might arrive from any direction. In other words, a financial system that would be a source of strength during stressful periods. A key pillar was building resilience in the banking system, and this effort was remarkably successful. Over the course of a decade, capital and liquidity at the largest U.S. banks more than doubled. We began a program of rigorous annual stress tests to ensure that the banking system was capitalized against severe recessions and financial market turmoil. The Great Recession also underscored the critical importance of the non-bank sector. Here, too, the authorities have undertaken a number of steps to build resilience, although much remains to be done. In 2020, the financial system was again tested, facing a truly unprecedented shock as the pandemic brought the global economy to a standstill. Investors scrambled for safety and liquidity during what we call the dash for cash. Financial markets came again under extreme pressure. Ultimately, the authorities had to support financial markets again as part of the extremely forceful monetary and fiscal response to the public health emergency. The banking system, however, was now far more resilient than it had been before the reforms, and thus well positioned to absorb the shock. We cannot take the resilience of the financial system for granted, however. The multiple shocks we've seen over the past year or so, including the extreme volatility in commodity markets following Russia's invasion of Ukraine, and of course, surprisingly high and persistent inflation, as well as the associated increases in interest rates, stressed a large range of bank and non-bank financial institutions. Given the efforts to build resilience in the banking system over the past decade and a half, two natural questions might ask are, first, why did Silicon Valley Bank and two other sizable U.S. banks fail this spring? And second, why did Credit Suisse, a globally systemically important bank, or GSIB, require a government-supported rescue acquisition? We are committed to learning the lessons from the U.S. bank failures for our program of supervision and regulation, and I'll offer three brief observations about these events. The first observation is that it is very difficult to resist the natural human tendency to want to fight the last war, as we say. In 2008, we saw banks come under stress from outsized credit losses and insufficient liquidity. Such losses appeared possible in the early days of the pandemic crisis, although they ultimately did not materialize. In our stress tests, we have considered severe stress scenarios that produced losses on banks' books, including outsized credit losses. But of course, Silicon Valley Bank's vulnerability came not from credit risk, but from excessive interest rate risk exposure and a business model that was vulnerable in ways its management did not fully appreciate, including a heavy reliance on uninsured deposits. These events suggest a need to strengthen our supervision and regulation of institutions that are the size of Silicon Valley Bank. I look forward to evaluating proposals for such changes and implementing them where appropriate. Much will depend on getting the specifics right, and we should bear in mind that there are always trade-offs with any financial regulation. In addition, the U.S. has benefited from its rich, multi-tiered banking ecosystem, and that diversity should be preserved. The second observation I'll make is the value of forthrightly recognizing when a crisis is building and responding decisively. When SVB failed, it was clear that a number of standard assumptions, even though they were informed by hard experience and historical data, were wrong. Notably, bank runs were no longer a matter of days or weeks. They could now be nearly instantaneous. Fortunately, in concert with other parts of our government, we were able to act decisively to meet liquidity needs of the banking system, protect depositors, and ultimately limit contagion. The third observation I'll make is the value of having the very large banks be highly resilient. Our regulatory system is much stronger for the substantial additional safeguards we've built around the GSIBs since the Great Recession. They are subject to capital surcharges, required to be highly liquid, and held to the highest supervisory standards. The events of the past couple of months would have been much more difficult to manage had the largest banks been undercapitalized or illiquid. The Great Recession was certainly a watershed moment, demonstrating the terrible consequences a fragile financial system can have on people's lives. In response, regulators in the U.S. and around the globe set out to build a much more resilient financial system. And the ensuing experiences of the pandemic in the past few months did much to validate this approach. The bank runs and the failures of 2023, however, were painful reminders that we cannot predict all of the stresses that will inevitably come with time and chance. We therefore must not grow complacent about the financial system's resilience. And building and maintaining this resilience requires collaboration. The system was able to withstand recent shocks because of the efforts by regulators and legislators, including our international counterparts in the globally interconnected financial system. So we'll take these lessons on board. We'll keep learning, because the work of building and maintaining a resilient financial system is never done. Thanks.
Thank you very much, Chair Powell, for these very interesting remarks, and I'm very pleased to host this dialogue between Governor Hernández de Cos and Chair Powell on financial stability issues that we see now in light of the financial sector turbulences that we witnessed earlier this year. So, Chair Powell, you outlined what has happened in the financial sector earlier this year and also the actions that the authorities took. Do you think we are done now with the financial turmoil, or do you expect more to come?
So, I guess the question, is the crisis over? I would say, remember that our jobs generally involve worrying about things. That's what we do. we try to look at things, and so we're very reluctant to reach a judgment like that. So earlier this year, we had 3 significant bank failures in the United States, and we saw a real threat to contagion. We took strong actions to protect all of the depositors in every case. Of course, we're still monitoring that situation very carefully. I will say, though, deposit flows have stabilized. Things have really settled down quite a bit. Capital and liquidity in the banking system remain strong. Aggregate bank lending is actually moving up again. Banking sector profits are strong. So overall, I would say our banking system is strong and resilient. Although, again, we're carefully monitoring things.
Thanks very much. Governor, how about European banks? I thought we got away with a scare after also the Credit Suisse episode. How would you judge the situation?
Yeah. No, thank you, Cornelia. Before entering into the question, let me thank Chair Powell for coming to Madrid. It's a real pleasure. Also, thank you to all participants in this conference, and by the way, mainly to my staff for organizing and the staff of CEMFI for organizing this conference. Well, you know, Cornelia, that from the very beginning we've been emphasizing at the European level that our banks are resilient, and this remains the case. But perhaps more than emphasizing that they are resilient, I think it's more important to put the emphasis on the reasons why this is the case. And there are at least 2-3 reasons that I wanted to put on top today. The first one is regulation. It's not an exception. Europe is not an exception in the fact that we've been implementing the Basel III reforms during the last 10 years, and this has led clearly to higher capital and liquidity ratios for our banks. Perhaps the novelty in our case is the fact that we are implementing all these rules to all banks independently of their size, meaning that the capital and liquidity requirements are applied to all banks. And this has been, in particular, in the current context on which there were some small banks who were affected, has been particularly relevant also in the perception of the banks of our banking system. Second element that I want to emphasize is supervision. And it's very well in advance in the cycle when we started to increase rates, when we started to withdraw liquidity, that the SSM and the supervisory mechanism, the European supervisory mechanism, started also to put the emphasis on monitoring the risk of the banks that are more related precisely to this type of macro environment. And in particular, I think Chair Andrea Enria has been emphasizing that the emphasis was put, for example, on monitoring the liquidity funding of our banks, on monitoring interest rate risk. Many banks were asked to be more prudent in many dimensions, in the calibration of their models, in the validation of their models. And I think this has also helped to our banks to be in a more resilient position now. Then there is a third issue that perhaps also should be emphasized. It is more related to some idiosyncrasies of our banks. And the fact that, of course, I mean, the banking sector in Europe is very complex because we have many banks, but there is a good number of them that are very much focused on retail banking. And of course, this has an implication in terms, for example, for the funding and the stability of the funding. So retail deposits with a very significant amount of funding that is secure, but the deposit scheme, this has provided also for more stability. And of course, this stability of the liability side of the bank has also incorporated also some stability on the asset side of the bank, and this is also crucial. And the reality is that, for example, if you look at the Spanish banking system, the profitability has increased in a very significant manner. It's for the first time in 2022, the profitability of our banks is higher than the cost of capital. And this is mainly because they have profited for the interest rate increases that we've done at the European Central Bank. The interest rate margin has increased, meaning that the repricing of the asset side of the balance sheet has been higher than the one on the liability side. Having said that, as Chair Powell was emphasizing, this is about risk. And we know that the risks are very significant, that uncertainty is very high in the horizon. That, for example, the level of the interest margins of our banks that they have today won't be maintained, that there will be an update of the funding cost at some point, that also credit risk will increase, that there are losses that will emerge also in terms of their securities portfolios. And this is why we are emphasizing at the European level, also at the Spanish level, that we have to take the opportunity of this high profitability that we are observing in the short run to at least to keep resilience of the banks, if not even to increase resilience of our banks.
You speak to my heart as I'm responsible for macroprudential policies, so thanks very much. Governor, so just earlier this week, the European authorities in Brussels, they decided on a further update on the Basel III regulation, implementation. Are you happy with the progress that has been made?
Cornelia, can I ask you to turn the volume up a little? I'm having a hard time hearing both of you clearly.
I was just asking whether the political compromise that had been found earlier this week in the European authorities for Basel III implementation.
So Jay, is the same question that you were making to me in my room just
Right.
1 hour ago. Well, I mean, as chair of the Basel Committee, I have to be very prudent because, as you perfectly know, Cornelia, you're a member of the Basel Committee. We have a process on which we analyze and we evaluate all the details in this case, of the new directive. But let me just give some very general remarks on my perception of the agreement. So, in general terms, I think the agreement fulfills the agreement that was. And that was approved in 2017 at the global level. But it is true that there are deviations. For example, in terms of the implementation of the output floor, which perhaps is the most important of the elements of the agreement in 2017 at the Basel table. What it is important in this regard is that these deviations remain purely temporal. Because we know, and there is a very good paper, by the way, published by the European Central Bank 2 years ago, that all the benefits of the Basel Agreement, the 2017 Basel Agreement, will only be perceived in terms of higher financial stability, meaning also higher growth in the medium and long run, if there is a full implementation of the agreement. And that's for me the key now, that the deviations that we know that they are there are kept purely temporal.
Thank you very much. So after the turbulence, all of us, I think, have been thinking hard whether, how to evaluate the turmoil that happened earlier this year, what lessons should be drawn. Chair Powell, what are, in your view, the main lessons that can be drawn from the turmoil from your perspective?
So, Cornelia, you're correct. We have spent a great deal of time since March thinking about that very question, as you know. And I would say to start specifically with so 3 institutions failed, and they shared their fairly idiosyncratic business models, but they shared 2 common characteristics. One is very poor interest rate risk management, and the other is a funding model that involved quite large amounts of uninsured deposits. So in the near term, of course, we supervise many institutions, and we're in contact with institutions that share those characteristics, and we're working with them on improving their interest rate risk management and their funding model. That's obvious, and we're doing that. More sort of medium and longer term, though, I think, and we at the Fed think that there will be ways that kind of some obvious and some less than obvious ways that we need to strengthen both regulation and supervision. I would say from a regulatory standpoint, the regulatory tools we have around liquidity, the net stable funding ratio and the liquidity coverage ratio, they embed certain assumptions about what a bank run looks like. And what a bank run used to look like was more people standing in line at an ATM, a modern bank run. That's very different from what we saw at Silicon Valley Bank, where it wasn't about ATMs, it was about people on their phones who were very technologically enabled and able to move money very quickly. So the run was much faster than anything, and that needs to be reflected in our regulation as well as our supervision. And there will be other areas where we're within the regulatory world. It's not just a supervisory issue. It is, however, to a significant degree, supervision. So the supervisors, and let me just say at the beginning, the Board of Governors controls supervision. The reserve banks implement supervision, but we said at the Board of, so we're ultimately responsible for supervision of the banks. We delegate that function to the individual 12 reserve banks. So don't read this as really ultimately the board is the one that's accountable for this. But the supervisors were on the right issues. They actually found the liquidity issues and the interest rate risk management issues, but they were operating under a standard playbook where you escalate things fairly carefully, fairly slowly. So I think we look at that and we say, we need to be more agile. And where appropriate, we need to be more forceful. So we are doing, under the leadership of my colleague Michael Barr, who's the Vice Chair for Supervision, we're doing a review of our supervisory practices to try to find ways, and we will find ways to be more agile and, where appropriate, more forceful. And that's broadly where I think we are.
Thank you. I must say the Barr report is excellent reading also, so I really recommend it. So everyone is looking now to the Basel Committee, no? What do we learn in terms of regulation for the global financial sector? With your head of the chair of that committee, how would you see which lessons can be drawn from the global perspective?
Yeah, well, of course, I'm not in a position to give a very definite answer because, as you know, Cornelia, we are in the process of reviewing. There was a request by the GHOS, and we have started the work, but of course we haven't finished it. But perhaps let me try to anticipate some of the elements that for me are relevant and very much along the lines that Chair Powell was also emphasizing. The first issue is, okay, we are perhaps jumping too quickly on the regulatory issues, while I think, and this is also the consensus around the table, that perhaps we have to put more emphasis on supervision and strong supervision. Many of the elements that were behind the failures in the US and in Switzerland, and this has already been accepted by the authorities, is that supervision was not working well, okay? Well, when we've been analyzing this at the Basel Committee, the reality is that it's not only about the willingness of the supervisors to have a strong supervision, but also that it is difficult in very different dimensions. And let me perhaps put the emphasis on one of them. We know how important it is nowadays for supervisors to analyze and to have a deep understanding of the sustainability of the business models of the banks. But this is very difficult. In the end, what we are asking supervisors is whether a concrete bank will succeed in the medium and long run, when, of course, they are subjected, as many other companies, not only in the financial sector, but also in the non-financial sector, to many structural changes that are very difficult to identify for the private sector itself, and of course, even more the case for the public sector. So to have a holistic view on how to measure, how to analyze the sustainability of the business models of the banks is absolutely crucial, but it's not easy. But then even let's imagine that we are in a position to say that certain bank, the sustainability of its business model is not sustainable. Then we have to intervene. But you have to intervene in a way that you cannot be shown as co-owning the bank. So it's forcing the bank to move in one direction, but without participating in the decisions. And when we've been looking at this into the details of different jurisdictions, the reality is that the tools, the instruments that the institutions have, the authorities, the supervisors have, are very heterogeneous. And in many dimensions, in many countries, are not sufficient in order to force the banks to move in the direction we want. So I think I will put the focus on this, because I think, and it's very much related also to the strategy review that we did at the Basel Committee 3 years ago, on which, well, the final conclusion of this strategy was, okay, we've been devoting the last 20, 30 years on putting the emphasis on capital regulation and liquidity regulation and banking regulation in general, while maybe the improvements in trying to homogenize supervision across jurisdictions, the emphasis has not been sufficient. No? So that's, for me, perhaps the first conclusion. Which, of course, doesn't mean that in terms of banking regulation, we should not also learn something from these events. And here, maybe I should differentiate two things. I mean, some elements, for example, and for me the most obvious one is interest rate risk. On interest rate risk, probably there is not much, there is nothing new there. I remember the discussions that were had at the Basel Committee for many years in 2016, for example, when the consultation paper on the interest rate risk was launched. Well, the initial proposal was for having a Pillar 1 capital requirement on interest rate risk. In the end, it didn't fly, for very good reasons. I'm not questioning the final outcome. But okay, let's come back to that discussion and whether recent events should modify or not this assessment that was done at that time. And there are other issues which are, to me, new. And this is more related, for example, to liquidity. And what we've learned, for example, from the Silicon Valley Bank is that the speed of the outflow of deposits. And I have to confess that I don't have a clear idea on how to solve this problem. No? And very extreme positions on one side or the other on how to solve this problem can also create collateral damage. You know? So I think we have to be careful also before dropping into clear and definite conclusions on this.
I think some of the banks that were in trouble, they had quite good liquidity coverage ratios, for instance, so it's maybe not the right measure to look at, or at least not only to focus on that one, yes. And you mentioned interest rate risks, and you talked about stress tests. I think in our wildest scenarios that we would have designed 2 years ago, we would not have thought, we would never have modeled the rapid rise in interest rates that we have now witnessed. So it's also a tricky business. So it means also that I think we are still, I mean, the financial stability reports of our respective institutions, they still stress that we are in a situation of elevated risks, financial stability risks. So I would like to hear from you, what do you think are the main risks for your respective jurisdictions at this point in time? Chair, if you want to start.
Sure, I'd be glad to. So I guess as you will, well, both of you will know very well, we have a framework for financial stability assessment, which we didn't have really before the global financial crisis. And we think it's helpful to have a framework that you constantly go back to, and so you can be held accountable, and it's very transparent to the public, and we talk about it, and we publish a financial stability report, I guess, semi-annually. So. The four broad categories of things that we look at are, first, asset prices, secondly, borrowing by households and businesses, thirdly, leverage in the banking system, and fourth, or in the financial system, and fourth, funding risk. So the kind of things that happen with, with the money market funds and things like that. So we look at those, and we look at them all the time so that we check ourselves that we're looking at everything and not just the obvious things. And and we published our most recent report in May. It's available on our website. And I would say overall, you see sort of moderate levels of vulnerability as you go through this. But there's some areas of real focus. I mentioned one of them, which is the aftermath of what we saw in the spring. That was 3 substantial banks failed unexpectedly, and we had to resort to extraordinary actions to protect depositors. We're still very carefully monitoring the banking system, although, as I pointed out, deposit flows have settled down, and things have settled down broadly there. But nonetheless, it's an area of real focus. I would also point to commercial real estate as an area where there's quite a bit of focus, and that's essentially a valuation question, and it's not exclusively, but I guess mainly about office. So work from home has really changed the story for many office properties, particularly in metropolitan areas where people can work from home and they have the kinds of jobs where you can do that. And so there's a valuation adjustment going on. We know where those risks are, but by and large they're not particularly present or concentrated in the large banks. If you go to the smaller banks, let's say in the United States under 100 billion, there's a substantial amount of commercial real estate, but there are not too many institutions that have high concentrations. So the point is, where an institution has a high concentration of commercial real estate, whether it's office or the sort of related retail that goes with downtown offices, we have a supervisory playbook, and the supervisors are working with those institutions to address the concentration and help them work their way through it. So this is a process that's been underway for some time. We're monitoring it carefully. On things like bank capital, I would say, is widely acknowledged to be strong. That's not an issue. Bank funding is the amount of liquidity that banks now have is certainly the largest banks have is very, very high. So we still have some funding vulnerabilities, though, as we saw in March, but also we haven't really addressed the issues with money market funds yet, where there were runs in the global financial crisis. The government had to step in, and again had to step in as part of the pandemic response their proposals to continue to work and to diminish and hopefully solve that problem. So those are some of the things I would point to.
Thank you. And in particular, we have witnessed some inflows into money market funds now in the US, haven't we, after the turmoil?
Yes, so that was really a function of, there were some big flows that happened around the time of the March crisis, and those have stopped. There's an ongoing thing. During any tightening cycle in the United States, and I imagine elsewhere, people tend to move money over time from bank deposits into money market funds, because during a tightening cycle, there are higher yields to be had in the markets than there are in deposits. This is something that goes on, and it's just part of the process of what happens during tightening, and it causes banks to tighten lending conditions, and of course that's a desired result. And as long as that's an orderly process, it's expected as part of what we do. So there are different things going on, and I would say what we're seeing now is very much in line with expectations.
Thank you. Governor, how about the European risk?
Yeah, well, you know, Cornelia, that in the European case, the heterogeneity across countries is very high. So I will refer mainly to Spain. And here, the main element of differentiation of Spain as compared to other countries is of the euro area is that I mean, in terms of financial stability risk, the developments in the last 10 years have been relatively good, in the sense that there has been a significant leveraging process of the private sector with a significant fall of private debt to GDP ratio of our economy. Well, the transformation of very significant current account deficit into a current account surplus, a current account surplus that has been maintained also in the last year under very stressed conditions during the pandemic and now with the energy crisis. So let's put it this way, most of the risks that we are observing and that we are emphasizing in our financial stability report are not so much endogenous, okay, to the financial cycle itself, but more of a macro nature, and the interconnection, of course, of this with the situation of households, of firms, and also in particular, in our case, of the public sector. So, for example, if you read our last financial stability report, the one that was published in May, there was a positive statement in the sense that it is true that our economy has behaved has remained more resilient than we were initially expecting, and this has been seen, for example, in the fact that our last two projections, the projections that were published in March, the one that we've just published a few days ago, we've revised significantly, I would say, growth for this year outwards. And of course, this is good for the economy, and this is good for financial stability. But at the same time, and coming back to a comment that I made at the beginning, that uncertainty is very high, risk remain. Most of them come from geopolitical dimension, and in particular the war in Ukraine, but also very much related to the uncertainty that we have on the need and the magnitude of the monetary policy tightening that we will have to deliver in order to meet our 2% price stability mandate. And if you take this risk and you combine them with some of the vulnerabilities of the Spanish economy, I would say that the two main risks that we are facing, one is more related to the public sector. So the Spanish economy increased the public to GDP ratio in a very significant manner, more than 80 percentage points of GDP since 2007. To a certain extent, there was a transformation of the private sector debt into public sector debt. And it's not only about the stock, it's also about the flow. Structural deficit, public structural deficit in our economy is very high, around 4% according to many of the estimates that are available. And of course, this is a vulnerability of the economy, and this is a vulnerability of the economy, in particular in a context on which interest rates are increasing. And of course, also for the private sector, and in particular in a context on which interest rates are increasing, and at the same time inflation has remained very, very high. The combination of these two things is leading, of course, to real incomes that are falling, and of course to interest burden that is increasing. So, and we develop regularly, and we publish it in our financial stability report, this simulation exercise on which we see that even under the current assumptions for the expectations of interest rate increases and in our central scenario for macro growth, there will be an increase in the vulnerability and the percentage of vulnerable firms, financial vulnerable firms and financial vulnerable households. And this, of course, will have also an implication in terms of potential losses for our banks. So given that these are the two main risks that we are observing, this is why the policy message that we are sending is also very clear in both dimensions. So the first one I was already mentioning, the fact that we think that our banks, even if they are profiting in the very short run from the current environment, since risks remain and remain elevated, I think it's important that they keep resilient or even that they increase the resilience in the current context. And the second is, of course, for the public sector, that we think with the current macro conditions is of the essence that a fiscal consolidation process is initiated in order to reduce in a gradual manner this vulnerability that the Spanish economy has.
So Chair Powell had mentioned the commercial real estate sector. Would you, I mean, they were of course very much badly hit by the COVID situation, and that, but also residential real estate will be affected a lot by the rising interest rate environment. How's the situation in Spain?
Well, in Spain, this has also behaved relatively different to other countries. Of course, one of the main reasons of why the global financial crisis hit the Spanish economy so significantly was because of the booming of the construction sector before the global financial crisis. The adjustment has been huge. It's not only about the numbers I was giving before on private debt to GDP ratios, but also, for example, the weight of the construction sector in the economy. The construction sector reached a peak in terms of the value added of the economy. It was close to 12% before the global financial crisis. Now it's 5%, which is the average in the euro area economies. Then housing prices, housing transactions during the last year, I mean, there's been a recovery, okay, of course, of the housing sector, but nothing compared to what we've observed in other countries like the Netherlands, Germany, and some of the Nordic countries. No? And of course, we want to think that, of course, the fact that we haven't seen exuberance in the housing market, at least as comparable to other European countries, this will also have an effect in terms of the potential adjustment in a context of higher interest rates.
Thank you. So moving on to monetary policy related aspects, or rather the interaction between monetary and financial stability, we have seen that the actions of some central banks, and not only in the US but also in the UK, for instance, last fall, central banks had to take some actions that were by some perceived as interfering with the monetary policy stance. So how would you assess, to both of you, the relationship between financial stability and price stability in your jurisdiction, Chair Powell?
So I guess I would start by saying that I see the two as tightly and closely related. We actually say in our constitutional document that the FOMC adopts every year that achieving our statutory goals of maximum employment and price stability depends on a stable financial system. So, and to think of it the other way, if there's an event, a sustained event of significant financial instability, that's certain to have, almost certain to have significant macroeconomic consequences. So the two over time, they go together. You can't really have them pointing in different directions for a sustained period of time. So that's my overall view. And I think if you look back at what we've seen, we've been able to raise interest rates and to expect further interest rates. We've been able to continue our fight to get inflation under control. At the same time, we've used our tools to foster financial stability and protect depositors and provide liquidity to institutions that may need it. We've been able to use those tools separately. I don't argue for a full and complete conceptual or practical separation between the tools. I do think the tools that foster macroeconomic stability also foster financial stability and vice versa. So I think we are accountable for both financial stability and macroeconomic stability, and our tools will broadly foster both of those outcomes. So, and I would say today our banking system is certainly strong and resilient, and interest rate risk we talked about. Most banks manage interest rate risk successfully. And I would say, I would also point out, I was going to mention that Actually, a very severe downturn in commercial real estate was one of the features of the stress test that we did, that we announced the results yesterday, and the 23 banks that took the stress test this year all passed that.
That's very encouraging to hear. How about you, Governor?
Yeah, well, my position is not very different to the one that has been expressed by Chair Powell. And you know, Cornelia, that we devoted a lot of time, and you were part of that team, no, in the strategy review that was developed by the European Central Bank and that reached to the conclusion that we published in June 2021. No? We were analyzing, among many other things, precisely the interconnection between financial stability and monetary policy. And in the end, we made this statement that, price stability is a precondition for financial stability, and financial stability is a precondition for price stability, which in the end is showing also the important interconnections and interdependencies that we have among these two objectives. No? As Chair Powell was saying, I mean, in many contexts, what you do with monetary policy is absolutely compatible, and there are no trade-offs in terms of guaranteeing also financial stability. And by the way, this is not only in normal circumstances, which of course even there is even easier because you have macroprudential tools on the one hand and the monetary tools on the other. But even in stress conditions, and you may remember, for example, at the beginning of the pandemic, the pandemic purchase program that we launched at the European Central Bank. Of course, the focus and the main objective and the main motivation of the package was to try to fight against a deflationary shock. But at the same time, the way it was designed, it made also it possible to fight against potential financial stability disturbances, in particular financial fragmentation. So using the same tool, the monetary policy tool, in the end was compatible with trying to reach both objectives. And the same is true, for example, with the TPI, you know, the transmission protection instrument that we decided to launch in July 2022, which in the end, of course, was also trying to guarantee that the transmission of our monetary policy to the euro area was completely homogeneous. So this was a monetary policy objective. But at the same time, we know that in a context of higher interest rates, if these fragmentation issues emerge, they might also lead to financial instability. So that, again, one instrument was able to do the job for trying to pursue both objectives. As Chair Powell was saying, I mean, of course you can imagine situations, and in particular in systemic crisis, that there might be a trade-off, but I would try to avoid to try to anticipate what we will do in that situation. Of course, we will have to be pragmatic in those situations and trying to anticipate well in advance those actions, including by the way the action of fiscal policy. Because if we are talking about solvency issues and not only liquidity issues, then fiscal policy will also have to play a role. I think it doesn't make much sense. So let's be pragmatic.
Very good. So going forward, of course, on the monetary policy side, we still see elevated inflation, and in particular, the core inflation is still showing quite some resistance, I think, on both sides of the Atlantic, even though energy prices have been falling over the past half year or so. So, but still, in light of the current situation, how would you expect that monetary policy might evolve over the next quarters? I'm not asking for specific predictions, but also in light of the turbulences, of course, that we have seen.
I'm tempted to say it depends, but it will depend on the evolution of the economy, which is always uncertain, and I think today particularly uncertain, given, for one thing, we've raised our policy rate 5 percentage points, 500 basis points in a little bit more than a year. And most of those hikes took place in the later part of last year. So, and also policy's only been restrictive for a few months, really, for 6 or 9 months. So we're still waiting for the real effects of our tightening policy to be felt, not just on interest-sensitive spending, but more broadly throughout the economy, on activity, and then ultimately on inflation. So we believe there's some in the pipeline, as we say, and it's hard to say exactly with what speed it will come. But that's one thing that we think about a lot. It's how far we've come, and it's also how much is in the pipeline. And also, we're looking As I mentioned, there's a macroeconomic connection with the financial issues that we saw earlier this year. There's good research showing that when banks experience stress, they tend to pull back from lending for obvious reasons. They're going to want to conserve capital and liquidity and that kind of thing. We don't see an incremental pullback yet, but we may see that, and so we're definitely thinking about that. In terms of where we are, we've said that we will use our tools to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. At our last meeting, we decided to maintain the level of rates that we are at, which is just over 5%, but at the same time indicate with our individual summaries of our individual projections for the 18 members of the FOMC, indicated that a strong majority feels that 2 or more hikes will be appropriate by the end of this year, as I mentioned during my remarks. But I would stress, though, that our commitment isn't to a particular number of rate hikes. It is to a stance of policy that's sufficiently restrictive to bring inflation down to 2%. That we can do and that we will do. And the timing and extent of any further rate increases, of course, will depend on the course of the economy.
Thank you. And do you, so now you have just paused and you said that you're waiting for the effects to feed through the economy, which can take quite some time. So are you worried that maybe you could overdo the tightening?
So I think as we've moved along, the risks, at the beginning there was little risk of overdoing it and a lot of risk of underdoing it. As you get closer and closer to what you think your destination is, those risks begin to come more into balance. I wouldn't say they're in balance yet. So we are certainly thinking about that. I also said, the decision was basically not to move at one meeting so that we can have more information. And so in a way we're addressing, we raised it 75 basis points at 4 consecutive meetings, then we slowed in December to a 50 basis point hike, then 3 consecutive 25 basis point hikes. So we're continually moderating the pace. And so it may be that we don't move for a meeting and then move at a meeting. Each meeting is going to be decided. We haven't taken consecutive moves off the table, but we have said that we're prepared. And we did take one meeting where we didn't move. So that's in a way a moderation of the pace. And so I would expect something like that to continue, assuming the economy evolves about as expected, which it is not. It has a tendency to do something different. We've all seen inflation be over and over again shown to be more persistent and stronger than we expected. At some point that may change, and I think we have to be ready to follow the data and be a little patient as we let this unfold.
Yes, thank you. So yesterday at the conference in Sintra that you also attended, there was one session about uncertainty and economic forecasting. And I think the consensus is really that the level of uncertainty is extremely high in current circumstances. So it's a difficult job. So how about you, Governor? How about European monetary policy looking ahead?
Well, it's not very different in terms of the main messages given by Chair Powell. No? You know that we had our meeting just some days ago. We had new projections, full of uncertainty, these projections. I remember perfectly that the staff also is always providing the centralized scenario, but also the uncertainty that the staff gives to each number, no, in the centralized scenario. And the level of uncertainty that they were showing to us was the highest in the last 2 years, which is already something. No? And this precisely this very high level of uncertainty, the one that is motivating this idea at the Governing Council of the European Central Bank that we want to be more data dependent than ever. So it's true that the new projections were showing an upward revision in core inflation, in particular for 2023 and 2024. Also, there was a slight upward revision of headline inflation for 2025. So in the end, the conclusion was that inflation would remain high for too long and that we needed more tightening. And this is why we increased rates by 25 basis points during the meeting. And to a certain extent, we have also anticipated that if the central scenario doesn't change in a material way, we will be also in a position to increase rates also in our July meeting. But that's it. I mean, for me, at least, it's very clear that the September meeting is absolutely open in terms of whether there will be or not a necessity to tighten monetary policy more. I see things now more two-sided. On the one hand, it's obvious that the fact that inflation is keeping high for too long also increases the probability of having very significant or more significant second-round effects on wages and markups, something that, of course, is not incorporated into the central scenario. And, of course, if this materializes, this would lead to higher tightening needed in the future. But at the same time, I also see that monetary policy transmission is working, and is working in a very forceful way. And the fact that we are already observing some weaknesses in economic data in the euro area, I think, in my view, is also related to the fact that monetary policy tightening is already having an effect on the economy. And we know that given the size, the magnitude, and the speed of the tightening that we've done in a very short period of time, we can also miscalibrate the potential consequences of this tightening. There might be some non-linear effects. So we have to monitor both not only developments on core inflation, headline inflation, projections, but also the transmission of our monetary policy. And we have to be ready to react accordingly to what we see. No? So, I mean, very high uncertainty should lead to data dependency. So let's just not enter into discussions on what the tightening could be in the second half of the year. I think it's too early to say.
So you say that the tightening is already being felt in the economy, but on the other hand, the labor market is very strong in the euro area, I think also in the US. So will there be a bad surprise at some point in time for the working population?
Well, I mean, the transmission mechanism of monetary policy is through demand. That's obvious. There is no other way that I can think of how monetary policy can be transmitted, and lower consumption, lower investment, in the end, would also lead to lower employment. That's clear. But the good news are, of course, is that till now we are in a situation on which labor market, not only in Europe, not only in Spain, but all over the world, in the US for sure, is behaving very well. So that the initial position is also good. So that then the impact that the monetary policy might have on employment in net terms will be perhaps lower.
So I would have one very final question, and that's really looking ahead, not over the next quarters, but maybe in the longer term, because we have now seen a period, a whole decade of exceptionally low interest rates. I don't think unprecedented here. We had negative interest rates on this side of the Atlantic. So by historical standards, really something very special, and a very, very accommodative monetary policy. So what is your prediction? Will we ever see a return to this very low interest rate environment, or do you think that over the long term the equilibrium will be at again a higher level?
I guess I'd start by saying rates have been very low for a long period of time, but you might agree, that doesn't necessarily mean policy was accommodative. I think there was good evidence to think that the neutral rate of interest was significantly declining over a long period of time due to a lot of global forces, demographics, aging population around the world, maybe globalization, advance of technology, a lot of savings in the world, those sorts of things. So that was the world we were in until the pandemic. And now, of course, we're in a world, and that was a world of very low inflation, low growth, low productivity, and low rates. Now the pandemic comes, and it's this enormously disruptive event. The disruptions are likely to last for years on end. And the question is, where will we come out in the end? It's a really good question. I think it's very hard to know, and there are people arguing both sides. I think for the near term, central banks are going to be very sensitive about inflation. We will not assume that we're going back to that low inflation environment for a good while, because, of course, we've seen what's happened. In terms of rates, I think we're just going to have to find our way. You would have thought it wouldn't have been thinkable to have a 5% interest rate before the pandemic, and now the question is that tight enough policy? And a strong majority of almost overwhelmingly, FOMC participants think that we need to do more to get to a level of tight policy. So I don't think we have the longer run answer, but it's a good question.
No, I fully agree with Jay. No, I mean, for sure, in the short run, we know that rates will remain high. That's clear under any scenario that I can envisage. Of course, the interesting question is more the long run. No? To what extent these things have changed? And I don't know, when I go through the list of the arguments that were used even before the pandemic to justify why R star was low, I mean, in many dimensions, I don't see material changes. So, for example, the main two arguments that were justifying very low R star estimates were, on the one hand, low productivity. And, well, I don't see a significant change in productivity dynamics across the globe. You may think that digitalization might improve productivity at some point, but at the same time, you have all this potential deglobalization process that will go in the opposite direction. It will have negative consequences on productivity. Then the second main argument that was always used was demographics. And, of course, demographics is a very slow-moving variable. It's not that it has changed or will change materially in the following years. And perhaps for me the main novelty, and even as a consequence of the pandemic and the response that was given in particular by fiscal policy, is that across the globe public debt is higher. And of course this will require higher saving in order to finance this public debt, and this could lead to also higher long-term rates. That's for me perhaps the variable that would have changed with a more medium-term perspective, or long-run perspective. But as Chair Powell was saying, I mean, the certainty on all these non-absorbable variables is very, very significant, in particular in the current context.
Thank you very much. So bottom line, even the most experienced and distinguished central bankers don't know.
Correct.
So thank you very much. This concludes our dialogue for this morning. Thank you very much, Chair Powell, Governor Hernández de Cos. Thanks very much.
Thank you.
Thank you.
Quedan 30 segundos. Esto me imagino que funciona automático, ¿no?
Okay.
Que esto será automático.
Esperemos.
Good morning. Welcome to the first session of this conference. Before we get started, let me just say that my name is Rafael Repulo. I'm the director of CEMFI. I'm the co-chair of the scientific committee of this conference. The other co-chair is Angel Estrada, who is not here. He's the injured person that you can see that was sitting in the first row before. We received 115 papers for this conference. We did a first screening, and then about 50 papers were sent to the scientific committee, and the outcome of this is the 12 papers that we're going to see between today and tomorrow. I would like to thank Luis Gutierrez de Rozas, who is indeed sitting in the last row, who basically did all the hard job of putting all the papers in suitable form to be processed, and did all these emailings to the speakers and discussers. Okay, now the rules of the game in this and the other sessions are as follows. Each speaker will have 20 minutes to make his or her presentation. The discussants will have 10 minutes. And there's going to be 10 minutes for general discussion. I have these cards here that basically I'm going to use them to keep tight control on the timing. Yes, I guess that without further ado, David is first. He's going to present this paper that you have on the screen. So the floor is yours, and here is the mouse.
Thank you so much, Rafa. So, first of all, it's a pleasure to be in this audience and to be in this conference. And this is joint work with Alejandro, who's sitting there. If there's anything you like about the paper, Alejandro did it. You know, that's clear. If you know me and you see the paper, you'll understand very quickly why that's the case. Anyway, I guess that in this audience, and given the talk that we just had, the very interesting talks, it's very easy to argue that, you know, monetary policy is a very relevant tool in the economic policy tool set. Okay, it affects relative prices. It's going to affect agents in very different ways. And what we're going to do in this paper is we're going to look at one specific agent, and that will be banks, that are at the core of the transmission of monetary policy to the economy. Okay, we know that, you know, banks can transmit monetary policy to the economy in very different ways. They can affect their lending. It can affect its deposit taking, its asset purchases. There's very different ways. And what we argue is that not only us, but many people, that understanding what actually determines the way that banks transmit monetary policy to the real economy is key. Specifically, what we're going to do in this paper, sorry, I just get to have the handle of the mouse, is that in this paper we're going to focus on one specific aspect of this bank monetary policy transmission, that is the lending reactions of banks to monetary policy changes, the so-called bank lending channel. There's so many channels in monetary policy that, you know, we can get lost. Here, basically, just think about, we want to analyze what happens in the lending market when monetary policy changes. What do we know about this? Well, we know a lot of things, and people in the audience are basically have found some of these findings, and we know that mainly there's a lot of heterogeneity in how monetary policy is transmitted to real economy through banks. Why? Well, basically we know that there's important characteristics of the banking sector, like for example their size, their liquidity, the capital requirements, that actually shape how bank lending is affected by monetary policy. But it's not only bank characteristics, there's also banking market characteristics, like for example a recent paper by Dressler et al. That argues that it's the competition in the deposit market which is a key driver of how this monetary policy is transmitted. What we're going to do in this paper, we're going to talk about one novel specific element. And this is important. The element we're going to talk is a bank market characteristic. So basically what we're going to be talking about is local lending specialization. I'm going to be very clear in the talk of what we mean by this. But mainly, where we started our project is by the finding that, well, we can observe that banks heterogeneously specialize in different lending markets, in different geographical markets, okay? And then there's papers that argue that this can give banks different incentives to, for example, acquire specific information about those markets, and also makes banks more or less prone to be affected by market-specific shocks. What we argue is that because of these different incentives, banks can then react differently through their lending to monetary policy shocks in each of these geographical markets. And that's what we're going to deep in today. Okay? So basically our research question is quite clear, does this local lending market specialization affect the transmission of monetary policy through banks' loan supply? And what we're going to do is we're going to analyze the relevance of each geographical lending market for a given bank, and we're going to focus on the US mortgage market. Okay, among all of the markets we can look at, we're going to be looking at the US mortgage market. For you to have some idea, in our data set, this is around above 50% of all of the on-balance sheet loans that banks have. So it's a very relevant market for the banking sector. Okay? And when we talk about monetary policy changes, we're going to have two main elements to analyze. For the most part today, we're going to talk about actual changes in the Fed funds target rate, and then we have some robustness, and I'm going to give you some results in which we try to take more exogenous shocks to monetary policy, like for example for Jarinsky and Karate, or shadow rates, and I'm going to give you some glimpse of what happens when we use that. Okay? The main story is that the things seem to go in the same line. Now, this is our key variable. So, this is the important thing for today. After this, I think it's easier. So what do we focus on? What we focus in is we want to capture how relevant is a given geographical market, what we define as a county, for a given bank. So basically our measure of specialization, which is for a given bank, a given county in a given year. So if you have the numerator is all of the new mortgage lending of Bank B in County C in a given year, divided, and this is fundamental, by the total amount of new mortgage lendings of that bank. So we're looking at the relevant weight of new mortgage lending in the bank's portfolio. Okay, that's our measure. Now, a very simple example. Think about a bank that is lending only in two markets. In one market, lend 9 million new mortgages. In market B, it's 1 million new mortgages. While the specialization variable for that bank in market A would be 0.9. For market B, would be 0.1. If you want some more realistic numbers, this is, for example, Bank of America in 2016. And if you look here at Los Angeles County, that would be a specialization of 0.12. That's the highest for Bank of America. And if you go to Santa Clara, that would be a specialization of 0.06. But of course, what we're going to build upon is the heterogeneity that happens across banks. So if we pick another bank, much smaller, a credit union, what do we have? We have in the same county, Los Angeles, the specialization for that specific bank would be much smaller, 0.015, whereas in Santa Clara, it would be 0.52. So this difference, this heterogeneity is what we're going to exploit in our research. Okay? So now, something relevant is to differentiate between two measures. One is the specialization measure. Let's recall that is the geographical importance of a county for a bank, versus another measure that we're going to use, and that has been used in the literature, which is the market share. Market share captures a different thing. It's how different is a bank for a given county. Okay? So they might seem similar, but you can see that basically the denominator is what changes. In one is the total portfolio of the bank. That's our main variable. In the other one is the total lending in the county. Okay, and that's very clear, and it's very important to have them separated. Okay? Anyway, and here's just an example that gives you some idea of why this is different. Now, what do we find, basically? We have two main sets of finding. First, from a microevidence, what we find is that after a reduction in the Fed fund rates, banks are going to increase new mortgage supply growth by more, where in counties in which they were previously more specialized, so that those countries were more relevant for the bank portfolio. Okay, and this is relative to what? Relative to two main things: to other banks that operate in the same county. So we have this within county fixed effects, and also relevant to what the bank is doing in other counties. So we have this within bank estimation. Okay, for you to have some idea about the economic magnitudes, think about 100 basis point decrease in monetary policy target rates, and think about a change of 1 standard deviation in the specialization. So basically what we find is that there's a higher mortgage supply growth of 54 basis points. Okay, so that's the magnitudes that we are talking about in this paper. Okay? Now, what we argue is that this microevidence can have important aggregate results in two levels. One is at the county level or regional level. What we find is that indeed counties that are more exposed to the specialized banks actually see an increase in new mortgage lending, house price, and then also smaller in wages and employment. Okay, so we see suggestive evidence of a transmission to the aggregate real economy at the county level. And also, we find that there's evidence of an impact on overall bank portfolio reallocation. So we find that after a reduction in the Fed funds rate, banks increase the specialization. That means that they are more exposed to regional shocks of a given county. Okay? So, in a nutshell, that's the findings we have. We then, and this is the less developed part of the paper, we want to analyze a bit deeper into the mechanisms, and we argue, and we built a simple theoretical model, which I'm not going to have the time to present, sorry for that, that basically we argue that this can be driven by market-specific information acquisition shocks. And we basically use a proxy that is the distance between the headquarters and the county, and show that basically this distance is a good predictor of what I just told you about. So we argue that maybe this informational cost transmission can be at the core of what is happening here. Now, what we argue is that we are adding to mainly two strands of literature. One of them is this huge literature on how monetary policy is transmitted through the banking sector. And what we add there is a new variable, this local bank specialization. And another one that I think is important is a literature that talks in general about bank shocks, not only about monetary policy, but in general about how banks transmit shocks. And this is where the market share variable is important, because there's a very nice paper about Janetti and Saidi that argues that banks, by having a higher market share, can internalize more negative externalities. What we do is we take that idea and bring it into the monetary policy literature and say, well, if monetary policy is a shock, then this variable can be relevant, and you will see that it's actually also relevant for transmission of monetary policy. Okay? And let's skip this one. Perfect. So what's the data we're going to use? We're going to use data from 1994 to 2019, and mainly, I want to stress this, for today, the main data, and in the paper, is HOMDA, so Home Mortgage Disclosure Act. We're talking about new mortgage lending in this paper, okay? Now, what's basically in a nutshell, what's the idea we want? So think about Bank One. Bank One, in a given year, gives 9 million new mortgages in Market A and 1 million in Market B. Then there is a Fed funds change, and what we see is that this 9 million goes to 12 million in Market A and 1.25 million in Market B. So there's an increase, if you want, of 33% in the lending of Market A and only of 25% in Market B. So what we're going to do is we're going to try to estimate this effect, and what's crucial is that one fundamental problem that we have is that, okay, but Market A can be fundamentally different from Market B. Okay, so monetary policy can affect Market A in some fundamental fashion, and what we're taking is demand and not supply. Well, for that, it's what we have Bank 2. Okay, if we assume that basically the aggregate shocks of Market A are equally, Bank 1 and Bank 2 are equally affected, so basically homogeneous demand shocks, then we can use the growth of Bank 2 in order to basically see the difference between what Bank 1 is doing and what Bank 2 is doing to capture the effect of specialization. Long story short, what I mean is that the main threat we have is that there could be changes in local lending opportunities, and how we're gonna try to solve that is basically by including county time fixed effects. So we're gonna basically assume that there's homogeneous demand inside a given county for both banks. If that assumption is true, then what we can see is that we're gonna have a supply effect coming here. But I want to be clear that this builds on this assumption, okay? Let me skip bank heterogeneity, it's not evident. So this is the main micro regression that we're running. What are we running? What we're running is the change in the growth rate by bank B in county C in a given period. We are putting these bank fixed effects. We are putting fundamentally and crucially this county time fixed effect that captured these aggregate demand shocks at the county level. And our element of interest is this beta 1, which tells us how is the differential moved by banks that are more or less specialized in that county to a change in the Fed funds rate. Okay, so that's basically what we're going to be running. And what our results, let me skip the growth variable, what we're basically finding is that after a decrease in the Fed funds rate, so that's negative here, banks increase new mortgage lending growth by more where they're more specialized. So remember, negative times negative, it's positive. Okay, so that's basically what we're finding. And as I said, basically the economic magnitude is 54 basis points if you take 100 basis point decrease and 1 standard deviation difference of a specialization. Okay, you can see by, if you focus on, how stable the coefficient is, that, including some of these county year fixed effects can be relevant because it captures part of the effect, but at least, you see some stability in the sign, so we don't see any change. That gives us some consistency, if you want, on the direction. Maybe not so much on the exact point estimate, but just on the direction of the effect. Okay? So then what we do afterward is we include some other relevant market structure characteristics. One of them fundamentally is this market share that we were talking about of genetic anxiety, and also other measures like deposit market competition. Long story short, the coefficient basically doesn't change very much. One interesting thing is that it looks like market share is also a relevant factor for the transmission of monetary policy. So I think that's also something to highlight. And if we want to talk about wrestlers, novel, and so on, we can talk over the break, but there's something there, but again, let me skip that, okay? Anyway, so once we have that, what we basically change, we say, well, this changes in monetary policy shock, in monetary policy rate. What we now want to do is sort of more exogenous changes. And for that, we're going to use, exogenous monetary policy shocks a la Jarinsky and Karady or shadow rates. And the main message is that if anything results are stronger, okay, the economic magnitude is stronger if we use these exogenous or pseudo-exogenous shocks, but the main idea still holds. Banks do more where they are more specialized after monetary policy easing. Okay? There's a lot of robustness there. I don't have time. The main thing I want to say is that we find that this is especially relevant for easing of monetary policy. That's why I'm always saying this 100 basis point decrease, okay? Because that's some finding that we find. Let me skip these new small business loans, but there's basically just to tell you that it looks like when we look for new business loans, there's also an effect there. But here we want to be very clear that we think that other elements like industry specialization that have been talked about and some people are analyzing is very relevant. We haven't done it, so this is just sort of a teaser. What it looks like for small business loans is also important. We honestly think it's much more relevant for mortgages than for small business loans because of these industry factors that I think are much more important here. Now, once we have the micro evidence, what we do is we say, well, does this aggregate? And the main story for you to have in mind is it does aggregate. So the first thing we look is at the aggregate county level, and basically what we want to highlight is, well, if this is true, what should mean is that counties that are more exposed to banks that are specialized in them should see an increase in new mortgage lending. We find that. Then this should affect probably house prices. There's papers that show that credit is a determinant of house prices. So we find that there's also an effect in house prices. And finally, if we think about this collateral channel of house pricing and entrepreneurship, well, if house prices increase, collateral increases, there could be an effect in wages and employment. We find some effect, to be honest, not super big, okay, but some effect is there. So long story short, that's what we do. Here's the example. Basically, this gives you an idea of, how different markets are exposed to this specialization channel, and basically our result is here. We basically find that indeed, counties, now we're at the county level, counties that are more exposed to specialized banks see a higher increase in new mortgage lending growth when there's a decrease in Fed fund rate, see a higher increase in house price index, and a bit of a higher increase in wage and employment. So we think that this aggregates. Then This is robust to other measures, like monetary policy shocks, different measures of the growth variable, etc. And what we then analyze is, does this have implication not only at the county level, at the regional level, but also at the bank level? Does this change the specialization of the bank? It should change, like our results would be in line of changing the specialization of the bank, and that's what we actually find. We basically, let's skip what we actually do, there's nothing fancy there. Basically what we find is that after a decrease in Fed fund rates, banks become more specialized. Okay, that means that they are more exposed to regional shocks. Okay, that's basically one finding that we have. And finally, this would be, if you want, the main part of the paper. At the end, we want to dig a bit deeper into the underlying mechanism that is driving this result. I'm very sorry, I'm not gonna tell you about the model. The model is super simple. There's nothing there to really to look at, but the main idea is the following. What we argue is that banks have differential heterogeneous lending cost in each market. So it could be different for banks to, create a good screening mechanism in a given market versus another. Why? Because, it has already more information about one market than the other, because the offices, the way it's structured is nearer to the head office, whatever. Okay, we don't enter into that. I'll enter in a second in this distance variable. Well, if that's the case, then the reaction to a monetary policy is going to depend on the curvature of this marginal lending cost. Okay, and that's what we build on. And we basically build on a model that basically gets these findings, and more importantly, we try to proxy this heterogeneous marginal information cost by the distance between the headquarters and the given county. So let me skip the model. You will see that it's just the convexity, what's giving us this, so no fancy things there. This is more relevant. So what are we doing? Well, we're basically going and we're going to take a proxy following some papers in the literature that says, look, if a county is further away from the headquarters, then it might be more difficult to transmit information to the headquarters. And hence, screening mechanism and other issues might be less tied to that market. So what we do is we basically first show that indeed, counties that are further away from the headquarters are counties in which the bank is less specialized. So that happens. And then we have sort of a very crude, reduced form type of IB, if you want. We just put distance instead of a specialization in our regressions and find that the results hold. What does this mean? The sign flips because the further away you are, the less specialized you are. Okay? That's why the sign flips. But basically what we find is that counties that are further away from the headquarters actually see a lower increase in new mortgage lending growth after a decrease in Fed funds rate, and then this aggregates then at the aggregate county level and at the bank level. Okay? I have 1 minute, so let me just finish. Basically, what we do with this paper is we want to propose a new variable that tells us about how monetary policy is transmitted through the bank lending. Okay, this is important. This is inside this lending channel of monetary policy. Well, we argue that bank county specificities, which can capture things that, their screening costs or their other type of lending costs, can be fundamental for this transmission. And we provide evidence consistent with this being the case. This is important for multiple things, but for example, it's going to give us some information of, how important are regional shocks for the banks. Well, this is going to depend on the level of monetary policy and the specialization of the bank. And it's also going to tell us, well, how is monetary policy going to be transmitted? Well, we know that if the county is more exposed to specialized banks, monetary policy is going to transmit it, if you want, with a higher tension there than in other markets. Okay? Thank you very much.
Okay, thank you. Let's move now to the... Let me make sure that Okay, so Christian Huffinger from ESF Business School is the discussant.
So, first of all, thanks a lot to the organizers to invite me to discuss this interesting paper by Alejandro and David. So the punchline of the paper is basically that banks specialize more in response to reduction in interest rates, and they show this at the county level, at the bank level. They then rationalize this finding in a theoretical model that includes heterogeneous marginal lending costs different across markets, showing that if these marginal lending costs are lower, banks lend up to a higher threshold, so they lend more in markets where they have information advantages. Then go on to show that banks increase lending relatively more in markets in which they have a large presence and therefore these information advantages. So the first comment that I have relates to these mechanisms. When I read the paper, what jumped to my mind is that there are other alternative mechanisms, in particular risk shifting, that could also be consistent or are consistent with the empirical findings. How would this work? So we know lower interest rates imply or are associated with lower net interest margins. Lower net interest margins, on the other hand, yield lower franchise values, and it's very well established that lower franchise value could lead to higher risk taking. In a portfolio setting, so I had a figure there, but yeah, in a portfolio setting, a lower franchise value implies that I double down or potentially have an incentive to double down on markets to which I'm already highly exposed. If on the other hand I have a high franchise value, I might be more inclined to diversify and go into markets where I'm less exposed to reduce potentially default rates. So to show this information channel, the authors use physical distance between bank headquarters and loan markets as a proxy for informational distance, but lower physical distance could be, of course, also correlated with the bank's pre-existing exposure to a particular market. So using this test is likely difficult to tell apart both mechanisms. Idea here, or potential suggestions, would be to focus on mortgages that are originated to sell. So if they don't end up on the bank's balance sheet, they are not relevant exposure. So this would rule out the risk-shifting channel if you find there the same evidence, basically. And it would also be potentially informative to look at the composition of mortgages that originated to hold versus mortgages that originated to sell, and how this changes after a rate change. In general, understanding the mechanism, I think, is quite important, especially for policy implications, because if it's driven by risk-taking, it's mainly bad. If it's driven by marginal lending cost, at least there are some elements that are good in the sense that it might be more efficient if these banks go into these counties. The second mechanism that I put alternative, but alternative in parentheses, because in the end it's very similar to what you had in mind, but it changes the marginal lending cost through a slightly different driver. So I was wondering in general how different information on soft information across counties, especially if they're close, is actually in the end the standard retail mortgages, and it's mostly by now automated processes. Fintechs, one hint, fintechs is going into this market and gaining market share. Another plausible mechanism that I was thinking of is like the cost structure of banks, fixed versus variable costs. So consider two banks, one having a lot of branches, lots of staff in a particular market, the other one 10 times less. If interest rates are high, this means mortgage demand implies a low mortgage demand. So having a large brand network is probably, means a lot of free capacity because it's undercapitalized. But then if interest rates go down and mortgage demand goes up, the bank that already has a lot of branches there might have an easy time to scale up because economies of scale is going to be huge, while a bank that's not yet very active in this county would need to open new branches potentially, hire new staff, so would have like discontinued when it scales up and very high potential setup costs. Suggestion here, first, I think as far as I remember, there's data on bank branches by county which you can use to capture proxy the cost structure. Even more useful maybe is using data on online lenders or lenders without physical presence. So these lenders shouldn't differ in the cost structure across counties. Neither should they differ in terms of the soft information if they do this mostly automatically. So I'm going to skip identification strategy, basically the same picture as, very similar picture than the two of you. But given your comparisons, that you're comparing the lending of different banks to the same market and from one bank to different markets depending on how they're specialized, this could lead potentially to these forbidden comparisons. So there are a couple of papers now showing that when treatment effects are heterogeneous and units are treated at different points in time and or they're treated or the treatment is continuous, you can have coefficients that are not potentially the weighted average of the unit level treatment effects. Why? Because of forbidden comparisons. So this can happen if you compare treated units to already treated units, and units that are treated more to units that are treated less, and both is happening, potentially happening in your setting. And this can lead to significant drawbacks, the extreme one being that you end up with actually opposite signs of the actual individual treatment effects. But there are a couple of tests checking whether this is actually a problem. One is this paper that I have over there. So the second comment about the empirics relates to the size of the counties, which of course varies a lot in the US, between 10 million LA County, then have counties with 57 people living there. And in general, the effects of interest rate changes on mortgage demand and supply might be quite different in urban versus rural counties. And this might be a problem for your measure that you use at the county level. So there you're employing the county's exposure to banks that are specialized. You talked about this measure, but it's basically capturing the size of the lending in a particular county versus its overall lending. And of course, if you're a larger county, you might have a larger measure there. And if you aggregate it up, you end up with potentially having this at the county level, larger measure for larger counties. So potentially there might be an issue that you're comparing this interest rate effect on mortgage supply between urban and rural counties, but there's an easy fix if you just control for county size and the interaction between county size and interest rate change, you can rule out this. The last one, just quickly, so I was a little bit puzzled about this coefficient of your spec variable, which is negative here. Was wondering what is the economic rationale about this, and then I was also a little bit puzzled about the calculation of the economic magnitude. So you're using basis points or 100 basis points, but if you look at the delta in interest rates, which we see over here, it seems to be expressed in percentage points, at least for basis points it seems quite low. So I was a little bit not sure what to make out of this. Which potentially has implications for also the joint or the size of the coefficient of the joint effect. Some minor comments. The most important one, just for the sake of time, your setting is quite nice, but it allows to even be more stringent on the fixed effect side. You could include bank-county fixed effects, which then absorb all time invariant bank-county relationship heterogeneity, making the identification even more cleaner. So let me conclude. So in general, I liked the paper a lot, enjoyed reading it a lot. Why did I like it in particular? So I think we need more papers like this, studying the risk coming from concentrated exposures, which in my view are more important than looking at idiosyncratic lending to riskier borrowers. So that we have the examples of the Silicon Valley Bank, Signature Bank, all very exposed to particular asset class or particular clients. And so far, empirical banking often tends to analyze risk-taking more with the view, not the portfolio view, and not taking into account pre-existing exposures, but looking at whether you lend to a particular borrower that might be risky or less risky. But if you don't look at the pre-existing exposure, this doesn't tell you much about whether this lending is actually risky or not. So yeah, more papers in this direction, I appreciate a lot. So thanks a lot again. And
okay, well. Thank you very much, Christian. 2 minutes to respond, and then we'll move to the general public.
Perfect. Awesome, Christian. Thanks a lot. I just can say that I agree with all your comments and also with some that you didn't speak. So, but let me just try to address something. Risk shifting, yes. I mean, it's a main element. Let me tell you that, with some person that's also on the table next to between you and me, we actually have this idea that maybe under some circumstances, decreasing monetary policy rates that not need to increase risk-taking. But let me tell you things that we did that seem suggestive but not fundamental of a risk-taking channel. We actually looked at different capitalization rates of banks. We see more capitalized versus low capitalized. We didn't see fundamental changes. We actually we didn't look exactly at what you're saying, and we're going to do it. I think it's a very good idea, it's originate to sell. But we looked at the difference between the whole sample and the only originate to hold, which, by definition, it should be something like that. We didn't see, out of the top of my head, that there was a big change, but we're going to focus on that. So awesome thing, we're going to look at that. Now, I think it's a very good idea to use branches. We looked at some point if there was a branch or not, but not so much at the free capacity, the number of branches. So maybe I think that's a very nice idea to do. Honesty first. The forbidden comparison, I'm going to look into it because I really don't know what that paper is about, so I'm not going to say anything more. I think your points are totally right, so let me go there. And finally, the county size, what we do look at, in order to try to see this comparison, we do look at, but you didn't have it, so it's unfair for you, but we did look at different income levels, income buckets, because that could be also, it's true that county size could be a main driver. We also think about income buckets. We didn't see a lot of difference in income buckets, but the fix for county is easy to do. We should do it. Let's do it, and that's it. And yeah, basically, and that's it.
Okay, so general questions from the audience. Xavier, I expected you to raise your hand, so this is rational expectations. Go ahead. There is a microphone coming. No, to the first row.
So on the issue of restaking, maybe you could look at delinquent mortgages or like non-performing loans, because and if there is a difference, means maybe restaking, no, if there is not, it's in favor of your channel.
Okay, let's, Vero, in the two rows behind.
Thank you. Very interesting paper. Just one question. Your paper talks a lot about local specialization in lending, and I wonder when we see banks that are locally specialized, should we think of them also specialized in their funding, specifically deposits? And if so, given that the counties might be different, those that, larger or smaller counties in terms of specialization, and the same goes for regional banks versus whether we think that maybe those demand shocks are probably correlated with mortgage demand, whether that would imply a problem. I know you have a lot of fixed effects there, but I don't know how it might.
It's a fair point.
Okay, any other question? Yes, Pedro.
Very interesting paper. Can you comment more on the effects of the positive versus negative of the changes in interest rates on possible asymmetric effects of how they react? Do we see the reversal? Or how do they?
Pedro, that was my question. Javier.
Very interesting paper. I was wondering what will be the non-specialization benchmark, and if you can develop the measure of a specialization based on the non-specialization benchmark. I think according to some sort of portfolio theory view, it will be like all banks will be lending to each county in proportion to the importance of mortgage lending of the county in total mortgage lending. Of course, we are very far from there. And once you are far from there, you will have banks with lots of zeros, not lending at all in any county. So, and I will not expect the increase from zero to be different from zero, except very exceptionally. So I wonder whether that is influencing the found coefficient, that you only grow in those counties where you already have. And this goes with the fixed cost story. Then you find that market share also matters. And my problem with this is that dynamically, what determines market share and what determines a specialization is the same choice. So, and if you, when you are specialized and the reference rate goes down, you increase lending. Somehow you are increasing your specialization, but maybe you are also increasing your market share. So I think that then extrapolating to what will be the general equilibrium implications of this is a bit tricky. You have this sort of non-homogeneity along a potential growth path, or at least for if you are in a period of decreasing interest rates over a long period, I will expect then a very different allocation of lending across counties resulting from this. And well, I don't know where it takes. I'm puzzled by the results. I think they are intriguing because I would like to see what is the structural model that is able to produce these results.
Okay, David,
yeah.
You have 3 minutes. Okay. Right, so, okay, let's, short question.
It will be very short, so thanks for the conference. So I was thinking, when you talk about the specialization, you're talking about the market share, as Javier said, more or less, but I was thinking about the specialization in different sectors as well. Because given that you've got data at county level, you might have like different specialization in sectors across counties. So in the example of LA, you said there you've got Silicon Valley, for instance, so I guess that banks are specialized in lending to financial sectors or maybe some startup, while in some other rural areas, the specialization might be in real estate, let's say. So that was my question, whether you can take that into account. That was all.
Thank you. Okay, David, you have to be fast and efficient.
Okay, that's difficult for me. Anyway, Xavier, yes, we can look at the liquid mortgage. I think it's a good idea. Let's go back to the risk-taking. Basically, the main thing is I think it's important, and I think Christian pointed out. One thing is if you want the micro risk-taking, like what happens with one given thing, and the other thing is the correlation. And I think that's something also that has to be taken into account. But yes, we should look into that. Veronica, yes, I think that indeed it could be due to different there could be a relation with different exposure at the funding level. That's what we try to capture, but maybe we're wrong with this assumption that basically banks are free to reallocate funds across a given, across their given markets. So then that should loosen that constraint. But indeed, there's some debate about how that can be done or not, and so that's what we do. Let me just leave it at that. Okay, because I don't have time to enter. Pedro, asymmetries. What I can tell you up to now is basically that we find that the effect is, I think, but I don't want to get into numbers, but much larger in monetary policy easings than in tightenings. But there's one important effect. In our data, easings have been much more disruptive because we don't have the latest increases. So there could be also an issue there about the time dimension that the data doesn't allow us to really tease out. So I want to be a bit careful about that. Okay, but I want to highlight that. Javier, long story short, yes, we do take into account entries, exits, zeros, all that. That seems not to be the driving effect, so that we control it. The other part, I would love to do it. I would like to have a structural model that is able to explain that. I don't have it as of now. I do disagree with that it's the same force what's driving a specialization that market share. Rafa is not going to allow me to implement this. It's true that it's the amount of lending, but it's not necessarily the same. And that's the simple example. Like you can specialize in one market, lend more there, but someone else can specialize much more than you. So that's decreasing your market share. But still, well, we talk too much. Yes, I would love to have the structural model. I don't have it, so let me just shut there. And Adrian, finally, industry-wise, that's what we try to control with the counterfeit effect. Our main argument is that there's not a big change from year to year in Silicon Valley's industry specialization. Because of that, we try to tease out with that counterfeit effect.
Great. So we are on time, so let's move to the second paper, which is going to be presented by, gosh, I'm sorry about this.
Spoilers.
Gosh. Well, you've seen it all now, I'm afraid. Okay, Matthew Naylor from the Bank of England. Here is the mouse, so you can point out, and then I'll move this so that it's...
I'll set my timer as well.
Is it all right, the mouse? Okay.
Okay, wonderful. So firstly, thanks again to the organisers for giving us the opportunity to present this paper. Titled Useful, Usable and Used, Buffer Usability During the COVID-19 Crisis. I'm Matthew Naylor, I work at the Bank of England. I'm also studying for a PhD at the University of Oxford, and this is joint work with colleagues Arkriti, Martha and Annie Rajan at the Bank of England, and the usual disclaimer applies. One thing to note is that Diana, I also thank you for discussing our paper in a bit. Diana has seen my two co-authors present this paper, so maybe she can give us notes on who presented it best as well. Okay, so in the wake of the financial crisis, the sweeping package of macroprudential reforms that were introduced by Basel III had an important component, which was the introduction of regulatory capital buffers. And the idea of these regulatory capital buffers is that they require banks to hold levels of capital above minimum requirements, which I show in turquoise here this is the UK capital stacks on risk-weighted and leverage frameworks. And the buffer capital is meant to be satisfied above minimum requirements and above MREL in orange. And we've highlighted these sections. And the idea of these buffers is that they're meant to be useful for increasing sort of bank resilience during stress, but crucially, they're also meant to be usable, and they're meant to allow banks to dip into these buffers in order to sustain lending and maintain credit provision to the economy during times of stress, i.e. they're meant to dampen possible credit crunches or pro-cyclical credit dynamics. Now, while all of these regulatory buffers are meant to be usable, some of them are also explicitly releasable, i.e. the counter-cyclical capital buffer, or the CCYB, as it's known. And the idea is that there is no regulatory consequence for dipping into that releasable buffer once it's been released. So the COVID-19 shock was the first sort of major test of these Basel III implemented regulatory capital buffers. And in the face of an exogenous shock to the financial sector with heightened uncertainty and risk of unexpected loan losses, we broadly saw, as Chair Powell said an hour ago, we broadly saw that the resilience of the financial sector remained pretty solid. However, a big question was whether the counter-cyclical objectives of the Basel III regulatory reforms were going to be satisfied. And a key question was whether these capital buffers would be used during stress. And the reason why this was such a key question was twofold. Firstly, if I can move the mouse. Firstly, anecdotally, prior to the onset of the crisis, regulatory and supervisory discussions with banks indicated potential reluctance, potential fear of market stigma from dipping into these regulatory buffers, supervisory reactions, or distribution restriction action. And secondly, more broadly, while evidence on tightening macroprudential policies was pretty extensive, the evidence on loosening is slightly more limited. And there have been far fewer episodes of loosening prudential policies. And in particular, this was the first test of the Basel III tools. So essentially in this paper, we try to answer two research questions. Firstly, did buffer usability frictions impact UK banks' capital, lending, and risk-taking behavior through the crisis? And secondly, are there benefits to having releasable buffers during stress? And the way in which we answer these questions is we adopt fairly similar approaches and use the same data sources in analysing changes in and UK banks' capital and lending profiles in order to answer questions on buffer usability based on their pre-pandemic surplus above regulatory capital buffers, splitting banks into low and high surplus banks, and for insights on releasability, or the effectiveness of releasing capital, we focus on the UK CCYB cut at the onset of COVID, and specifically we make use of the fact that UK CCYB cut fed through into capital relief to different extents for different banks. So some banks received greater capital relief from the cut in the CCYB, and we make use of that heterogeneity. And for spoilers, what we find is the following. Firstly, buffer usability frictions impacted bank behaviour during COVID-19. While all UK banks increased capital ratios, the relative increase was larger for low surplus banks. And as a result of that, or in order to defend their capital surpluses, low surplus banks maintained tighter lending terms and reduced their risk-taking capacity relative to peers. In potentially more positive news, releasing buffers can help, and they can help dampen these unintended consequences of buffer usability frictions, and they may be a necessary precondition for their usability. Specifically, banks that received greater capital relief from the CCYB cut maintained more stable capital ratios, and they used that extra capital space to loosen lending terms or provide more credit to the economy and take on more risk. In terms of the general literature in which this belongs, within the sort of effectiveness of, or literature looking at the effectiveness of macroprudential policies across the various tools, we focus on specifically capital requirements, and in relation to the various objectives, so across between financial system resilience and objectives of smoothing the credit cycle, we focus on the latter. And so in relation to the effect of capital requirements on credit cycle smoothing, there are sort of three strands of the literature that we can hone in on. Firstly is pre-Basel, where evidence of tightening requirements restricted credit supply and could soften procyclical credit dynamics. But despite evidence on loosening being more limited, the suggestion from some of the literature is that there are these asymmetric responses, that loosening is less effective than tightening. The second strand is post-Basel III reforms, but pre-COVID. During this episode of tightening, again, capital requirements have been found to restrict lending in the short run. And now we get to the literature that we contribute to, post-Basel III reforms and post-COVID, i.e. the first episode of loosening for Basel III reforms. And there has been work looking at similar questions. So on usability, there's work in the US and the EU finding similar results to ours, that there are usability frictions that impact bank behavior. And on releasability, similar results to ours again, which I guess is encouraging, and I'm going to spend the next 30 minutes or so trying to convince you that our paper is of particular value. So in terms of the contributions, well, firstly, we provide evidence on the effectiveness of loosening macroprudential tools, and in particular, this is the first test for Basel III capital regulation. And secondly, we focus on the UK, which allows us to do two things. Firstly, we're able to really precisely measure banks' surpluses above their buffer requirements. And we count for a whole host of other things that capital may be used for, to identify that using confidential regulatory data. The second is that we have, if the clicker works, the second is that we have within the UK an instance of a cut to a positive CCYB, an explicit cut, which is quite rare. That hasn't happened in many countries. And then third, our third main contribution is the following. We have a fantastic loan level mortgage data set. We have transaction level data on the universe of UK mortgages. And this allows us to zoom into a key segment of the household credit market that wasn't directly impacted by government guarantees in the same way that corporate lending was. But it also gives us extremely granular data on risk and or borrower risk characteristics, allowing us to strip out loan demand and borrower risk to really identify credit supply. Okay, so onto are regulatory buffers usable? So our approach, which I've touched upon, is we look at the pre-pandemic distance to regulatory buffers as an indication of the likelihood of a bank having to draw down on their buffers once an anticipated shock hits. And there's a few different ways in which you can calculate capital surpluses. The way we do it is we focus on effective CET1 surpluses. What do I mean by effective? Well, we take into account the CET1 that's used to meet other lower qualities of capital and also other requirements, so leverage and EVRA. And I'll show you in a minute why this is a major contribution of our work. So using quarterly confidential regulatory data on 159 UK banks, we're able to group banks into low surplus and high surplus banks. The low surplus banks are those with, we categorize or define as those with a 2% effective surplus above their capital buffer requirements or less, and high surplus banks have a greater than 2% surplus. We use different definitions for robustness, including sort of bottom quartile versus the rest, or continuous measures, and our results are pretty robust, very robust to all specifications. We drop the top quartile of our distribution because we find there's an extremely long tail, so for comparability reasons. So I mentioned that the effective surplus measure is a key contribution. This is why. Here we have the distribution of effective surplus the distribution of CET1 surpluses above buffer requirements for the effective measure, which is our contribution in red, and the simple measure in blue. We see that the effective measure is leftward shift to the simple surplus and is tighter, indicating that the simple surplus routinely overestimates the degree of headroom that a bank has to their buffer requirements. So, onto some trends. So here we have the unconditional evolution of surplus for low surplus banks in red and high surplus banks in green on the left-hand side in levels. We see that the evolution prior to the onset of COVID in 2020 Q1, their trends were relatively similar, and then post, also quite similar. Both groups of banks, on average, increased their capital surpluses by 1.5 percentage points over 2020. But then on the right-hand side, we index this to their pre-COVID value, and we see that in relative space, or in relative terms, this represents a greater relative increase for low surplus banks compared to high surplus banks. So in relative terms, they increased their surpluses by 100%. This is all unconditional, and so we test this in a different diff regression specification. So here we have as our dependent variable either capital surplus or log capital surplus for the growth rate of surplus, and we test the association with our independent variable of interest, which is this interaction term, low surplus times post-COVID. A bank is low surplus. If a bank is low surplus, then it receives a dummy of 1. If it's high surplus, 0, and 1 for post-COVID. And then we use our confidential regulatory data set to be able to account for or strip out, condition on, a whole host of bank balance sheet variables. So to capture sort of banks' business models, profitability, liquidity, provisioning, etc. And then we have bank and quarterly time fixed effects. And so the interpretation is, well, if the beta 1 coefficient is positive, we see that low surplus banks defended their capital surpluses by more post-COVID than peers. And this is exactly what we see in relative space. So while in column 1, there's no difference in levels, as we saw in the unconditional trends, in column 2, in relative terms, the increase was, or constituted, a greater relative defense of their capital surpluses. And so the question is, how did they defend their surpluses? Did they restrict lending in order to do so? So here's some data on pricing and product availability in the UK mortgage lending market. We see that there was a tightening of conditions in both. On the left-hand side in pricing, there was a particular increase in price for risky loans, so high LTV or LTI loans. And on the right-hand side, there was a decrease in product availability across the board, but in particular, again, for the riskier loans, for the high LTV loans. And so the question is, were there fundamental differences between low surplus and high surplus banks in the degree to which they sustain credit? And so we test this now using our, as I mentioned before, wonderful loan level data set on the universe of mortgages. So here we test the interest rate to capture price and loan value to capture quantity. On the left-hand side, for each individual I in postcode L from bank B, receiving a loan from bank B at time T. And now we have the same interaction term of interest, but now we're able to control, and the same or similar lagged bank controls, but now we're able to control for loan and borrower risk at the individual level. And we're also able to account for postcode time fixed effects and postcode bank fixed effects, which allows us to strip out sort of, variations in loan demand at the postcode level and across time, and also account for differences in bank presence. And by postcode, we mean 3-digit postcodes in the UK, which account for, which are similar to sort of US zip codes. So it's very granular. There's only 23,000 people within each postcode on average. And the interpretation of a positive gamma 1 for interest rates is that low surplus banks increased prices relative to high surplus banks and reduced loan values. And this is what we see. We see that low surplus banks maintained higher interest rates post-COVID by 3.7% and maintained lower loan values after the onset of the pandemic. And taken together, that points to buffer usability frictions. Low surplus banks defended their capital surpluses by more, and they restricted lending as a result. So on the CCYB, on the releasable buffers, we use a similar definition. We make use of the fact that although the CCYB cut was the same for all banks, it fed through into a reduction in capital requirements to different degrees. And we refer to a high pass-through rate bank as a bank that received greater capital relief and a low pass-through rate bank who received higher, so less than 50%, greater than 50%. And this depends on the degree to which credit exposures are based in the UK. That's how it works. And again, we for robustness, we check this against the definitions and it holds. So here we see really interesting dynamics. We see that banks that received greater capital relief maintained more stable capital surpluses. And this strips out the mechanical reduction in the CCYBs. This is just behavioral. Whilst low pass-through rate banks defended capital surpluses. So then the question is, did they use this extra space in capital surpluses to maintain greater lending? Well, firstly, we see that this is statistically significant in our regressions. They maintained lower CET1 surpluses. And then we ask, did they use the space to sustain lending? And the answer is yes. High pass-through rate banks maintained lower interest rates by 3.7% and higher loan value. So being a high pass-through rate bank partially offsets the impact of buffer usability frictions on deleveraging. Then finally, we look at risk-taking. And we define risk-taking in a few different ways, which I'll get onto in a moment, but essentially we augment our baseline specification to have a triple interaction. So now we look at the impact of being a low surplus bank post-COVID relative to a high surplus bank on the degree or on the pricing or quantities that you offer on a loan that's considered risky versus not risky. So if you increase interest rates on a risky loan relative to a non-risky loan compared to high surplus banks, that's evidence of curtailing of risk. And so we measure this in two ways. The first is COVID specific. So we look at, we define high case rate areas at the regional level as reflecting high risk borrowers. And to motivate this, there's a few high case rates are correlated with restrictions, pandemic restrictions, and have also been identified as also being associated with high default probabilities. And this chart is quite neat. We show the change in volume of mortgages by low surplus banks on the left-hand side and high surplus banks on the right-hand side in high case rate areas. So in the riskiest areas, how did volume of mortgages change? And we see on the left-hand side, low surplus banks decreased lending by more. It's darker red. So then we put this to the test in our regressions, and we see that in high case rate areas, low surplus banks reduced loan values. The pricing wasn't statistically different, and the high CCYB pass-through rate banks reduced prices and increased loan values. So again, they're acting in opposite directions. There's a buffer usability friction, releasability is helping. We also define risky loan more conventionally by sort of high LTV, high LTI, and zooming in on first-time buyers. And here we see again the same thing. Low surplus banks increased prices, reduced quantities to these risky loans, and high CCYB banks did the opposite. Again, buffer usability frictions, releasability, alleviating those frictions. So in terms of our conclusions, this is what we said before. All UK banks increased capital ratios, but this relative increase was greater for low surplus banks. Low surplus banks, as a result, maintained tighter lending terms and exhibited higher risk aversion, whereas in contrast, releasability may be a necessary precondition for usability. Banks that receive greater capital relief in the CCYB cut were able to maintain more stable capital ratios, provide greater credit, and take on more risk. Policy implications are fairly clear, but they essentially highlight potential unintended consequences of the Basel III reforms. And this is particularly striking in the face of the widespread financial, fiscal support, monetary support that was provided during the crisis. But in better news, or in more positive news, they also support releasability of regulatory capitals as a mean of dampening these unintended consequences. And I'll leave you with that. Thank you very much.
Okay, thank you very much. Okay, so here we are. Okay, so the discussion is going to be Diana Bonfim, and let me pass the mouse. Sorry, I moved this. Okay, there you are, 10 minutes.
So thank you so much for the invitation to discuss this paper. These are going to be my views, not those of the Bank of Portugal, nor the ECB. And so the paper plays with these three words: usable, used, and useful. So the questions are, I mean, if capital buffers introduced in Basel III are usable. Second, if they were actually used, and I think it's a combination of the two that actually makes them useful. So let's first think about the usable part. So Basel III introduced these different capital ratios that Matthew explained to us in the beginning and are familiar to most, to mitigate something that was well identified in Basel II by Rafa and Javier in the room and other authors, that showed that Basel II could be highly procyclical and regulation could even exacerbate the natural procyclical behavior of banks. But the question that was always around these new buffers introduced by Basel III was, to what extent are they usable? Okay? And there are several good reasons to believe they might not be usable, especially if we think that during a crisis, during a recession, banks might want to hold on to the capital ratios that they have. And second, I mean, we also want to understand if banks actually use these. And so COVID is the first, as Matthew told us, was perhaps the first opportunity worldwide to see, to understand empirically how banks were making use of these buffers, okay? And this is especially true for when you think about the CCYB, the countercyclical capital buffer, which is precisely designed to be released in situations such as the one we experienced in early 2020, okay? With the goal of avoiding a credit crunch and making sure that banks can draw down explicitly on these buffers to be able to continue to lend to a distressed economy. And so I think the idea that the authors want to convey with this paper is that for buffers to be useful, they need to be usable and they need to be used or released. And so what you do in the paper is to use COVID-19 as an episode to test the use and the release of capital buffers in the UK. And so there's two main questions in the paper. First, did banks make use of the capital buffers, or did they try to just remain well capitalized or even to further increase their capital ratios? And second, did banks make use of the capital buffers to actually lend during a crisis and support the economy and avoid this credit crunch scenario? And so the main findings are that the banks that had less capital surplus before the pandemic, they actually made an effort to improve their capital ratios. So in a way, they acted procyclically. They offered loans with higher loan rates, they offered lower loan amounts, and they offered tighter terms in riskier lending, okay? On a more positive note, banks that had the greater capital relief coming from the release of the countercyclical capital buffer, well, in this case, at least the banks did not act procyclically. Maybe they didn't act countercyclical either, but at least they didn't reinforce the cycle. So I think the paper really is a very thorough analysis of everything that happened in the UK. I mean, the authors really try to make the best use possible of the amazing data that they have and look into this through different angles, and they try to be very careful with empirical strategy, and I think the paper offers really very important policy implications. So overall, I have an incredibly positive view of the paper, but I have three questions that I'd like to discuss. So first, about how the banks adjusted overall. Second, about empirical design and the specificities of the setting related to the pandemic. And third, on more general terms, about the role of countercyclical regulation. Okay, so about the bank's adjustment. Okay, this is a low-quality picture of how a simple balance sheet of a bank looks like. And in the paper, the authors focus mainly on two items. Okay, they focus here on the role of bank equity and how banks adjust equity in the aftermath of the pandemic, depending on how well capitalized they were, and also on the pass-through of the release of the countercyclical buffer. And they also look here into this mortgage part. Okay, so they have amazing and quite unique data on mortgages. And so the first part of the paper is anchored on equity, and the second one on the mortgages. But of course, there's much more things going on, right? And of course, I would be curious to also understand what were the other margins of adjustment of the banks during this period. Of course, we cannot do this in such a causal, well-identified setting, but at least to have some descriptive overview on what happened to corporate loans, to security holdings, to the funding structure of the banks. Of course, we have monetary policy at work here. We have many other shocks happening at the same time. And I think it would be interesting to at least provide some broad description of this. And this is especially for one reason. So my question here is, how important are the mortgages in shaping the adjustment? So mortgages are perhaps one of the assets that the banks have with lower risk weights. And so if the banks are indeed, as shown in the paper, trying to improve or at least stabilize their capital ratios, well, mortgages are not the more efficient way to do that. Okay, these are already asset categories with very low risk weights. And so I wonder if this means that the results displayed here in the paper are somehow a lower bound for the effects, because maybe we could expect that the adjustments for corporate loans, for instance, where risk weights are much higher, could be much sharper. And of course, this also interacts with the question about, how other support measures affect the banks. So there's some effort in the paper to deal with this, but I think it could also help us to think about all these interactions. So on my second set of comments about COVID and empirical design, of course, an easy question to ask is if COVID is the ideal setting to test the role of buffers. I think we will never have an ideal setting to test it, so I think this is a very useful exercise to do. That said, I think one challenge that the authors acknowledge is that it's not easy to control for mortgage demand. So in the corporate loan literature, this type of analysis is typically done by looking into a firm that borrows from at least two banks at the same time, and we're going to compare how what the two banks are offering to the same firm is varying. Of course, no one gets two mortgages at the same time from two different banks. And so here what the authors try to do is, what they claim in the paper is they say we're going to test whether a new loan issued to a borrower I in local area L by Bank B in quarter T was priced differently after the onset of the pandemic by two different banks, depending on their surplus of capital and depending on the pass-through of CCYB. I think this deserves a more thorough explanation in the paper. Okay, I think this is not entirely clear. There's also controls for borrower characteristics here. They're also changing, and their importance is also changing during the pandemic. So I think that being clearer and more detailed about what is going on here and how is this effect identified, I think it would be very important. Still on this item, I think that there's a final part in the paper that Matthew showed us where the authors look into the heterogeneity across the UK in the number of cases and local restrictions. I think it would be interesting to see how important these really were in terms of lending decisions. I think showing some supporting evidence would be interesting, because the effect is captured mostly by these triple interactions. So it's really not easy to understand what are the mechanisms at work. So I think here in the slides it was, you focused more on the results where there's only one of the buffers working at each time, and those are also in the paper. But then most of the tables in the paper are using the two buffers at the same time. And I think there's for sure correlation issues that might somehow cloud the interpretation of the results. So I think it would be interesting to look into this as well. Very minor point. Why is the reference period 2009 Q1? I think it would be much more to the point to use the first pandemic quarter. And so let me just conclude with the last comment, which is more policy oriented in a way. So Basel II was recognized as being perhaps too pro-cyclical, and I think we have to talk about counter-cyclical regulation. I think a lot of what we know and think about counter-cyclical regulation actually was designed here in this building when dynamic provisions were set up a few decades ago. And the results of the paper suggest that at best the buffers can mitigate pro-cyclicality, not really act counter-cyclical. And I think this is very valuable, and I think the paper could also gain from providing more descriptive insights. For instance, I could not understand if any bank actually used the buffers, if they really went down. I believe not, but it would be interesting to show and discuss that. And then on the policy, I think, there's a few interesting aspects to explore. For instance, as far as I know, the Bank of England had a strategy of keeping the CCYB structurally above zero permanently. I hope I'm not wrong on that. But I wonder if the results show that this is somehow important. And one thing that you could perhaps do would be to look into internationally active banks that are not subject to this buffer in the same way, and see if there's something coming out of this, because I think this would be a really important policy implication for the design of the buffers. Another thing I found very interesting that you mentioned somewhere in a footnote is that the Bank of England at the beginning of the pandemic carried out stress tests showing the banks that they would be better off if they continued to lend to the economy instead of just cutting lending overall. And I wonder if this pedagogical approach somehow encouraged the banks to lend. And so by looking into banks that were exposed or not to these stress tests, I think we could also learn a lot. I think we could also learn from this paper about synergies and conflicts between micro and macroprudential policies. And with this, I will conclude and just recommend you to read this paper, both from an academic perspective and a policy perspective. I think there's a lot of content here, and I wish the best of luck to the authors to publish this paper well. Thank you.
Okay, thank you, Diana. Let's, Matthew, quick response to the comments, and then we'll open the floor.
So firstly, thank you very much. That's extremely helpful comments. So just coming back on a few things. So you mentioned that we're focusing on mortgage lending data and not corporate data. The truth is that we'd love to also look at corporate, but we don't in the UK have the same transaction level data set for corporate as we do for mortgage. You then mentioned that mortgage lending typically is associated with lower risk weights, and so isn't as efficient for banks to sort of change behavior on if they're trying to increase their or defend their capital, but which, as you say, I think probably makes our results even more striking. If we're finding this result for mortgage lending, then yes, the suggestion is that it's potentially or likely to be even stronger for corporate. So it might well be a lower bound, which I think speaks to how striking our results are, despite, again, all of the sort of government and financial fiscal support. But I take that point. We wish we could, but we don't. Then there was a question about controlling the loan demand and borrower risk characteristics, etc. So yeah, I take your point that we maybe need to explain this a bit better in the paper. In fact, when I was editing these slides, I kind of had the same thought. We think that our identification strategy is pretty robust because of this loan level data. So we're able to have postcode time fixed effects, which essentially strip out unobserved changes at the postcode level. So per 23,000 people on average over time. And we're able to couple that with individual level characteristics for borrowers. So we have data on LTV, LTI, whether they had income verification, whether they're self-employed, first-time buyers, etc. And so essentially we're able to compare the change pre to post-COVID for low surplus versus high surplus banks on essentially the same borrowing, stripping out all of these effects. But you're right, we need to maybe explain that a bit better. Then there were some other points about having low surplus and so the usable and releasable in the same regressions. We do try them in separate regressions. We get the same results. We have them in the same regression just to be able to demonstrate them a bit more succinctly, but it's a good point. Did any banks actually use buffers? No. That's the simple answer. No, they didn't. And that's why we focus on the surplus above their buffer requirements, because we don't, as a proxy for frictions. We can't look at, because they didn't. Yeah, that's a good point. Thank you so much.
Okay, so let's open the floor. Let's start now with Anatoly at the back.
Matthew, very interesting presentation. Speak up. So the question, in the euro area, supervisory authorities also responded to the COVID shock by encouraging banks to use the capital conservation buffer, which is a more, not formally releasable, more structural buffer, and they kind of try to reassure banks that if they were to use that buffer, supervisory interventions would have not been triggered immediately. So my question is whether or not you can use the similar approach of heterogeneous pass-through of capital conservation buffer release, quote unquote, to ask yourselves the same questions, and was that useful at all, and more useful than the release of properly releasable capital buffer? Thank you.
Javier.
Okay, thank you for the presentation. I see your paper, perhaps with a little bit of distance, as a paper on maybe, or with the underlying question of why banks have voluntary buffers, what they want the voluntary buffers for. And I can imagine two stories. In one story, banks want the buffers to better absorb unexpected losses, no? Above and beyond what the requirements will give them in terms of loss absorption. Now, in that type of case, I would expect the banks with the high buffers to be the ones that don't want to use the buffers in bad times, in the sense of giving more lending out of them, because they were holding the buffers as a precaution against potentially larger unexpected losses. In another view of the world, which is maybe more consistent with things that I have done with Rafa, those buffers are there to protect your lending opportunity. So I would expect the banks with the higher voluntary buffers ex ante to be those who have better lending opportunities to protect, higher on average in terms of profitability in bad times. The banks with the low buffers will be the ones that don't expect to have very profitable opportunities in bad times, and they don't want to protect their lending in bad times. Then, if you find that when the bad times materialize, the banks with the low buffers decide to expand their lending less, this is perfectly consistent with the second view, and less perfectly consistent with the first view, right? So I will tend to read the results more in this sense, that in sense of what is usable versus use, and I'm not sure I saw the regulatory natural experiment here, because at the same time there was release of a part of the buffers. There was also dividend restrictions, which make very hard to interpret what is going on with the voluntary buffers after COVID, because these are not voluntary anymore. The voluntary buffers after the event are the result of the imposition of constraints on payouts. So the banks that don't want to have buffers probably wanted to have high dividends, and when the dividends is cut, basically keep the buffer high for distributing after the pandemic. Sorry, because I'm not sure this is a question. This is sort of giving background to your results. Thank you.
Okay. Is there any other question? Okay, Matthew, the floor is yours.
So on the euro area equivalent, so there's a paper by Kouaye who tried to, and co-authors who tried to essentially ask the same question on impact of releasability based on that policy in the euro. They don't have a positive CCYB, but that's exactly how they tried to relieve capital. And they find pretty similar results to ours, in that had a positive effect on banks' capital behavior and also their lending. In terms of the implications for us, I mean, in the UK or other jurisdictions on sort of capital conservation, I think the Financial Policy Committee at the onset of COVID released a statement trying to encourage banks to dip into their regulatory buffers. So that includes the capital conservation. They didn't distinguish between capital conservation and systemic risk, but they released a communication to try to encourage that behavior. And yet, no one did, and we're trying to identify whether they did. They didn't because of potential frictions. So in terms of what we can take away from the euro area experience is that it could have an effect if there's no CCYB, but it didn't in the UK context. Javier, I think you make very good points. I think in terms of the interesting question is, pre-pandemic, what leads to banks having the surpluses that they do? And so i.e. what's their risk aversion or what's their ideal management buffer over buffer requirements? And why would they have it? Is it because they think that the buffer requirements don't actually give them enough capital to be able to absorb the shock? Or is it for other reasons? Is it because in the event of a shock, do they not believe that they would be able to raise capital, which is also different for different types of banks? Essentially, we try to strip out we don't try to draw insights onto that. We try to strip it all out where possible through bank time fixed effects or bank level controls to try to really to try to strip out any variation that isn't just fundamentally where you started before the pandemic in terms of your capital surpluses. So we don't draw insights into what drives that initial decision, but we try to strip out to the extent that that's associated with other bank characteristics or observed variables through the bank time fixed effects. We try to strip out. So I don't have necessarily a response for you. I know that there's other work that tries to identify where the buffer usability frictions may be coming in specifically. My co-author Arkwiti and Annie have a separate paper which look into that, and they seem to find that it is the distribution restrictions that generate this friction. So insofar as I can lean on their research to give you some sort of indication as to what might be causing it. Yeah. But in our paper we just try to identify an issue without necessarily generating or looking into what's driving that specifically.
Okay, so thank you, Matthew. So we move to the last paper of this session, Martina Yasova, Glossy Greenbacks.
Perfect. So thank you very much for including our paper in the program of the conference. This is a joint work with Maria Assunta Gianetti, Maria Lomiotti, and Caterina Mendicino. And as Caterina is with the ECB, the usual disclaimer applies. These are our views and not necessarily the views of the ECB or the Eurosystem. All right. So many banks these days celebrate themselves as the pioneers in embracing and engaging in environmentally themed activities. And following the global trend of rising voluntary disclosures, banks are joining this pattern, and they are increasingly emphasizing their environmental activities also in their disclosures and annual reports towards their investors. Now, the literature has generally showed that these types of disclosures tend to be associated with a number of benefits. For example, more loyal customer base, a higher ESG rating, or lower cost of capital. However, there is some skepticism, both by the policymakers as well as the market participants. And this skepticism is essentially asking whether these environmentally themed disclosures proposed by banks are actually credible, or whether they primarily just contain unsubstantiated claims where banks are selectively reporting on certain activities and trying to just symbolically comply with these new institutional roles. And so in this paper, we try to study this question in detail. And specifically, we ask, what is the relationship between the bank environmental disclosures and their actual bank lending activities? And the way we answer this question is in two steps. So in the first step, we use the annual reports and sustainability reports of a large set of European banks to analyze their environmental disclosures. And in the second step, we link these disclosures to bank lending to firms. And specifically, we look into a couple of heterogeneities. We look into differences in lending to firms in brown versus green industries, to firms specifically based on their firm level emissions, so to borrowers who actually have higher level of greenhouse gas emissions. And then finally, we use the information of borrowers that describe their businesses as green based on the EU taxonomy. So the main finding of the paper are as follows. So on the first part, we showed that the environmental disclosures of European banks are generally positively associated with the higher environmental risk of the country where the bank is localized, a higher social activism in that country, a stronger regulation, as well as higher bank ESG rating. At the same time, we show that banks that have higher level of these environmental disclosures actually are more involved in the issuance of green bonds. Now, the key focus of our paper, however, is on lending, and we find a couple of things. The first thing we find is that banks that talk more about the environment actually end up lending more to high-emission borrowers rather than the other way around. Interestingly, we don't find any evidence that these loans would be funding the transition of these firms towards greener technologies. And finally, we show that banks that are engaged in these activities the most tend to be lowly capitalized, and specifically they lend to the weakest borrowers in these brown industries. So overall, in the paper, we document this disconnect as to what banks say and what banks do, and we show that banks tend to overemphasize their climate goals and then continue the relationship with their polluting borrowers. So, few words about the data and methodology. So on the data side, the paper makes use of the granular loan level credit registry, which is the ANA credit. Many of you are probably familiar with the data. So it's the harmonized loan level data of all Eurozone commercial loans outstanding. We're going to focus on information on loan size, interest, and maturity. And one most important thing that I'd like to emphasize here is that unlike bond issuance or syndicated lending, this information is generally confidential. So market participants, investors don't really know what's in the loan book of the banks. So it's kind of a hidden part of the bank assets. And we're going to use this information for the newly issued loans for the period of 2014 to 2020, which is going to give us a sample of roughly 553 banks and bank subsidiaries across Europe. Now, as I mentioned, I will focus on a lending to green versus brown firms or brown industries, and we're going to do it in 2 steps. In the first set of results that I'm going to present, I'm going to focus on the industry level heterogeneity, which is going to come from Eurostat. And we're going to use the greenhouse gas emission data by the country, NACE to industry level and year. And this is going to be standardized by the industry value added. And then for the subset of these firms, I'm going to have firm level emission data, which are coming from the Urgentem. And we're going to use a firm level scope 1 and scope 2 emission intensities. And then finally, we're just complement this with regular data on firms and banks. All right. So the first step that I want to talk a little bit more about are the environmental disclosures. So if you were to write a paper like this in the US, it would be much more trivial because you could go to Edgar, download all of the annual reports at the same spot and, you know, kind of process the information. In Europe, we have to visit each and every website of our banks, manually download this information, hope that it's published in English, and try to make sense of it. And this is going to give us a sample of roughly 1,400 documents that are going to contain, you know, a bunch of information. Approximately half of it are coming from annual reports, and the second half is a range of reports, whether it's sustainability, integrated reporting, non-financial reports, and so on. So we start reading this. After approximately 50 of these reports, we start building our dictionary. So we start with this because, you know, banks can be talking about an environment maybe differently than we know how non-financial companies talk about environment. So we start building out our dictionary by reading these annual reports and other statements. And then we complement it with additional topics that are either coming from the rep risk or the SASB. So this is going to give us a dictionary of words and bigrams that are related to topics such as energy use, emissions, biodiversity, or activities are commonly attributable to affect pollution. So our key measure of environmental disclosure is going to be the ratio of words that are these environmental keywords as a share of total number of words in the statement, excluding the stop words. So before I jump into the loan level analysis, let me show you some validation. So I know that this table is a little bit overwhelming, but I'm going to quickly guide you through it. In the column 1, what you can see is that the environmental disclosures tend to be correlated with the activism of that specific country. So meaning that the inhabitants in that country are more likely to, you know, join the protest or, you know, sign a petition if they learn about a company, you know, violating certain environmental standards. We also see that there is a higher environmental risk of that specific country. Secondly, we see that environmental disclosures go hand in hand with other reporting, such as GRI standards or integrated reporting. I'm going to come back more to the bank characteristics a little bit later on. What you can see next is that indeed also in case of banks, those that report more on environment tend to benefit from higher environmental ratings. And it doesn't really matter whether you use the information from MSCI, Bloomberg, Sustainalytics. And then finally, we see that banks that talk a lot about environment also tend to be more active in the issuance of green bonds. However, the main point of our paper is to look into the impact on lending. So before I jump into the loan level evidence, let me show you some bin scatter plot. On the x-axis, you see the share of the loans that are brown, going to brown industry. So this is the brown exposure of a bank. And on the y-axis, you see these environmental disclosures. And surprisingly, what you see here is there's a positive relationship. So there seems to be some disconnect, that banks that talk more about environment actually end up lending more to these brown sectors. So what we're going to do next is that we're going to examine this question more formally. And we're going to run the following set of regressions. I'm going to start by looking into, on the left-hand side, the log amount of credit that a bank B grants to firm F in year T. And this firm is going to be located in industry I in country C. My key coefficient of interest is the one highlighted in orange, and it's an interaction coefficient as to whether the industry is brown, and an interaction with the environmental reporter. So the industry here is denoted as brown if the greenhouse gas emission of this specific industry in that country, in that year, ranks in the top quintile of our entire distribution. And the higher environmental reporter is a dummy that takes a value of 1 if the bank is, in terms of their disclosure, again in the top quintile. We present a bunch of robustness in the paper using continuous measures, and I'm going to talk more about firm level emissions later on. Importantly, we control for a couple of important things. Specifically, in order to control for the demand for credit, we introduce the fixed effects in this specification. We either start with the industry country time fixed effects, or then we move to a more standard Kwajamian style fixed effect. So it's the firm time. So we observe the lending of the same polluting firm receiving credit from 2 different banks. One of them ends up talking a lot about the environment, the other does not. Furthermore, we control for bank characteristics either with the combination of bank fixed effects and additional time-varying controls, or with the time-varying bank fixed effects. So if these banks that actually talk a lot about the environment should be scaling away from lending to the brown industries, we should expect this coefficient beta 1 to be negative. So let's look into this. So as you can see, it's not negative, and in 2 out of these 3 specifications, even statistically significant. So these are the cases with the first set of fixed effects, and then when I fast forward to the Kwajamian style fixed effects, you see that this positive and statistically significant prevails. So there seems to be this disconnect of where banks are actually lending. And now you might think that maybe these high environmental reporting banks are lending a lot to the very brown industries, but maybe they are trying to offset it by also lending a lot to a very green industries. So I'm going to replace the heterogeneity here and look into whether they're lending to the least greenhouse gas emitting industries. And you don't find really much here. There seems to be the same pattern of banks that talk about environment and those that don't. So these coefficients are not statistically significant. Now, we can repeat the exercise by actually really using the firm level greenhouse gas emissions. So the benefit of this is that we can move to a more granular measure, but the cost is obviously that we're losing a lot of firms for which we don't have reported firm level greenhouse gas emission intensities. Regardless, what you can see here is that the results are very robust. So they are positive and statistically significant when we control for the demand of credit with the interaction of industry, country, and time fixed effects. Now, as we move to the firm time fixed effects, the positive, the statistical power disappears, but the results still remain positive. And if anything, it shows us that there's no difference in lending coming from a bank that talks a lot about environment and the bank that doesn't seem to pay so much attention to these environmentally themed topics. So in other words, there seems to be this disconnect into what banks say and what banks do on the intensive margin. Now, until now, I presented the results using the granting of all kinds of new loans. Let's shift gears and focus on the establishment of the new relationship between a bank and a new firm. And what we can see here is that there is a silver lining, at least in 2 out of the 5 specifications, that suggests that high environmental reporters at least try to reduce new lending exposure to brown industries. However, when we shift attention to the termination of the relationship, we once again see that these high environmental reporters are reluctant to terminate their relationship with brown industries. So overall, again, there seems to be this disconnect between the environmental statements and the actual bank loan book. So the big question is why? And in the paper, we explore a couple of channels. The first channel you might think about is that this doesn't necessarily need to mean greenwashing, because what this can be is that the banks are actually funding the transition of these brown industries towards more carbon neutral. So in a sense, this can be associated with a bunch of benefits still. So in order to test this really carefully, in an ideal experiment, you would want to have the greenhouse gas emission of these firms over a very long time period and like to see whether these emissions are going down. So we try this for our limited period. We don't find much, but again, this could be driven by simply the fact that we are observing 6 years of data. So in response to that, we develop a couple of approaches that can help us tackle this question a little bit better. The first approach relies on the fact that funding transition is costly, and firms that tend to transit towards greener technologies might be more involved in high investment or research and development. So in other words, what we can do, we can compare the lending of the high environmental reporters to two firms in the same brown industry and see whether they're funding more the firm in the same brown industry that has more R&D or that has more investment. The second idea rests on the fact that it tends to be the new entrants that are the disruptors. So, in other words, if you think about who is more likely to adopt greener technologies, who is going to innovate and disrupt these old brown technologies, this should be younger firms. So again, we can look into the cross-section of these firms and compare whether young firms receive more credit than brown firms in the same industry by these high environmental reporters. The third test that we're going to implement rests on the fact that firms can actually make science-based commitments to reduce their greenhouse gas emissions. So there's an SBTi data set that puts together science-based credible targets that the firms set for themselves into trying to get to a more carbon neutral ways. So again, we can compare two firms. One of them is an SBTi signatory, the other is not, and we can see whether there is some reallocation of credit. And finally, we use the capital IQ to present yet additional textual analysis where we compare the business description of the two firms. So you can imagine two firms in the textile industry. One is doing more of a fabric upcycling. The other one is more into fast fashion. And again, we can compare whether there is a disproportionate lending going towards a greener descriptive firm. So for today, I'm going to show you the results for the first three. And the results are here in this table. So in columns 1 to 4, you see the proxy for the first channel, so either a triple interaction with the R&D or investment. Column 5 and 6 are showing you the interaction, whether the brown firm is young or not. And the final two columns are showing you whether the firm is or is not the SBTi signatory. Across the sample, you don't really see much. The results are either statistically insignificant or they're actually going the wrong direction. So overall, we don't find any evidence that these high environmental reporters are actually trying to fund the transition towards greener technologies. Now, in the paper, we further look into additional margins. So as I already mentioned, we don't really see that these banks would be scaling down the amount of credit, but there can be potentially affecting other loan contractual firms. So in the result right here, you see the results when we focus on the interest rates. And the idea here is that maybe they're charging them higher interest rates on these loans. And you don't see that that's not what's going on. Again, the results are statistically insignificant, and if anything, they're potentially even going the wrong direction. The other potential contractual margin is the maturity. So you might be thinking that these banks are forcing these polluting firms to shorter maturity loans, so to face higher rollover risk as the time develops. Again, not much to see there. One of the coefficients, the one in column 3, is actually again going the other direction, but overall we can say that the contractual terms doesn't seem to differ when you think about the bank that pays a lot of attention to the environment versus the one that doesn't. So the final result I want to leave you with is looking into the role of relationship lending. In the column 1 and 2, we're proxying for relationship lending with the exposure, where exposure is essentially the share of the credit I as a firm get from bank 1 as a share of my total bank credit. And what you can see here is that high environmental reporters especially lend more to brown borrowers if they have already extended them a large share of credit in past. So they have a strong relationship with these firms, and they might be reluctant to discontinue such relationship. Now, in light of this result, we'll look deeper into a potential channel that can be related to this opacity, specifically to the zombie lending. There's a lot of literature, especially in Europe, showing that undercapitalized banks might be more likely to lend to unprofitable borrowers. So we proxy for this low profitability or low health of the borrowers with 3 different measures that are standard in the literature. Whether the firm has low or negative ROA, a low sales to employee ratio, or low interest coverage ratio. And you can see the triple interaction coefficient highlighted in orange. And out of the 6 specifications here, 4 are positive and statistically significant, suggesting that these discrepancies between the actual lending behavior and the bank environmental descriptions are actually more pronounced for lending to firms that are of poor health. And linking this to the zombie lending, there's essentially an additional layer on the zombie lending. So what you normally know in the literature is that banks might be reluctant to terminate the zombie lending because this would force them to recognize credit losses. Now, recall when I started talking about the ANA-credit, I told you that this is a confidential data set that we cannot really observe as market participants or investors. So we don't really see what banks are doing in their loan books. We just trust what the banks say in their disclosure. So by actually recognizing those credit losses, if worse comes to worse, the bank would not only need to talk about the credit losses, but they would also need to discuss and explain their exposure to these brown industries. So in other words, the banks might have another layer of the reluctancy to terminate the relationship with these types of unhealthy zombie firms. And finally, moving to the bank level heterogeneity, I'm going to start with looking into the heterogeneity based on the capitalization of the bank. And what you can see here is that the high environmentally reporting banks are more likely to lend to brown industries, especially if they are lowly capitalized. And again, this brings me back to this zombie lending channel, because we know from the existing literature that undercapitalized banks have particularly strong incentive to hide their losses and continue lending to these unprofitable firms. Secondly, we also see that this relationship is the strongest for large banks, which can be related to the fact that large banks in particular face more institutional pressures to integrate climate goals in their strategy, and as a result they may overemphasize their stewardship to their investors about this green lending. So in other words, we see that this credibility can be very hardly observable to market participants. In terms of hard observability of this lending, you can see in columns 3 to 5 additional heterogeneities as to whether the bank is using mandatory sustainability reporting, whether there's any change post-Paris Agreement, and whether these sustainability reports are third-party audited. And you don't really see much in any of the free proxies, which again is to suggest that these environmental disclosures are very hard to compare and standardize, and the result, they cannot be easily regulated or verified by the external auditors. So to sum up, in this paper we show that banks that stress environment more in their disclosures actually end up lending more to high-emission borrowers. We don't find any effect that this should be helping the transition towards greener technologies, and instead we document that the close relationship between banks and firms matters, and specifically the lending towards zombie firms tend to hinder the transition of the banks towards more responsible green lending. Thank you.
Okay, well, thank you very much. Okay, and the discussant is Ortega from the Bank of Spain.
Thank you very much for having me here discussing this fantastic paper. While reading it, it was a pleasure to read, by the way, very well written. And while reading it, I was like, I think, raising my eyebrows as I could see in the public while she was going through more and more results and robustness analysis on the results. So I wanted first to congratulate the authors. It's really well written and easy to read. I find it's a very necessary paper to put some evidence and numbers into the greenwashing debates, and also into the value of the actual information reported by banks and how much they are valuable to infer their lending policies. In a nutshell, it explores whether the Euro area banks claim, whether the bank's claims of sustainability performance are reflected in actual greener lending policies, or if just they aim to greenwash their loan portfolios by selectively disclosing positive environmental information of their activities. It's actually a very well thought and carefully conducted contribution. Basically, all the robustness analysis extra that came to my mind were actually done in footnotes or appendixes. And my main point is this paper leaves somewhat worried. The central banker, maybe naively, believes that there's a key role for the financial sector in actually guiding the green transition through financing green investments. So let me a bit zoom out and come back to what was the main ideas of this, the role of the financial sector in guiding the green transition. I'll use 2 slides on that, and then I'll go into commenting some of the results. So the first one is obviously the green transition is basically in the hands of governments, of course. These are the ones who have the main policies. They can increase taxation, help the vulnerable sectors of the society, set the standards, provide agents with certainty, a stable environment. But the financial sector is actually a key player. Actually, this chart is from a special chapter that we published last year in our annual report of Banco de España on the impact of climate change into the Spanish economy. So the financial sector has this key role of efficiently channeling the enormous amount of investments that are needed to actually conduct the green transition, but they have not only to channel these funds, but also to do so while assessing the risks and the exposure of the agents and themselves to climate risks. Of course, central banks have a role here, and that's why this paper is important here. Not only we've been incorporating climate considerations in the monetary policy operation framework, but more importantly, we have the role to monitor the risk of the financial stability posed by climate change and in the green transition, and to enhance the regulation and the prudential supervision. But all this green transition and the workings of these three key actors happen in a context of huge uncertainty, a need of international coordination. But the third point, the third dark blue box here, it happens in a context in which it's essential to increase the quantity, quality, and harmonization of environmental information, and that's where this paper appears here. If we want to dig a bit into a general picture of the loan, say the carbon footprint of the loans extended by credit institutions, here you have on the left-hand side the chart for Spain. So the brown line is the total greenhouse gas emissions in the Spanish economy per unit of output, so the carbon footprint of carbon intensity of the whole Spanish economy. Since 2008, of course, it has a downward trend. And in blue, you have the calculation of the carbon intensity of the loans extended by the Spanish financial institutions. So actually, so this is taking the emissions per industry and then weighting them according to the weight of the industry in the total loan portfolio of the Spanish institutions year by year. So you can see the blue line lies above the economy, so maybe the carbon footprint of the loan portfolio in Spain is higher than the overall Spanish economy, but it has fallen significantly, especially since the Paris Agreement. So does it mean that the loans are getting greener? No. So there's some shifting into more green, a higher weight of the green industries. As you can see in the right-hand side, this is a much simpler classification than the paper that we have just heard. This is just above the median or below the median, the industries, according to their emissions per unit of value added. And the percentage of green industries in the loan portfolio of the Spanish financial institutions has increased a bit, but hasn't intensified dramatically in the last years, contrary to what the information of the disclosures show. So this basically is the case of Spain, for Spain, that is in coherence with the aggregate results that Martina just presented. So what this paper is about is that the decarbonization trend in the bank's loan portfolio doesn't match the glossy green picture portrayed by the sharp increase in the disclosures of the environmental disclosures by European banks. And these, on the left-hand side, you have the chart of this indicator, this proxy of environmental disclosure showed by Martina. There's other ways of reporting this increase on disclosures, environmental disclosures. And on the right-hand side, you have some results of colleagues from Banco de España that they show in the Pillar 3 reports of European banks supervised by the ECB, whether they actually have, what's the percentage of institutions that have mentions regarding ESG frameworks or ESG risks. And you see that from 2019 to 2020, there was a sharp increase just in 1 year. And it was especially the case for smaller institutions, but it's all over the place. So this is coherent with this increase that Martina showed. The main results, she was quite efficient in telling us the main results, and basically that Euro area banks with higher environmental theme disclosures lend significantly more credit to brown industries. This is the first main result. And this is tested with a very welcome extension to firm level data, which I encourage you to dig further, because it basically concentrates into big firms, and it would be very nice to see a bit more. And they lend significantly more credit to brown industries, and there's some result that she didn't highlight, and I found a bit puzzling. banks reporting, the high environmental reporting banks, 1 year, they tend to lend more to brown industries, even 3 years ahead. So kind of forward-looking greenwashing. And in my head, it makes sense to declare more environmental concern and then act later, but 3 years later, I'm not sure that this makes much sense, this long forward-looking greenwashing. And this, as you saw, this higher credit is not for the green transition through R&D investments or to discourage brown activities through higher rates or shorter maturities. These banks do not lend significantly more to green industries, and they are less likely to discontinue established green credit relationship with brown borrowers. So this case of banks with low capitalization that report more environmental disclosures, they lend more to brown borrowers, but especially bad brown borrowers. I found a bit, this is an argument that applies to everything. Why are more prone to zombie lending the high environmental reporters than other banks? It wasn't clear to me. My final point is, all right, if environmental disclosures by European banks in this period, 2014-2020, cannot be trusted as reflecting lending policies that support the green transition, is there not hope for this call I made in my first slide that it is essential to increase the quantity, quality, and harmonization of environmental information? Well, she showed a table in which even the countries where there's more audited sustainability reports, it doesn't make any difference, and also other measures that have been taken. So my question here is, what would the authors think that regulators and prudential supervisors of the banking system can do about environmental disclosures if what has been tested so far doesn't seem to work? With this, I've finished. I thank you for the paper, and it leaves me a bit worried, but I think it's a very nice paper and it contributes greatly to the greenwashing debate. Thank you.
Okay, thank you, Eva, very much. So, back to you, 2 minutes.
Perfect. Thank you very much, Eva, for a fantastic discussion. So I'm going to very quickly jump onto a couple of things. Yeah, I agree. The firm level data are incredibly promising, and I think we could be doing more there. The problem is we're losing a huge amount of firms, so there is a trade-off. We now have more results into actually tracking these emissions over time to see whether they fall. Spoiler, they don't. So they seem to be that there's, again, like no transition evidence even looking more into the firm level emissions. On the forward-looking greenwashing, so yes, we have included now more results by actually using different leads and lags for the environmental disclosures. So essentially the main message here is that these environmental disclosures seem to be mostly time invariant. So a bank is either the type of a bank that likes to talk more about the environment, or it's a bank that just does not talk about these topics. And it doesn't seem to vary so much year from year. So as a result, when you implement some of the lags, you see that this result kind of remains there over time. Coming to the zombie lending, I think it really suggests that the talk is cheap, and if a bank is undercapitalized, there's really no problem for the bank to hide these losses and distract, from the loan book towards other activities of the bank that could potentially, again, as I showed early on, is benefiting, their ESG rating, that there are other positive effects. So that the undercapitalized bank that's engaged in these types of, lending behavior might essentially prefer to distract the attention and make more focus on other parts of their activities. And then finally, on the big question, is there any hope for the regulator and how should we think about this? I think that's a very hard question, and I think it opens the debate. I'm going to say two things. One is on the side of the regulator. So we were able to write this paper using ECB data, which are using the $25,000 euro threshold. My understanding is that Bank of Spain has even more granular loan-level credit registry data. So again, regulators can learn more than compared to what the market participants can see. So there is some scope to, have better understanding in terms of the supervision, like what kind of loans banks are actually making. And the second comment is related to the standardization of these disclosures. So right now, banks can really say whatever they want in their reports, and they're not really penalized for saying anything. Right now, there's a case playing out in the French courts when the non-profit firms are suing ING for saying something about being environmentally friendly. And the case is playing out now in the court, so it's going to be interesting to see whether ING will be forced to pay the fines. And if so, this can have a market disciplining effect of its own through the legal system. Yeah, I'm going to stop there.
Okay, well, thank you. You wanted to? Okay, you go first.
So, I agree very much, first of all, with Eva, great paper, so very interesting. One suggestion, one remark. So you're using Orbis data already, so it might be interesting. Orbis has this banker variable, so it like shows you publicly known bank firm relationships, and then you have a couple of that are in the light and a couple of that are in the shadow. So you might use this to distinguish, like see what banks are doing for both type of firms. The second, the remark, I think your implication go beyond zombie lending. So if you are even lending to a viable brown firm and you are the relationship bank, you might be very reluctant to stop this relationship if you have a large exposure to this firm, because first of all, there's adverse selection, like if other banks see that you as a relationship bank cut back on lending. On top, this is a brown firm, you might be very scared that this viable firm turns to a non-viable firm because you as a relationship bank cut back lending. So I think that goes even beyond just zombie firms.
Let's, Solly. Second row.
Well, thank you very much for your paper. I think it's very good, although it's really pessimistic and it's bad news. But I don't know, I mean, we all know that big banks, which are the ones that disclose more, are very intensive brown lenders. By a matter of fact, the stress test that the ECB did, they found that 2/3 of the income coming from non-financial firms are coming from brown firms. No? So that's on the picture itself is not so surprising as you think. I know that you control my time, but I would like to see, I mean, or probably you have done it, if it is really increasing, which will be the problem. I mean, have you plotted the percentage of brown lending over total lending? Because, I mean, your period is 2014 to 2020, which especially the first years were not, I mean, nobody was worried about these things, especially 14, 15, probably. And also something that may explain that is precisely because these high intensive in brown lending banks are managing risks, climate-related risks. For instance, if they are issuers of green bonds, maybe they are just issuing green bonds and then they are doing green lending too with the funds raised from the green bond issuance, and then compensating the risk coming from brown lending.
Xavier.
Thank you. Very illuminating paper. In relation to your last comment, what you were saying at the end, you did not say much about the type of disclosures of the banks, and I think there could it be that generic disclosures are associated to what you say, but then that institutions that have much more precise disclosures with a scope 1, 2, 3, whatever, no, and they are much better targeted than it's the opposite? Then could it be, because this I think could be the, in a sense, the good news, and also the way that regulators should go, no?
Okay. Veronica. Okay, well, come on, sí, venga.
What are your expectations on the effects of these more standardized, extensive disclosures? Can they be potent enough to induce somewhat negative supply shock on brown firms, some substitution towards financing towards towards NBFI or banks that have some exemptions of these disclosures, or this is too potent? Can this affect the communication strategies of banks? Will they try to differentiate, or it might lead to some content to conform to the standard and reduce this heterogeneity? Thanks.
Okay. And now, Veronica, your turn.
Thanks. This was a great paper. I have just one comment. I see your paper as a huge criticism for a lot of recent research on using text-based analysis on how we measure variables. This is a text-based variables are great. We have many of them, but what you're saying is that in the signal-noise ratio, maybe there's a lot of noise, and the noise is not the classic white measurement error. It's an error that is driven by demand and supply components that probably are really bad for any identified study. So it's really a comment more than a question, but I think there's a lot of criticism in using that type of measurement after your paper.
Okay. Right, so let's, Javier, and
so
then
very quickly,
the
I
last one.
think I'm going to go on things that have been said, but just to reinforce the message. I see this paper as a call for caution against the meaning of soft disclosures. It's in line with what Veronica and Xavier were saying, soft as opposed to hard disclosures, no? And your references to the disconnect brought to me immediately to think about a Spanish proverb whose translation to English is, they brag most who can do the least. Dime de qué presumes y te diré de qué careces. So I think these firms, these banks feel guilty by how much brown they have, and then they talk about green in the discursive part of the disclosures, but they cannot report hard numbers supporting their claims. So I think the regulators will have to go towards the hard information. Another comment, leads and lags. I think your discussion was very good, because I think this will make me more convinced about what is the direction of causality. From my proverb, basically, is you have a lot of brown and then you do this type of cheap talking. But it would be nice to find what comes first, whether the big brown portfolios and then the references to green, or the other way around. It will be very strange that you increase your intensity of disclosure and then you go into further brown, but maybe that happens and then it will be really anomalous.
Javier,
okay, I pass that.
Tamon.
Hi, Martina. So I have one additional comment since last week. We discussed the paper together. So I was wondering if you could add a little bit more color on how non-high environmental reporters are doing in terms of their performance for greening their loan portfolio. Are they doing super good and high environmental reporters are doing bad? In this extreme case, the greenwashing argument is a very strong argument. The other extreme is every bank is doing bad and the high environmental reporters are doing even worse. In this case, probably the regulatory constraints or the possibility of firms doing greenwashing or simply technologies are lagging behind, these may be responsible for the result that you see. So I was wondering which is closer to the reality. Thanks.
Okay, finally, Sole wants to have a very short remark here in the, hey, can you bring it here to the second row on the left?
Yeah, just a very short question. Do you think that things will change with the new regulation on disclosure? I mean, the directive, they will have to precisely report on the percentage given to brown industries or to green industries, whatever, and also about scope 3 emissions. So scope 3 emissions will cover that. I mean, will cover which is the effect of the lending on emissions. So would you think that it will change? I mean, they will have less room for greenwashing, but...
Okay, well, thank you. You have quite a few questions in very little time, but let's see what you can manage.
My response is standing between you and the lunch, so I try to be extremely quick and we can talk more afterwards. So yes, we can definitely use more Orbis. I like the idea. And yeah, I think we can do more with this data. The data is ready, so I fully take your comments, and I think we can definitely do that. In terms of the overall lending dynamics, we do aggregate the results on the bank loan portfolio, and we indeed do see that these high environmental reporters are shifting their portfolio towards more brown. So this is not just the loan level information, there is actually more brown lending also in total. We also split the results by years. So we first dropped the very beginning of the sample, then we estimated year by year, but then we also drop the very last part of the sample. It doesn't really matter how you slice the data. The result is always there. Magnitudes might slightly differ. If anything, the results are getting stronger these days. But again, that's primarily driven by the fact that we have better data and banks like to talk about this more. Again, coming back to the discussion that this talk is generally cheap and there doesn't seem to be much punishment for it. In terms of the discussion we had here on other activities, so I think that the issuance of green bonds and other activities that banks are doing that are green are kind of, on one hand, compensating for the activities that are happening on the loan book, but more importantly is, as I mentioned, the loan book is unobservable for investors. So banks can choose to selectively talk about these, like positive things that can be verified because you can see green issuances, but as you cannot really observe the loan book, there's a little bit more of a dark area. Xavier, on your questions, yes, we played a lot with the disclosures. We excluded information such as whether the banks talk a lot about like very far future, by 2050 we want to do something. We played a lot about dropping information that are just general environment. Sometimes banks just talk about like fires, or they talk about droughts as an overall problem. We also use the measure of the sentiment, so to kind of measure more the vocabulary around these words, whether they pursue these things as risks. Again, our results are generally robust to all of these additional tests. This brings me to Veronica's comment on the disclosures. Yeah, the signal to noise, again, coming back to the point that the talk is cheap and at this stage is not punishable, so it kind of doesn't really matter how state-of-the-art measurement textual analysis you're gonna implement. There still appears to be a disconnect as to what banks say and what they actually do in their loan books, which we find particularly worrying. In terms of the communication, yes, there is a large heterogeneity at this stage. So we do see some banks that talk about it a lot, some banks that don't. It would be interesting to see over time what happens, whether there's more homogeneity, again, coming to the fact that there doesn't seem to be much repercussions. There is a big question is like, why don't all banks do this, given that it doesn't seem to be a problem? And I agree, we can try to do more there. I love the call for caution on soft disclosures. Javier, I think it's a very nice summary of the paper. The leads and lags, yes, I misspoke. For now, we use the lags, different lags, but we haven't tried the leads, and I agree. We use the other one. So we look to the future. We haven't tried looking to the back, and I think we should, because that could help us more with the causality, as you exactly pointed out to. So that's definitely on our to-do list. And then, what about the regulation? If we have better disclosures, I guess we all have to see. There is some mixed evidence. I mean, we know that there are papers looking into, say, stress tests and how banks can still manage to hide their losses. So it probably matters on the sophistication of the banks. But I agree that more information should definitely shed more light and potentially improve the bank discipline. And in addition, scope 3, again, it's a great idea to measure it. The problem then becomes how much of these firm level emissions are actually firm really based and how much are model-based. So again, there is some heterogeneity in like what's the quality of the information we're getting from these types of sources. I'm going to stop there and happy to talk more offline.
Okay, well, thank you very much. It was a great session. Thanks to the speakers and the discussants. Now is lunchtime, okay? We have 1 hour, one floor down, okay? So thank you.
Is it open? Yeah. Well, hello. Welcome to the second session. And what we have here today is 3 great papers on capital requirements and the best design for capital regulation, how that impacts on smoothing credit lending and avoiding, hopefully, bank distress at the time of crisis. So we will start with Jan. The floor is yours. You have 20 minutes.
Okay. First of all, thanks a lot for the conference organizers for inviting us to present here. So the paper I will present is entitled The State-Dependent Impact of Changes in Bank Capital Requirements, and this is joint work with Dominic Menno from the Bundesbank. So given that we work at institutions, the usual disclaimer applies. So what's the structure of my talk today? So I will start out with a brief motivation and an overview of the key results. Then I will present the structural model setup. And then in section 3, I will provide the key results of the paper. And finally, in section 4, I will conclude and provide some policy implications. So what's the motivation for our paper? If we look at the data, we see that the impact of changes in bank capital requirements is actually state dependent. So a 1 percentage point increase in capital requirements tends to have close to a 0 impact on lending in good states. So whenever banks make profits, they have voluntary capital buffers or the macroeconomy is doing well. So you see that illustrated in the left-hand side chart. You can also see from that chart that if you're in a bad state, so where banks don't have buffers or make losses, the same increase in bank capital requirements can actually reduce lending by a few percentage points. So in the data, there's evidence for the state dependence of changes in bank capital requirements. And the second motivation is that if we look at standard macro models with the banking sector, they often lack this feature of state dependence. So if you look at the table on the right-hand side of the slide, you can see a summary of the quantitative impact of a 1 percentage point increase in capital requirements on the lending reduction. So we have borrowed that table from a recent ECB paper. And you can see that in most of these models, so many of these are used for policy evaluation in institutions, there's a constant lending response of 1 to 1.5% in response to a 1 percentage point increase in capital requirements. So we use this as our motivation to build a structural model with state dependence. So our key result is that indeed there's strong state dependence, and the impact of a change in capital requirements on lending can actually differ by up to 2 orders of magnitude. So the differences of state dependence can really be huge. So what do we do? In our paper, we build a nonlinear banking sector equilibrium model, and this model features monopolistic competition, and it also features the fact that bank equity is always more costly than bank debt. So this assumption will tend to make it quite costly to increase capital requirements. So whatever we do in the model, interpret this as upper bound. So we're making quite conservative assumptions. And then the key model block that gives state dependence will be that we introduce 2 occasionally binding constraints. So we have a capital requirement constraint and a constraint that banks cannot issue equity. So they cannot go to the market and issue equity. They can only build equity through retained earnings. And really this interaction of the 2 occasionally binding constraints is what will yield strong state dependence in the model. In particular, what we find is that in normal states where banks hold voluntary capital buffers and make profits, there's actually a very low impact of an increase in capital requirements. So 1 percentage point increase only leads to a drop in loans of up to 0.1%, and it can even be lower than this impact. However, if you're in a bad macro-financial state where banks make losses and they become capital constrained, you actually get a very high impact of changes in bank capital requirements on lending. So a release of requirements by 1 percentage point can increase loans by up to 10%. So these are really the 2 orders of magnitude difference. And the key question is what's the intuition behind these very different magnitudes? So we show that in normal states, when banks basically have enough equity, a pricing channel is active. So basically whenever banks have the equity to satisfy higher requirements, the only impact on loan quantities is that the average funding cost of a loan increases because equity is more costly than debt. And this is passed on to customers, and you move up the loan demand curve. But this effect is really super small. However, if you're in bad states, where banks make losses and they basically hit their equity constraint, a quantity channel comes into play, because basically the available equity and the requirement directly determine the maximum loan quantity that banks can supply. And basically then, in these states, if you change the requirement, you can have a very large impact on loans. So in the interest of time, I will not go into the details of the related literature, but you find all the things in the annex. And for the remainder of the talk, I will go into more details of the model and show you the technical details behind this state-dependent impact. But basically, the intuition you already have, and it's on this slide. So how does the model look like? We have a fairly stylized but realistic bank balance sheet and profit and loss account. So on the asset side, the bank has loans. On the liability side, they have deposits and equity. And the profits of the bank are simply given by the difference of net interest income minus the cost of risk, so impairment costs and operating costs. So let me say a few more details about net interest income. Net interest income is simply interest rate on loans times the loans minus the deposit interest rate times deposits. Cost of risk is simply that we assume that a time-varying fraction theta of loans default every period. So this is the stochastic variable in the model. And operating costs are simply a constant fraction of balance sheet size. So this scales up linearly. And importantly, the interest rate on loans that the bank is able to charge will be endogenous. So in the annex, you will see how we model the loan demand side, but we basically have a downward sloping, constant interest rate semi-elasticity aggregate loan demand curve, and we assume monopolistic competition. So this will lead to basically an endogenous interest rate that depends on the loans that the bank supplies and the aggregate loans in the economy. And as I've mentioned before, the impairment rate is stochastic, and we assume that it follows a log AR1 process, and we assume log AR1 because in the data we see a fat right tail of loan impairments, and to get that fat right tail, you need a log AR1 and not a AR1 in levels. So on this slide, I'm basically summarizing the key two occasionally binding constraints that will yield state dependence. So first, note that equity is built through retained profits after accounting for dividend payouts. So equity next period is simply given by equity this period plus the profits the bank makes minus the dividend payouts. And importantly, dividends are the optimal choice of the bank. So the bank chooses how much to pay out, but there's a constraint and they cannot issue equity. So dividends cannot be negative. The second occasionally binding constraint is that there's a potentially time-varying capital requirement R, and this must be met by the banks all the time. So the capital ratio, which is defined as equity over risk-weighted assets, so omega is the risk weight of the assets, this needs to be, the capital ratio needs to be greater or equal than the requirement at all times. And the interaction of these two occasionally binding constraints will yield this very strong state dependence. So what is the objective of the banks? Banks maximize the present expected discounted value of dividend payments, and they discount, or the discount rate that they apply is determined by the required return on equity. And we denote this by RAW, and we assume that it's constant and it's always greater than the deposit funding cost. So this is quite a conservative assumption and will tend to make it costly to increase bank capital requirements. But as we will show, still in normal states, the cost will be very low. So the decision problem of the bank can be represented by the Bellman equation that you see on the slide. And the state variables of the value function are theta, which is the credit risk shock, loans of the bank, equity of the bank, and the aggregate loans supplied by the entire banking system. And you can also see that on the right-hand side of the Bellman equation, you have the two occasionally binding constraints. So the capital requirement constraint has the associated Lagrange multiplier chi1, and the equity issuance constraint has the associated Lagrange multiplier chi2. And the equilibrium of the model will be determined by the first-order conditions to this decision problem and imposing the representative bank assumption. So in equilibrium, the individual choices need to be consistent with the aggregate. So let me turn now to the key results of this framework. So I will present analytical insights, but also quantitative insights based on a calibrated model to euro area data. And importantly, we solved the quantitative model with global solution methods so that we get the full nonlinear dynamics of the model. So the first insight of the paper is that there's a pricing channel of changing bank capital requirements. And proposition 1 states that in the absence of an equity issuance constraint, equilibrium loans respond to changes in capital requirements via a pricing channel. So what you see there in the equation is that the percentage change in loans is equal to the right-hand side expression, which might look complicated, but actually has a fairly intuitive interpretation. So let me walk you through this. So if there's no equity issuance constraint, banks can always go to the market and get new equity. So the only impact on loan supply is that the weighted average funding cost of a loan increases. So you need more equity to finance the loan. Equity is more costly than debt, and this is basically increases the funding cost. And that's what you see in the square brackets on the right-hand side of the equation. So raw minus ID is simply the premium you pay on equity, and omega times delta R is simply the additional amount of the loan that you need to finance with equity. So basically the square brackets give you the additional or the increase in funding cost. What's important to notice is that actually the impact on funding costs will, for realistic parameter values, will be super low. So if you plug in an 8% cost of equity, a 2% cost of liabilities, 50% risk weight, and a 1 percentage point increase in capital requirements, you end up with an increase in funding costs of 3 basis points for the loan. So this is an eighth of a standard monetary policy rate hike. So in terms of increased funding costs, that's almost nothing. And due to monopolistic competition, banks will pass that on with a markup. So that's why you have mu over mu minus 1 in the equation. But this markup will also empirically will not be that high. And then the impact on equilibrium loan quantities will depend on how elastic loan demand is to this increase in offered lending rates by the banks. But empirically, we also know that loan demand is not too elastic. So a reasonable estimate is around 3 for this interest semi-elasticity. So if you put together all these numbers, you end up with a minus 0.1% in loans for 1 percentage point increase in capital requirements. So this result is for the model where you don't have the equity issuance constraint, but importantly, we show that a similar proposition can be derived for the full model for states where the banks actually hold voluntary capital buffers before a capital requirement increase and after. So if banks have enough capital to basically absorb the increase in capital requirements, a similar pricing channel will be active. And the key message about the pricing channel is that whenever that is present, the impact on lending will be super small. And we use our quantitative calibrated model to illustrate this. So what you see on the chart is basically the simulated impact of a 1 percentage point increase in capital requirements on lending. So that's on the y-axis. On the x-axis, you see the relative frequency of the simulated impact. And what you see is basically whenever banks hold voluntary capital buffers but do not pay dividends, so those are the red bars, basically a 1 percentage point increase in requirements will only lead to a drop of minus 0.1% in loans, so quite low. But importantly, if banks are also paying dividends before and after, so they basically already hold the optimal voluntary capital buffer, the impact on loans is almost zero, so it's very close to zero. So it basically means whenever banks hold voluntary capital buffers before and after changing capital requirements, the impact at most will be minus 0.1, and it can even be lower. So it's almost, very, very low. The second key result of the paper is that there's a quantity channel also of changing capital requirements. And proposition 2 states that in states of the world where the equity issuance constraint and the capital requirement constraint are binding, the equilibrium loans respond to changes in the requirements via this quantity channel. And the quantity channel states that the percentage change in loans needs to be equal to minus the percentage change in the requirement. And again, what's the intuition behind this quantity channel? So if both constraints are binding, it means that banks don't hold voluntary capital buffers, and it also means that they don't pay dividends. And in these states, the loans that the bank can supply is determined by the equity they have, the profits or losses they make in the period, and the capital requirement. So the equation there, I simply plugged in these values, and you see that basically R prime and L prime are the only two variables that vary. So if you change the requirement, it directly impacts the maximum loans that the bank can supply. So the key message about the quantity channel is that the impact on lending whenever this channel is present will be very large. So whenever banks are capital constrained, a 1 percentage point release in capital requirements will lead to around a 10% increase in loans. And where does this 10% increase in loans come from? If you look at the quantity channel, it's simply percentage change in loans equal to percentage change in requirement. And given that the requirement is usually around 10%, a release by 1 percentage point means roughly a 10% change or reduction in the requirement. So we also use our quantitative model to simulate the quantity channel. So assume a bad shock hits the economy, impairments go up a lot, so you see that in the middle panel. This will actually induce big losses for banks, and the losses push the bank towards the capital constraint. So the constraint becomes binding, and they're forced to deleverage. And you see that represented by the red lines. So basically under constant capital requirement, banks will be forced to deleverage a lot. So if the regulator actually is able to release requirements in these states, this helps the banks to absorb the losses and it mitigates bank deleveraging. So those are the blue lines compared to the red lines. So of course a key question is then what kind of capital requirement rules help you to prevent that this quantity channel is basically absent whenever you activate capital requirements and that it's not there in the bad states. So proposition 3 states that policymakers can avoid the quantity channel with capital requirement rules that satisfy that the requirement never turns negative, and it needs to satisfy the following condition in all states. So the requirement needs to be smaller than the beginning of period capital ratio plus the return on risk-weighted assets adjusted for a desired loan growth rate of the banks. And again, what's the intuition behind this rule? Well, basically, the return on risk-weighted assets and desired loan growth, they determine the speed limits for how quickly banks can change their capital ratio. So when profits are positive, a gradual increase in the capital ratio is possible for the banks, and therefore you can gradually increase the capital requirement. The reverse is that if there are losses, a release in the requirement will be needed so that basically you allow banks to accommodate the decline in the capital ratio without forcing them to deleverage. So we use our quantitative model to implement a simple state-dependent rule that is consistent with this proposition. And most importantly, the state-dependent rule will build up capital buffers when the costs are low. So when banks make profits, you gradually increase the requirement, and when they make losses, you release. What you can see in the chart is basically the result of 100,000 simulated economies for transitioning from a 10% constant requirement to this time-varying rule that varies requirements between 15 and 10%. So the blue shaded areas give you the percentile ranges across these 100,000 simulated economies. And what you can see is that the state-dependent rule will provide large gains at fairly moderate costs. So basically, on the right-hand side, you can see that after 5 years of having the state-dependent rule in place, basically the credit crunches are gone, so you really cut off the lower right tail of the loan distribution, and at the same time, basically the upper percentiles of the loan distribution are hardly affected. So this basically shows if you do this state-dependent rule, you basically don't do much to loans in the normal state, but you avoid that you get occasional large deleveraging. So let me finally provide sort of a brief overview of what the policy implications are. So in our view, the paper provides a clear rationale for positive neutral countercyclical capital buffer strategy, CCYB strategy, and in particular that you should start to build positive buffers when banks make profits because the costs you will impose are very low. So when and how should capital requirements be increased? When the banking sector makes profits, this is super easily observable. How should it be done? Fairly gradual, because the speed limit for increases in the capital ratio will be given by ROA and desired loan growth. And this is super easy to implement because basically dividends tend to be paid out of past year profits, and also the CCYB is phased in with basically a 1-year time lag. So if you observe profits, you can basically increase the requirement based on observed profits, and it should not constrain banks. In the interest of time, I will stop here, but basically, yeah, release when banks make losses, but this will be a bit harder to implement. So thanks a lot for your attention, and I hope you found the talk interesting.
Thank you. So we have Galo Nuño from Banco de España discussing this paper. Thank you.
Thank you very much. So, okay. So, I mean, this is a very interesting paper that addresses a topic that I think needs to be addressed, which is most of the macroeconometric, I mean, models, tools that we have at central banks, and also in the academia in order to deal with macroprudential issues are typically based on linear models. And this is kind of a big gap because in terms of monetary policy, it's different because inflation is kind of a continuum phenomena. Now we can discuss whether, high inflation regimes are different to low inflation regimes. But in terms of macroprudential tools, there are very strong nonlinearities operating. And the beauty of this paper is that in a relatively simple approach, it tried to address these shortcomings from the point of view of analyzing this kind of state dependency associated with the behavior of banks in response to changes in the capital ratios. I wanted to start with a simple, because the paper has several elements, but at the end of the day, it can be stripped off of most of the bells and whistles in order to focus on the key mechanisms. And then essentially, this is why I wanted to start with very simple, kind of toy model. It's a simplification of the model in order to understand how those two channels operate. It was very helpful for me. So let's start first with the quantity model. So imagine that the capital constraint is binding for a bank. So you are really hitting the capital constraint. Then, if the bank's capital is constant, so it cannot issue new equity, it cannot issue new capital, and this is an important if assets are short-term, then if you increase the capital ratio, automatically the bank is forced to deleverage and reduce the assets. So that is pure accounting, in the sense that, if I have to satisfy that at a share of my assets are covered by equity and I cannot issue new equity, and now you ask me to increase the share of my assets that have to be covered by the same amount of equity, and I cannot default, and I can instantaneously or in one period reduce my assets, then I will deleverage. And essentially, the percentage share of the deleveraging in assets is proportional to the increase in the capital ratio. Then, if now I plug that into a demand curve mapping interest rates with quantities, then I will get which is the impact on the impact of that reduction in interest rates, which will be just proportional to this to the semi-elasticity that linking quantities with interest rates. Okay, so that is the quantity channel. The quantity channel essentially relies on these two key assumptions. One is the issue that you are at the constraint, and second, that you cannot issue new equity, and especially that your assets are short-term, so you can deleverage. Then now we move to a different scenario. Imagine now that a bank can issue all the equity that it wants, or that it holds a voluntary capital buffer. Then the bank is facing a very simple problem. Here we can illustrate it in a two-period case, but it's very similar in the multi-period model. Essentially, I mean, you want to maximize the flow of dividend in this period and in the next period, and essentially you are facing the net interest income. The other costs don't play a role. They play a quantitative role, but in order to understand the mechanism are totally relevant, the same as monopolistic competition. Actually, in the calibration, papers are almost perfectly competitive. So this is not about monopolistic competition, this is not about any kind of cost. It's super simple. It's essentially, you have this, that the dividends are just the net interest income minus the change in capital, because you want to decide endogenously to devote a part of your profits to increase or decrease your capital, and then subject to the constraint. Then the first order condition just give you this pricing channel. So they are just giving you this mapping between the difference between the deposit interest rate and the discount of the bank multiplied by the change in the ratio. So if we compare both slides, thank you. If we compare both slides, you see that in one case there is kind of a -1 mapping from the reserve requirement to the change in assets, whereas in other case, this, instead of a 1-to-1 mapping, this mapping is multiplied by epsilon, rho minus ID, and omega, which essentially it is multiplied about a difference between two interest rates. So we are multiplying the quantities by a difference of interest rates. So then that makes kind of obvious that this channel is going to be proportional to this interest rate. So it's going to be 2 orders of magnitude smaller than the quantity channel. Okay, so that is my reading of the paper. Then when you analyze the whole model, dynamical model, then they have super beautiful pictures, and I should say that I like even more the presentation than the paper in terms of how things can be understood. But this is the idea of the paper. So essentially what we are going to have is is the banking system that is hitting from time to time this occasionally binding constraint. Then I have 3 comments. The first one is whether banks deleverage so fast as in the model. The second is whether bank heterogeneity can be used to support the results. And the third is how relevant is to miss the endogenous deposit funding, because this is a channel that is automatically shut off in this paper. About the deleveraging, as I said, an important assumption of this paper is that it has a short-term asset structure and that banks do not default. So then, if you imagine, for instance, that a large negative shock arrives, then banks can immediately deleverage. So essentially, there is this super strong mapping from the ratio or from the equity impact to the asset side. But the question is, in reality, banks engage into maturity transformation, and most of their assets are long-term. So then it is not that clear to me that this process will be that big. And if it is that big, that would have to be something dynamically. The bank cannot deleverage so fast, so it would be some kind of dynamic deleveraging over a number of years. So that is, from a quantitative point of view, that is something to be taken into account. The second is the issue of bank heterogeneity. If we have a look to the distribution of capital ratios, very few banks are close to the regulatory ratio. So then the question is, how realistic is to, of course, you may say that the assumption that banks are, the banking sector as a whole, because this is a model with a representative bank, is slack or is hitting the boundary, it can be used as kind of a proxy of which share of the mass of this distribution is close or not to the boundary. But if that is the case, maybe the empirical data can be used in order to see whether banks that are closer to the boundary behave more as in the quantity channel, whereas banks that are farther away from the boundary behave less as in the quantity channel and more as in the pricing channel. That would provide really some convincing evidence about the importance of those regimes. And then the third one is that the paper makes a point about the link between the regulatory ratios and the interest rates on loans. But then it artificially keeps the interest rate on deposits shut down. But however, if you also make, that endogenous, I make some, I think I didn't put it in the end, but you get this kind of dynamics about this kind of deposit channel of monetary policy, in which the increase in the ratio, the increase in the regulatory constraints, on the one hand, as it happens in the model, increases the equity and reduces the loans, but then in a second stage, as you deleverage, you also require less deposits, and then that changes the competitive situation in the deposit market, so that reduces interest rates on deposits, and then increases the net interest income, and that helps to recapitalize the bank, and then increases the loan. So, I mean, it's very clear that an increase in the regulatory ratio is going to increase the amount of equity, but the effect that it's going to have on the loans will depend on the relative strength of whether the impact through the loans is stronger. In this model is totally stronger because the other is shut off, but in reality it will rearrange between the elasticities in the loans and deposits. And then to conclude, I mean, this is a very cool paper. As an advice, I mean, the paper is nice because it has both analytical results and quantitative computational ones, and the quantitative computational ones, I mean, it's not something that can be done in a couple of evenings because it's a fully general equilibrium nonlinear model, but there is a certain tension about whether the paper wants to just illustrate a mechanism or really talk about the real numbers in reality. Then it would also be nice to have more evidence about this state dependency in the data, because the paper based to use that, which is this paper by Jimenez et al., it's more about credit demand and loan quality, but not that much about banks and the regulatory constraints. And that's it. I mean, thank you very much. It's a very nice paper to read, very well written, and thank you.
Do you want to?
Yes. I mean, first of all, thanks a lot for the discussion and the kind words. Let me briefly respond to the 3 comments. So, yeah, it's true in our model, banks deleverage instantaneously because we basically have one period assets. This was done deliberately because it allows us to have the model simple and tractable and derive analytical results. Of course, in reality, there will be some friction, so you can also introduce adjustment costs here. And the thing is, I mean, if you take it to the extreme and banks basically have only long-term assets, what will happen in the cases where they can't deleverage is basically they would default. And to keep actually, I mean, solving a model with default and that nonlinearity is even more complicated than what we're doing now. So we're fully aware of what you said, and to make it quantitatively super realistic, probably some form of adjustment costs will be needed, but to get analytical results and intuition, we try to keep it tractable and focus on the key mechanism. Similar for bank heterogeneity, so we kept it on purpose with a representative bank. I think the impact of heterogeneity on the results will depend on what you assume about substitutability of loans across banks. And, but I mean, I think one point that we really want to make with the paper is if you increase requirements gradually when banks hold voluntary capital buffers, the impact will be low. And I think as long as the majority of banks are in such a state, the impact will be low, and I think this is really what we want to convey to policymakers. Don't be afraid to increase requirements in states where basically banks can absorb that. Deposit rates, yeah, if you make the deposit rates react to capitalization, the pricing channel would probably be even less than what we derive. So this is really a conservative upper bound, and you can even have more beneficial impacts of higher capital requirements. So again, we try to make it as hard as possible for increasing capital requirements to actually have low costs. And even with those very strict assumptions, we show that it's actually not that detrimental. So, but yeah, for fully realistic quantitative model, that's definitely something to consider.
Well done. We stop here so we can, if we can get some questions from the audience. David?
Thank you. Thank you very much. It looks like a very nice, clean paper. Thanks a lot. One question. How much does the relative cost depend on the level of the capital you have? Because it looks like the deleveraging is going to depend a lot on what's the starting level of capital. Mm-hmm. So basically, if you can comment a little bit on that, I would appreciate it. Thank you.
Okay.
Okay, now it's working. Okay, thanks for the paper. So I was wondering if you could comment a little bit on your assumption that banks cannot issue equity. It seems to be quite strong to me. So what exactly do you have in mind? Is it related to the timing? Is it some form of debt overhang? And it seems to be that should be related as well to your policy implications down the line. So wondering if you could comment on that.
Thanks. Really, really great paper, and speaks a lot to the paper that I presented this morning on sort of low versus high surplus. And I was going to make a comment on Gallo's point about the distribution of capital ratios and how it doesn't seem as though many banks are close to their sort of regulatory ratios. I wonder if voluntary surpluses are also state dependent, and I wonder how that impacts the point at which capital constraints bind. And I wonder if there's a way of incorporating that into the model. Because I wonder if once a shock hits, banks may all of a sudden decide that they prefer to have greater management, but for sort of voluntary surpluses, and therefore may become capital constrained even if they're not right on the border. Thanks.
Thank you. Do you want to?
Sure. Well, thanks a lot for the interesting questions. So how much does the impact of our two channels depend on the level of capital? So the short answer is, for the pricing channel, basically doesn't really matter because it's only the delta. For the quantity channel, it matters because it's about the percent change in the capital requirement. So if you have a very high capital requirement, then the quantity channel will be smaller. If you have a very low capital requirement, quantity channel will be higher. So for the quantity channel, the level matters. On equity issuance, indeed, it's a strong assumption to assume no equity issuance at all, but you could relax it and say equity issuance is possible, but it's costly. So what that will still lead to state dependence, because in the good states where banks make profits, you will not face this equity issuance cost. You will still get state dependence. The intuition will probably be that the magnitude of the quantity channel will be lower, because it could be that banks are actually not that much actually capital constrained, but of course their marginal cost of providing a loan increases if you need to pay a very high cost to issue equity. So you will still get state dependence, and importantly, the low cost of increasing requirements in the good states or normal states will be unaffected. Then on heterogeneity and voluntary buffers. So we don't have heterogeneity in the model, but we have voluntary buffers in the model, and they're basically optimal choice of the bank. And interestingly, actually we have we have counter-cyclical voluntary buffers. So in the bad states, the self-insurance motive of the bank increases. So if risks are higher, they want to hold higher voluntary capital buffers, which is actually the opposite to what you want from a macro perspective. So this is basically what we show in the paper is that the self-insurance that banks do is not enough to avoid that they occasionally face basically deleveraging pressure, and that's why as a regulator you want to put in place higher requirements in the normal states so that you actually can release in the bad states, because the banks voluntarily, they will not do enough self-insurance. Yeah, I'll leave it.
Well, thank you. Thank you very much. Our second paper for this session is by Maximiliano San Millan from CEMFI.
Thank you very much. Let me start by thanking the organizers for inviting me to present at this conference. So let me start by giving you motivation about this paper. So it's motivated by what I consider first to be a bit of a paradox in my view. So it has been documented that rapid credit expansions in certain sectors in the economy, and in particular in the residential real estate sector, tends to be associated with a higher probability of future banking distress and with lower future GDP growth. Now, in spite of this fact, the design of our capital requirements is predominantly macroprudential, and because mortgages tend to be individually safer than other exposures, then we require banks to hold less capital against exposures in the real estate sector vis-a-vis other corporate exposures. Now, what I'm going to do in this paper is to study the macroprudential implications of this microprudential design. And I'm going to be looking at episodes of banking distress, and I'm going to study how different regulatory designs, in particular the type of buffers adopted after the Basel III reforms, so in concretely the countercyclical buffers and the proposal of sector-specific countercyclical buffers, can help at preventing and mitigating these banking distress episodes. And basically the contribution is a quantitative one. I built a two-sector DSG model with the structural credit risk, and where bank-level distortions, namely the presence of limited liability and deposit insurance, are going to play a role. So it's going, the mechanism is really going to be a risk-shifting type of mechanism. In case I run out of time, let me just say that the model will indeed predict that expansions in real estate credit is associated with lower future GDP growth. And in terms of the policy analysis, what I find is that increasing the levels of risk-sensitive capital requirements, for example, by adopting a capital conservation buffer, while it does reduce the probability of banking distress, by making bank capital scarcity considerations stronger, actually induces a larger reallocation of credit by banks towards the real estate sector, which is the sector with the lower risk weights, and that the stabilizing effectiveness of countercyclical buffers is enhanced by the adoption of sector-specific countercyclical buffers as opposed to the generic CCYB. And intuitively, what the sector-specific countercyclical buffers will do is to dynamically correct bank risk-shifting incentives in response to an increase in non-diversifiable risk in the economy, as I will explain next. So let me skip the literature in the interest of time. But basically, like I was saying before, the mechanism is one in which there are risk-shifting incentives motivated by the presence of limited liability and insured deposit funding. So in the model, I will assume that there is a non-diversifiable driver of returns, which means that in response to an increase in this type of non-diversifiable risks, banks will be willing to expand their balance sheet as much as possible, and the sector where they can do this more easily will be the sector with the lower capital charges, which is, of course, in this case, real mortgage lending. Okay, so the consequences will be that the looser lending standards associated with these lower capital requirements will lead to larger increases in borrower leverage and will amplify the small downturns in real estate markets. So that's basically the story. Let me give you a brief picture of the model. So basically, financial resources in the model finance one-period risky ventures, which I call housing units and firms. So these are the final borrowers, if you want, in the model. And these borrowers are subject to both risks that can be diversified away by the banking sector and risks which cannot be diversified away. So that is why banks in each sector, both the mortgage and the corporate sector, are going to be subject to this non-diversifiable risk. The metaphor that is used in this literature is to describe this economy as one in which there are islands, and in each of these islands we have these banks, and they can diversify across the borrowers in their island, but they cannot diversify away the island-specific risk factors. So essentially what's going to happen in the model is that I'm going to be shocking the cross-sectional dispersion of this idiosyncratic risk, okay? Both at the diversifiable level and at the non-diversifiable level. So these are the shocks that I was mentioning before. There is this cross-sectional level of risk at the borrower level, and there is the island level risk, and I'm going to assume that on top of the traditional AR1 productivity shocks, we have the type of risk shocks that have been described before in the literature, which essentially will generate larger default. Now, as it happens, when I calibrate the model, it will be the case that the sector, the mortgage sector, will have a higher relative importance of the non-diversifiable component of risk. In other words, this is to say that in spite of the fact that you can have on average safer mortgages, the defaults in that sector will tend to be more correlated among themselves. So due to the risk-shifting incentives that I had described before, this will create incentives for banks to reallocate their portfolios towards that sector as we shock the economy with increases in non-diversifiable risk. The balance sheet of these banks consists basically of loans on their asset side and insured deposits and equity provided by bankers, and they are subject to capital requirements. Capital requirements I will later calibrate following the Basel IRB formulas, and they have, the next period, they will have some returns which will be affected by both the diversifiable and non-diversifiable components, but where importantly, banks will not dislike the non-diversifiable component of risk, as they will be protected by limited liability. These capital requirements will be binding in equilibrium given the distortions that I have described before. So essentially, how credit is going to be allocated in this economy is going to be more or less as follows. Banks will offer borrowers a menu of contracts such that bankers are properly compensated by the value of the equity that they invest in the banks. Now, because I will be assuming that bank net worth is scarce as is standard in this literature, there will be a shadow value of the banker's net worth. But more importantly, this participation constraint states it crucially depends on capital requirements. So essentially, lower, let me be more specific, let me say capital charges instead of capital requirements. So this is the effective equity cost per unit of lending that banks will face, and they will, higher capital requirements or higher capital charges will tighten this constraint in a manner such that if we think what's the way in which these loans are determined, well, borrowers see this participation constraint of the banks and they choose their leverage and a promised loan rate so that when we have tighter capital requirements, essentially the bank's participation constraint will become more binding, and in equilibrium, the borrower leverage will also be constrained. So far this is quite standard, but let me say what I do with this framework after I calibrate it to the Euro area financial and real data for the period in which Basel II was in place. What I'm going to do now is to show you what happens when we introduce different types of buffers, okay? So I calibrate the capital requirements. I assume that there is some partial adjustment, basically to capture the fact that some banks use through the cycle and other banks use point-in-time PDs. And I use the regulatory formulas in the Basel framework. So these are different regimes that I will analyze, where of course in Basel I we had basically non-risk sensitive capital buffers, and in Basel II we allowed the buffers to depend on risk parameters, and then in Basel III we add the buffers. So let me skip this. Let me just say in terms of the calibration that the model accommodates the data by setting a higher relative importance of non-diversifiable risk in the mortgage sector, which will be important. Okay, banking crisis that I will study are episodes where there are large costs to deposit insurance, so larger than 3% of GDP in a year. I want to understand what's going on in the path to a banking crisis, what's going on with real estate credit, what's going on with corporate credit, and what's going on with capital requirements. So I want to look at how this crisis look when I adopt different buffers, and I want to look at the outcomes in terms of the probability and severity of banking crisis. So this is a typical path to crisis in the model, where basically I'm comparing the baseline economy with a counterfactual economy, where I remove the risk weight and I set the capital charges to be constant, as you can see in the bottom panels. So what we can observe in this figure is that with the flat capital requirements, banks' incentives to reallocate their portfolios towards the real estate exposures is now smaller. So there is a smaller reallocation towards the more systemic sector. And this is essentially because we have removed artificially this difference between the requirements. Also, because of the lower reallocation in the corporate sector, we observe a smaller fall in GDP. Now, I mean, this is already interesting, but let's see what happens when we compare the baseline with the economy in which we add the capital conservation buffer. That is, we increase the capital requirement on risk-weighted assets by 2.5 percentage points. And actually, what's going on in this case is that we have increased the gap between the effective capital charges across the mortgages and the corporate credit. And this in turn leads to a sharper reallocation towards the mortgage sector in the path to crisis. So as you can see, the capital scarcity considerations are very important in the presence of these risk shifting distortions. And finally, let us introduce the sector-specific and the generic countercyclical buffers, which I introduce with a smooth function because I'm basically solving the model using a third-order perturbation approach. And what I find in this case is that adopting a generic countercyclical buffer is not as effective as adopting the sector-specific, the sectoral targeted instrument. So what is going on in this particular exercise? So basically, all these crises are driven by increases in non-diversifiable risk. That is the main driver of the event. So because non-diversifiable risk is more important in the calibration in the real estate sector, banks have incentives to reallocate their portfolios towards the mortgage sector. However, once we allow capital requirements to adjust to credit growth in each individual segment, what we achieve is a dynamic correction in those incentives. That is why we can see in the green dotted lines in the figure that the reallocation towards real estate loans is much softer, and also that the subsequent fall in output is much more, well, maybe not much more. I'm working on a different calibration, but it's smaller. The output fall is smaller. And again, what we can see if we look at the difference in the effective capital charges is that countercyclical buffers are basically shrinking the difference between the effective capital charges in each sector. In terms of how the buffers do at preventing banking crisis, well, let me say that the capital conservation buffer of Basel III does a good job. So in the baseline calibration, this banking crisis happened 3% of the time annually. And basically in Basel III, we are cutting that frequency to roughly half. But in terms of the output losses in the event of a crisis, then essentially the buffer that works best at cutting those output losses is the sectoral CCYB. Notice that perhaps I was surprised when I did this that it's important to aggressively relax the buffer on the corporate sector, as well as tightening the buffer on the real estate sector. So basically, that's the main result. Sectoral countercyclical buffers can be effective tools. Let me just conclude in order to keep with the time. So the key message I think of this point is that of this paper is that increasing just the level of risk-sensitive capital requirements can lead to more severe reallocation episodes in the sense that bank capital, the scarcity of bank capital can become more important. And in contrast, if we also allow for a dynamic approach in which there is a timely correction of the distortions by perhaps reducing the differences in effective capital charges by adopting the sector-specific type of buffers, we can achieve large stabilization gains. And going back perhaps to the initial motivation of the paper, I think that one final message is that the microprudential design of bank capital requirements can indeed exacerbate the reallocation of credit towards real estate in the build-up of vulnerabilities in the financial sector. Okay, so let me stop here.
Thank you. Also discussing this paper is Pedro Guete from a university.
So thank you very much first to the organizers of the conference for inviting me to discuss the paper. It's a very nice paper and creative. I have to say I like it a lot because it gives an opportunity to think on the two reasons for this conference, right? Because this conference is called Financial Stability, and after up to the financial crisis, it was a micro conference because basically financial stability was macroprudential regulation. After the crisis, the financial crisis, then we start having this new word, macroprudential regulation, and now the conference, probably Rafa, Angel, they struggle to put papers on both dimensions, and I like this paper because it creates an opportunity for a shock between the two. Okay, so the first I'm going to classify what I call macroprudential, and I found this figure in the New York Times that I found super cool, because to me the sufficient statistic of macroprudential is basically bank failures. That's kind of the variable I think is is key to measure the classical banking regulation. Well, when you see this, you notice that at least in the US, supervision, it made some mistakes, right? It's kind of, we had previously here J. Powell, but when you see that the level of 2023 is kind of, in terms of, you see the billions of dollars there. So this is showing you this macroprudential approach, but something I found interesting is that even if you notice that, look, really we had a big banking crisis, the macroprudential approach is going to be different. And when you think on the banking regulation, the micro approach, you see there are two key variables, right? One is the probability of default, the other is the loss given default. This is kind of the two classical variables. And if I was checking the Basel framework, how to compute capital requirements, and when you go through all the formulas, you see formulas like this in which there are many other variables, but you always see this LGD, loss given default, probability of default. There are different ways to compute the risk-weighted assets, but this is the interesting thing of this microprudential approach, is that these two are these key elements, and real estate in these two elements is kind of a safe type of credit. Okay? But when you go to macroprudential, that to me the sufficient statistic is house prices. That's the key variable that macroprudential regulators, I think, need to keep tracking. In fact, if you follow what happened during the financial crisis, you see this big drop in house prices. Recently, we didn't have any big change in house prices. That's why I think the recent banking crisis of the US so far didn't go so much into the economy. Okay, but what you see is that real estate sector is key on the macroprudential. This is another set of very nice pictures. The previous was the New York Times. This is Yale. Yale have a web page where you find, in my opinion, the best pictures of the financial crisis, house prices. This is the evolution of types of credit that you see at all the crisis was basically mortgage debt. And these ones that get super sophisticated but super cool. All the things that the US government had to do, okay, during the global financial crisis. You have here this measure of the LIBOR OIS stress in the system, okay, and you notice that this is basically, I think this figure created macroprudential regulation. It was obvious after this crisis that we have to change the approach to financial stability, and this created that part. And now coming back to, and then you start having all these new words, that is what creates macroprudential, right? It's fire sales externalities, collateral externalities, financial accelerators, bubbles, and housing real estate is key on this. Okay, it's an asset that is behind. You have the papers of Jacobello, all this literature in which, but real estate was before, I'm pretty sure 20 years ago, I don't know, in this conference, before the financial crisis, there were very few papers on real estate in this conference. Now I'm sure that the past years, real estate has become a mainstream of the conference. And then going back to the paper, I think what is a great insight of Max, I'm going to shorten your name, okay, of Max, is that he says, look, there are two things here going in opposite directions. Real estate credit defaults usually less. In case of default, the losses given default are smaller because, for example, foreclosures is not the same than a company. Assets of companies are much more specific, so if you close the company, it's harder to sell, but you foreclose on a house and you sell the house. So what it happens is that from the micro perspective, the real estate credit ends up having a better treatment than the corporate credit. But at the same time, like the previous picture show, real estate is at the center of all the macroprudential risk. And then I went to look in the data, and there is this very nice paper from the Central Bank of Ireland, I don't know if anybody is here from there, in which basically they took all the different types of credit in the economy, and they tried to compute what's kind of the capital weight that they applied. And unfortunately here we don't have a big screen to highlight, but if you see the NFC, this is the non-financial credit, then you see the mortgages next to it, and you can see the numbers, right? It's between 51% and 31%. And I think this was the brilliant idea of Max, is to see the macroprudential approach treats real estate in a beneficial way, when in the macroprudential is kind of probably the enemy you have to control. Okay, and then Gallo gave 3 comments. I'm going to put 5 comments here. Okay, so the first is that, now going back to his paper, I tell you, I think it's a very brilliant idea. The first thing is that the paper, I think, has to clarify much more how the model is working. It's a complex model, and I think we need to have input response analysis to understand very well the propagation mechanism. And then real estate it's complicated because now we notice that it's the collateral to many things, especially also for corporate credit. We have a new literature here. There are different papers on this showing that it matters for companies, for entrepreneurs, for many things. And this is telling you that it's not going to be clear, okay, when you model the value of housing, because it matters for both. Housing, that has wealth effects, many other effects, but also for corporate. And I think it's going to be key that you model different ways to see how your results depend. The second one is that Max spends some time on the calibration. I think when you take on this paper, that came to my mind, and these papers, I didn't see them in your paper, that's why I put them here, is there is a new literature studying the crowding out from real estate towards commercial. And if you see papers like this one of Chakraborty, they have these very nice impulse responses in house prices, how they change credit in corporates. I think this paper is kind of a DSG model. It should be calibrated with matching input response analysis, something like that, to match this. I think that will make the paper very credible, because I think at this moment, credibility of the quantitative, we have a million ways to calibrate, and depending on what the governor of your bank tells you, you can get one result or the other. But if you match these kind of figures, I think you get more credible. Then the paper is focused, and it's really a paper focused on minimizing crisis. All the paper is, you see, evaluation of Basel III, and if you see the x-axis is, do you have a banking crisis, what happens before or not? And I understand that regulators, usually you never get credit for the crisis that didn't happen, but I think we need to have, since I'm in academia, I think we need to do analysis out of crisis to evaluate regulations. We need to compare GDP, and maybe some crises are healthy in capitalist economies. I don't think it's good to minimize all the crises, because we know how to minimize crises. In some Soviet countries, they don't have so many crises, but there is a price on growth. I have a paper on this. So I would put much more to do this analysis of regulation out of banking crisis versus minimizing banking crisis. At least the focus on the paper. Okay. Then, to me, when you think of macroprudential of housing markets, now the key variable is LTV regulation. There is this very nice paper of Benetton in the Journal of Finance showing that there are relations between loan-to-value and capital requirements. And here you have the first paper. I have some kind of general equilibrium to study these things. And I think maybe macroprudential regulators, they need to know these two tools, right? You have a new tool in the army that before you didn't have, LTVs. And then you have the capital requirements. And maybe you don't want to operate through capital requirements, and you want to operate through loan-to-value. And I think maybe you can contribute to this. That seems to me a very interesting question. And then to conclude, okay, we have here in the Bank of Spain, Sergio and Rodríguez Monero and Raschedi was here. And something very important when you take, especially for policymakers, is the role of appraisers. And I think this in Spain has been very important topic, is that basically what happens is that all these regulations that depends on the value you assign to the house, if you change the value of the house, this has implications also for the capital requirements that the banks have to have. Okay? And in these papers, they show this. The Spanish banks, by having maybe distorted appraisers, distorted valuations, well, maybe they have been savings on the capital they need to have. And I think this for regulators is a first order. Maybe in the US, appraisers are much more strict. I think this depends on the countries, but at least I guess, especially in southern Mediterranean countries, in which sometimes things are more tricky. I don't think this should be in your paper, but since this is a policy conference, I thought that this was very important to think, because this paper shows it there. You see this kink, okay, on how appraisers behave, and I think that's very important. So to conclude, is like I found this paper very creative. I think it's a very promising paper. It's still, you see, Max is still a very young guy. Has time to write this paper, maybe more papers. I wanted to give you ideas, and I enjoyed. So thank you for the paper.
Thank you. Max, you want to take a time to answer?
Yes, thank you. Well, thank you. I have only words of gratitude towards this very constructive comments. Maybe a few comments on what you said. You mentioned the complementarity between real estate and corporate credit. I think that it is indeed. I think it is indeed crucial. Actually, well, the paper is calibrated using residential mortgages, but we know from the experience in Spain that commercial real estate credit also had a major role during the crisis. So exploring a different approach, or perhaps a different strategy in the calibration that would allow me to also include the role of collateral in the corporate sector would be very important. And then you mentioned loan-to-value regulations. This is something that this is a comment that I have received before, and that is, I think we don't have right now a framework that allows us to study simultaneously capital requirements and borrower-based measures in the same analytical framework, and I think that would be a great contribution for the future. So, thank you.
Thank you. So we open now the floor to questions. Here, David.
Thank you, Max. Super interesting paper. Two questions. One is, I think, not so much about the paper, but I would like to pick your brain on it, is how much of this, sort of high fat tail is a structure of the housing market, or is a decision of banks? So let me put it in other ways. Could it be that if I lend to intermediate loan to income or intermediate loan to value, then I wouldn't have this sort of fat tail that you model? That would be one question. Or do you think that there's no way around this? This is a structural feature of the housing market that's always going to be subject to that problem? Because I think this then has effects on what you want to analyze. And then I catched something that I hadn't seen before, and I would like you to comment on, if possible, that is the effect that this has on housing default, on borrower default. It looked like there was, maybe I skipped, or maybe I didn't see it correctly, but it looked like in your proposed better measure, the sectoral countercyclical capital, it looks like there's a boost in the default. It goes from 0.81 to 1%, but maybe I'm wrong. So if there's something that happens there in the default, why am I saying this? Because if you're thinking about a welfare type of model, which I think you've been pushed to that, and I think it's a good thing, then this cost can be a very big cost to take into account. If this is affecting, households' default in some way, then yes, you have a safer banking industry. That's great. The model is tailored for that. But if I'm pushing 25% more of the households into default, then maybe I'm having some problems there that, are something to take into account.
Okay, so if you want to answer.
Okay. Thank you for your questions, David. So, in terms of the risk characteristics of the real estate sector, I think that's a great question. I don't have I think I don't have a good answer, but if you think about the corporate sector, then you have different industries. You have diversification there in an extent that maybe in the real estate sector, in the end, it's still housing, no? So it's still one sector. So I would tend to think that there are still some inherent features of the sector that make defaults there more correlated when they happen, when they materialize. As to the second point, well, yes, you mentioned that under different regimes there may be different average probabilities of default. This may be a consequence of one of the figures that I was showing before. In the sense of how leverage is determined in the optimal contract. It may be the case that yes, okay. So it may be the case that you have safer banks due to the higher capital requirements, and still you have some riskier borrowers. That can happen. That can happen in the model. Whether it is, I have some preliminary welfare numbers. There are still very small welfare gains if you move from one regime to the other, but there are bankruptcy costs that would be associated with housing default that would be higher under that regime. Yeah. Okay.
Well, thank you. And we now move to the last paper in our session. Tamon Takamura is going to, from Bank of Canada, is going to present it. Oh, sorry. Thank you.
Okay, thank you very much for giving me this wonderful opportunity to present our work today. I'm going to present banking dynamics, market discipline, and capital regulations. This is a joint work with Victoria's Rule and Yas Terajima, and the usual disclaimer applies. So this is another paper about the countercyclical capital buffer, which is a time-varying capital requirement in Basel III. As Diana mentioned this morning in her discussion, this regulation addresses the procyclicality problem of constant capital requirement, which could go against stable loan supply across financial cycles. This is because if capital requirement is kept constant, it effectively becomes more stringent during financial downturns when banking funding conditions become tighter. But by reducing capital requirements in bad times, CCYB could potentially alleviate this problem and help smooth bank credit supply over time. In Canada, CCYB is implemented under a slightly different name under Pillar 2, and it was introduced in 2018 at the level of 1.5 percentage point. So this means that banks at that time had to maintain at least 13% of capital ratio, which could have gone down to 11.5 had the buffer been released. So in this paper, we want to understand to what extent this kind of time-varying capital requirement, when it is released, affects the banking industry in Canada. And another motivation of our paper comes from market discipline, which is viewed as an important external force that complements capital regulations in Basel III. Market discipline is promoted through disclosure requirements on banks under Pillar 3, and it is expected to facilitate the pricing of individual bank risk by investors to limit banks over borrowing from the wholesale market. So both market discipline and CCYB have important implications for banks' decisions to take leverage, and in this paper we want to understand the interaction between these two objects. And based on these motivations, we pose broadly two different questions. The first question is, what's the impact of releasing CCYB through a great financial crisis-like episode? We want to understand the average impact on bank credit supply and the probability of bank default. We're also interested in the heterogeneous policy impacts across banks with different capital ratios. The second question of our paper is, how does market discipline change the way banks react to CCYB, and are there any heterogeneity around banks' reactions? And to answer these questions, we develop a dynamic model of the banking industry with heterogeneous banks, and we simulate that model to quantify the impact of releasing CCYB. And I'll come back to the basic features of the model and how we do simulations in a later slide, but I want to show you the main results of the paper for the interest of time. So regarding the first question, we find that a release of CCYB indeed helps smooth credit supply and probability of bank default, and these are the intended consequences of this regulation. Quantitatively, we only find small impacts of releasing the buffer if the buffer size is as small as 1.5%, which was the case when it was initially introduced in Canada. This is because banks on average hold private capital buffers above the regulatory requirement to avoid violating the regulatory minimum. But if this is the case, then larger buffers would have a larger impact. And indeed, we find that
5%, releasing the 5% buffer would have a larger impact through a counterfactual simulation. Regarding the differential policy impacts, we find that the impact varies across banks, especially there is a larger impact on low capitalized banks. These banks have almost no private capital buffers prior to the crisis, so even a small release of the buffer has a more visible impact on them. For the market discipline, we find that market discipline raises capital ratios in normal times through precautionary motives of the banks, which helps soften the impact of the crisis if it happens outside of the stationary state. However, market discipline could be a double-edged sword. When a crisis happens unexpectedly, market discipline could increase the rollover risk in the sense that it becomes too costly for banks to roll over their debt while remaining solvent. And as a result, even large and well-capitalized banks could become vulnerable to a crisis shock if they have a large amount of wholesale funding on their balance sheet. So what's the contribution of a paper? Relative to many other papers on CCYB in the literature, I guess our contribution is in the analysis of the interaction between CCYB and the market discipline. And we use a dynamic model of banking industry with heterogeneous banks to do this. And our model can speak to precautionary motives of banks, dynamic risk associated with wholesale funding, and also the impact of the buffer size on the effect of releasing CCYB. So let me talk briefly about the basic features of a model. A model is a heterogeneous bank model in which aggregate states switches stochastically over time between normal and crisis state, and each bank incurs idiosyncratic long failure rate shocks, which gives us a distribution of banks. While these shocks are exogenous in our model, the individual decisions of banks whether to default or not is endogenous. And this endogenous bank default probability determines the risk premium on banks' wholesale funding. So for example, if a bank decides to increase its leverage through wholesale funding, its default probability increases, and the amount of discounting on the wholesale funding increases, and that limits the amount that bank can raise from the market funding. And that's how the market discipline works in our model. But even though we have market discipline on the wholesale funding side, our model also features retail deposits that are given exogenously at a constant rate. So this gives rise to an inefficiency from moral hazard due to limited liability, and thus a rationale for having capital regulations. This is how the balance sheets of banks would look like. They invest in long-term illiquid loans, which are funded by insured deposits, wholesale funding, and their own equity. And banks can issue their own equity with some costs. And banks must satisfy capital requirements, including the time-varying capital component. So using this model, we simulate it and evaluate the dynamic impacts of releasing CCYB. And the way we do the simulation is to first calibrate the banking industry to 2017, right before the CCYB was placed in Canada at the level of 1.5%. And we assume that the industry is in a stationary state, meaning that banks anticipated the probability of a crisis, but the actual crisis has not happened for a long enough time. So this gives us a stationary distribution of banks, which we can use as a starting point of simulation. And then we assume that the crisis happens in years 2 and 3, in which the average loan failure rate increases by 50%. The crisis dissipates after year 3, and the industry gradually reverts back to its original stationary state over time.
And even though we use this particular crisis recovery episode, this is different from a perfect foresight simulation because banks only know the transition probability of shocks, and they learn where the economy stands as shocks are revealed over time. And using this scenario, we simulate aggregate dynamics and analyze impulse response functions to evaluate the impact of releasing CCYB. In particular, we compare two different policy scenarios, one in which the CCYB is not released, which is represented by the blue line, where the capital requirement stays at 13% all the time, versus when the CCYB is released during the financial crisis period in years 2 and 3, so the capital requirement goes down to 11.5, and the difference between the two can be attributed to the policy impact. And to understand differential policy impact, we keep track of 3 different bank groups. The top 10% groups, the bottom 10% groups, and the average, the industry average, all sorted in terms of capital ratios in the initial distributions. So let me now talk a little bit about the impact of market discipline before a crisis happens. This table shows some statistics from the stationary distribution under a baseline scenario of 1.5 percentage points CCYB. As I mentioned earlier, banks are required to hold at least 13% of capital ratios, but they have some private capital buffer above that. And in the left-hand side column, this shows the case with market discipline, and the average capital ratio is 14.64%. On the right-hand side column, that number declines to 13.85%. So without market discipline, banks take more risk, and as a result, bank insolvency rate is higher. So market discipline in stationary state makes banks more prudent and hold more capital, and it is in this sense that market discipline reinforces CCYB in normal times. But market discipline is not countercyclical, so it could have an opposing effect if a crisis happens outside of this steady state when a shock happens. And that's something that I am going to mention in a later slide. But before that, let me show you the dynamic impact of releasing CCYB of the size 1.5%. As I mentioned earlier, I keep track of 3 different bank groups. The top panel shows the top 10% groups, the middle one is the industry average, and the bottom panel shows the bottom 10% groups, sorted in terms of capital ratios in the initial distribution. So let's look at the middle panel, which shows the industry average. The panel shows that the capital ratios of banks decline during the crisis periods in year 2 and 3. This is because the average loan failure rate increases during this period. And the decline in the capital ratio is larger when the buffer is released. This is because banks are allowed to take a higher leverage. But even though the total capital requirement goes down from 13%, which is indicated by the solid line, down to 11.5%, which is shown by the dashed line, banks are not using that extra space created by the regulation. A part of the reason for this is that they hold private capital buffers before a crisis happens, so that helps them absorb some of the negative impacts of the crisis. But also, they want to maintain some margins above the regulatory requirement. So when the buffer is small, the headroom is too small for them to utilize that buffer. In contrast, low capitalized banks on the bottom panel, they almost have no private capital buffers at the beginning, so even a small release of buffer helps them absorb the negative impacts of the crisis. So in this way, our model can capture differential policy impacts of releasing CCYB depending on the capital ratios of banks, and this will help us understand the impact of the policy on new loan issuance and the probability of bank default as well. So let's look at the new loan issuance. On impact of the shock, in the middle panel, in year 2, the new loan issuance tanks, and a release of the CCYB, shown by the difference between the red line and the blue line, mitigates the decline in the new loan issuance. And this is the intended consequence of the regulation, but the mitigation impact is limited to less than 5 percentage points relative to the overall decline of 60%. In contrast, low capitalized banks on the bottom panel, their mitigation impact is much larger, almost exceeding 10 percentage points. And this difference reflects differential policy impacts on capital ratios that we have just seen in the previous slide. A similar pattern holds for the probability of bank default. On impact of the shock in the middle panel in year 2, the probability of bank default increases. A release of the buffer helps reduce the increase in the probability of bank default, and the mitigation impact is quantitatively larger for low capitalized banks on the bottom panel for exactly the same reason as before. Going back to the middle panel, this picture also shows the cost of releasing CCYB. Allowing banks to take a higher leverage during the crisis periods means that banks become riskier. So this manifests itself in the form of higher probability of bank default relative to the case when the buffer is not released in the following years, for example, in year 3. And this is the cost that the regulator needs to weigh against the benefits. So far, I have shown you that when the buffer size is small, then the quantitative impact of releasing a CCYB is limited. This picture shows that when the buffer size is increased to 5 percentage points, it has a larger impact. This is because banks are more willing to utilize the headrooms given by the release of the policy. And interestingly, in Canada, the financial regulator increased the upper bound of the time-varying capital requirement from the previous level of 2.5% to 4% earlier this year. And I'm curious to see how this increase of the buffer has some real impacts down the road if they need to release it. The final slide that I want to show you today is the dynamic impacts of market discipline when the CCYB is released. In principle, market discipline should make banks safer by inducing them to build up a higher buffer prior to the crisis. So when the crisis happens, they should remain safer. And indeed, that story holds on average. As you can see from the middle panel, the probability of bank default with market discipline, shown by the solid line, remains lower than the case without, which is shown by the dashed line. But if we shift our eye to the top panel, on impact of the shock in year 2, market discipline makes even well-capitalized banks more vulnerable to a crisis shock. And this sounds a little bit counterintuitive, but what's happening here is that these are the banks that have a lot of wholesale funding relative to what they need for new investments to sustain their large balance sheets. So there's a lot of rollover risks involved for these banks, and they're aware of it, and that's why they're well capitalized in the first place. But even so, when a low probability event like a crisis happens, they have difficulty rolling over the debt because market investors are sensitive to a higher risk of bank default. So I guess I'm running out of time, so let me wrap up. Our analysis confirms the intended benefits of CCYB through smoother credit supply and bank insolvency dynamics. But the average quantitative impact depends on the size of the buffer and also how much capital ratios banks have prior to the shock. Regarding the market discipline, it has two opposing effects. It complements CCYP by inducing them to hold a higher buffer, but for banks holding a larger wholesale funding, they could have a larger rollover risk, and that could work against CCYP. Thank you.
So discussing this paper is Javier Suarez from CEMFI.
Thank you, Veronica. Thank you, whoever is responsible for putting me in the program. As a discussion of this paper that touches on my one of my research fields very, very closely, it's been a pleasure to read the paper, even if a little bit in a very busy period. I apologize in advance for potentially too linear type of discussion, where I will spend most of my time with the overview of what is in the current version, but I will drop, as I advance, some of my reactions, and then at the end I will have a list of comments. So this paper, as Tamon has shown us, proposes and calibrates what I will call an ambitious industry dynamics model aimed to jointly analyze the effects of counter-cyclical capital buffers like the CCYB, what in Canada is called the domestic stability buffer, and market discipline. Well, this is a little bit peculiar, I found, because I think that analyzing one of them will have been enough, but somehow you play with the variation of on and off market discipline, understood as a wholesale funding that is either priced according to the risk of each bank, or otherwise, like if this market funding, I understand, were sort of insured the same way deposits are insured. So indeed, this is an important source of market discipline. Now, the model features bank heterogeneity, bank default, and distributional dynamics. So all this is computationally demanding. At the same time, as I was emphasizing in my first sentence, this is an industry equilibrium model. Is not a dynamic stochastic general equilibrium model. The cyclicality is captured by the evolution of an exogenous aggregate state that moves up and down. And actually, the elements of industry equilibrium in the model are very limited. It's almost aggregation of individual dynamic optimization problems, and I try to explain that there. The banks are subject to both idiosyncratic shocks to their defaults on their loans, as well as some type. Banks can be of a type that makes them large or tend to be large, and or some type that tends to make them small. So they transition individually across those states, but at the level of the industry, the only feature that is equilibrium is the entry and exit. There is endogenous exit, but then the assumption that the exiters are replaced by entrants. And then the other market price in the model is the price of wholesale funding, but this is individually done at the level of each bank. So I will say that the strength of the paper is at solving a dynamic optimization problem for the banks, very much like the first paper we saw in this session, and then looking at industry-wide implications by aggregating across essentially a number of individual histories. Now, something that, as I say in the comments part, but I can anticipate now as I just explained the ingredient, something that makes me a bit nervous of the current formulation is what I will call a shortcut in the modeling of the other side of the market. So these banks are operating in partial equilibrium,
in the sense that instead of feeding with their loans the supply of a market for loans where there is a common demand for loans, or extracting or taking deposits from a market where there is a supply of deposits, each of them is endowed with a fixed amount of deposits, and then each of them faces convex, or eventually convex, it's actually more convoluted than that. It's first concave, then convex, cost of originating new loans. That is the way to close the model as for how many loans the banks want to make. In my view, I mean, maybe after experience as quantitative macro banking person, what this is doing is sort of substituting the calibration of a market demand for loans and a market supply of deposits that the banks are accommodating, and where, if you were doing that alternative instead of the pure individualistic bank alternative or shortcut, you will be able to see that banks not hit by a shock replace in the supply of loans or in the demand of deposits banks that are hit by a shock. This is totally mis, and is sort of mysteriously, in a sense, moving up and down in the model due to how the particular cost of loans origination and also cost of issuance of wholesale funding is both formulated and calibrated. Now, I think there is a lot of analytical modeling and computational merit in dealing with heterogeneity. Heterogeneity is a reality. So when you see banks in an industry, you find lots of heterogeneity, different capital positions, different sizes. I think the model is trying to capture that, and you are in good company, because basically there is the very recent econometrica paper by Erasmo, right, and Corvée, and a few others, but you are there, and I think this is something to be seriously taken into account. At the same time, in the current version, I'm not convinced about how this is calibrated. I don't know how much empirical discipline you are using to make sure that the distribution of funding needs and the distribution of loans that the model generates sort of replicates the distribution in the data, and perhaps more importantly, given the black boxy modeling of the cost of generating new loans and the cost of accessing wholesale funding, I would like to see that the model is able to replicate how this distribution moves when the industry is hit by a shock, by a negative shock. If you were able to do that, I mean, this will be like the next econometrica paper in some sense, right? So please take my comments in terms of that type of ambition. Now, in the model, there is dynamic optimization. The banks are interested in maximizing the utility that their owners derive from dividends. There is, as I said already, wholesale funding. Then there is new loan origination, and this is subject to constraints. And here, of course, is where the policy analysis enters. The constraints banks are subject to come from capital regulation, and the paper is also quite original relative to the literature in considering not just a minimum capital requirement that will be sort of binding all the time, but what in the regulatory reality will be called a combined buffer requirement. So which includes buffers that, as discussed earlier this morning, can be used. But maybe banks don't want to use, but can be used in the sense that eating on those buffers does not violate the requirement, is still compatible with the bank operating. So in the model, you assume that when the capital ratio of the bank is between what in my slides is theta lower bar and theta z, where z is the aggregate state of the economy, what the bank cannot do is pay dividends. And this is very realistic because this is the maximum distributable amount restriction associated precisely within the buffers in the Basel III wall. So I think this aspect of the modeling I like very much, but maybe what I don't like, or at least I was a little bit perplexed, is the current calibration. Because in the current calibration, as you justify, you have these state contingent values for the upper requirement, so the one that includes the regulatory buffers, realistically calibrated, but then I saw that your theta lower bar is 0, so which means that in practice you are allowing banks to violate the minimum all the way down to 0, and the only thing you are doing is restricting their dividends to not be positive in that big area. No? So when I thought about the formulation, I thought the natural choice for theta lower bar would be the regulatory minimum of 8%. Maybe the code doesn't solve with that, and you are still trying to find the proper, in a sense, way to deal with this. Now, since I'm running out of time, let me not summarize the sequence of results that you were finding. And as I anticipated already, most of my comments there focus on the very last. So I think that the most important learning that we can extract from this type of ambitious project, apart from the part dealing with heterogeneity, is the dimension of dynamic optimization, something which is shared with the first paper in the session. And to me, there is a sentence in the calibration section, page 12, which is a sort of a killer, because you say that the paper performs very well in terms of matching model moments with data moments, except for a few moments on dividends. You know, and endogenous dividend policy is the most unique aspect of your dynamic optimization, and is the one that could interfere with the willingness of banks to use or not use their buffers, which I think is key to the effectiveness of the counter-cyclical capital buffer. So you see there, the right column is the model. The model has twice as big as in reality dividend ratios, plus, but more importantly, 3 times or so more volatile dividends. So what happens in this model effectively is that banks don't smooth dividends. And this can be seen, this is the effects of the policy of introducing the CCYB at 5 percentage points versus not having it at all on bank lending. Okay, there is some smoothing thanks to the buffer, but we see that the capital ratios are significantly reduced when the capital buffer is released. So banks are using the buffer, but they are using it to reduce their dividend cuts. So in the baseline economy without the buffers, in your baseline calibration, when the negative shock comes, the average bank fully cancels its dividends. This, unfortunately, banks don't do in reality unless they are forced. So in your model, when you release the buffer, they cut the dividends by half. But this doesn't translate into more lending. Basically, they use their buffers to keep their dividend policies. So I think that if the model could do better on the dynamics of dividend around crisis, then it will be great for assessing the counter-cyclical capital buffer. Thank you very much.
Thank you. Tamon, do you want to take a few minutes?
Thank you very much, Javier, for your very insightful comments. I take all your points, and we do think that we need to improve upon the dividend part of the model. I think you're right that the calibration a little bit misses in terms of matching the dividend distribution in the stationary state. And I think that's partly because we only hit 1 year as a sample, but we may need to take a longer average of the data, and that way we may be able to have a better outcome. And also dynamically, you're right that the dividend movement is quite large in our model, but in reality, the regulators pose restrictions on dividend payout when it's released. So that's currently not existent in our model. So if we impose that, then some of that would go to the new loan issuance, I guess. Regarding the regulatory limit of 0%, so we have two regimes, one in which the 8% capital requirement is important, but once we assume in the fashion of the prompt corrective action in the US, once they violate that 8% requirement, then the regulator steps in and restricts the discretion of banks to pay out dividends. So it gives them a chance to recover under some restrictions. So that's what they do in our model. And also, I agree that Kobe and the Erasmus paper made a significant advancement in the banking industry model. And relative to that paper, they endogenized many of the demand side. And that's something we may need to think about in the next revision. Thank you so much.
Thank you. So now we open it to the floor. Rafa and David.
This is just a question that I didn't understand very well. How does market discipline operate in your model? I mean, a bank that changes the risk profile, say by paying dividends and reducing the capital buffer, then the debt investors outside adjust the cost of their funding? I mean, what do they see in order to be able to modify the price of the debt?
Hi, Timon, thanks a lot. This is sort of a similar question that I already posed. You know that we have time, let me pose it. So I would be interested in understanding how much, when you talk about the buffer release of the 1% to the 5%, how much is this an absolute or a relative term type of thing? So if we want to have an impact, it looks like, given the current calibration, that will change, I guess, in the future, but it looks like you need this 5% to have reasonable effects. But this is because this is 50% of the base level, or this is because you need a 5%? So, you have an 11% base capital that you're releasing, from 16.5 to 11, or is it, if you would have, for example, from 10%, you would only need, 3% or something like that? So is there a relation between the levels and the absolute, or is it a relative term? That's basically.
Okay, so.
Any more questions?
One more?
Sure.
Okay, so the market discipline works as an extra premium on wholesale funding. So when the bank decides to increase the leverage, market investors know that it's going to be more leveraged and more risky. So, so it's like the 1 minus the default probability divided by the risk-free rate. So when the default probability increases, banks are facing a higher discount rate than the risk-free rate. So the amount that they can borrow from the market investors is going to be discounted by that amount. That's how the market discipline works in our model. And regarding your question, so we assume that the buffer is fully released. So if it's 16.5, then it's fully reduced down to 5%. So I guess it's a matter of the relative decline in the capital buffer that matters.
Well, I thank here the authors and the discussants for a great session, and we have half an hour for coffee break, right? Thank you.
You're the very last.
Exactly, right. When I go there,
so it's that level,
they would know.
From time to time I forget.
So I think it's time to start the last session of this day. I know it's been a long day. We started very early in the morning, and but I think the session is really very interesting session. Topical issues, great papers, excellent speakers, and amazing discussions. So I think it's really worth the effort we are going to do over the next 2 years, over the next 2 hours. Next 2 hours. So I'm really delighted to chair this session, and the first paper is going to be presented by Patrick Cohen from Toulouse School of Economics.
Thank you. It's a pleasure to be here. So this is joint work with my brother Jamie, who's at Imperial. He also has an affiliation with the Bank of England, and we use Bank of England data, so the usual disclaimer applies. Now, this is going to be, as you see from the title, a paper about the interbank network. And sometimes people say interbank network and they mean very specifically short-term lending, but we intend it here more broadly, more generally. So any direct interconnection between banks through lending or through derivatives. So any direct interconnection. And the trade-off is a fundamental one in almost any setting of regulation, which is how do you keep the good and get rid of the bad? So the good here is that there are some gains to trade. So if you think, for example, about lending, the bank being lent to, maybe they manage their liquidity risk in some way, or they're able to fund some profitable project, and because of that, they're willing to pay an interest rate to the lender. So there are gains to trade. That's the pro. The con, as we're all familiar with, is counterparty risk. So maybe the person to whom I lend does not give it back to me, which can aggregate across the network into systemic risk. This is a quotation from Janet Yellen, but actually Jay Powell this morning said something very similar about there being trade-offs to any type of regulation. So ultimately, what I'm going to be building towards is tweaking existing regulation to improve exactly this trade-off. To get there are a few intermediate questions. So how does contagion work? How is the network formed in the decentralized setting? How does existing regulation work? And then how can we tweak it? So these are our findings, but given that it's a short presentation, I won't go through them in detail now, but just as a direction of travel, what I'm going to try and persuade you is that there's good reason to believe that contagion is heterogeneous across banks, and given that we're in a network context, even heterogeneous across bank pairs. And the regulation change that we're going to build towards tweaks existing regulation according to that heterogeneity. So we're not going to have anything to say about the level of capital regulation on average, for example, but we are going to propose a tweak that increases capital regulation slightly for some connections and decreases it for others. So that's what we're aiming for. So the way we do this, again, this was in the title, it's a structural econometric approach. So I'm going to spend a few minutes on the data, then the model, then the estimation, and then the counterfactuals. Their data is Bank of England data on aggregate counterparty exposures. So you see they started collecting it after the crisis, obviously, and stopped in 2018 because people weren't using it in a regulatory setting. But effectively, it's self-reported aggregate exposures. So Goldman Sachs, for example, is saying if JP Morgan were to fail tomorrow, this is how much I would be out across all the different types of relationship I have with JP Morgan. So derivatives are a large portion of this, but also debt and various types of securities lending. It is infrequent, so it started off being collected every 6 months, then it moved quarterly. So both T and N are small, but given that this is a full network, the number of data points is reasonable enough to do empirical work on it. One important clarification,
This is a good, or perhaps the best in the literature, view of what is below the waterline in terms of this iceberg of interconnections, because there's a lot out there that looks at interconnections in very specific settings, overnight lending, CDS contracts, for example. So this is a good view of what's under the waterline, but it isn't perfect. So the data is incomplete in certain respects, which we take seriously in the paper, but given that this is a short presentation, I won't go into detail here. So this is what it looks like. Now, these are big global banks. So what we effectively see is the core of the network. So the main thing that jumps out here is the density of it. So the nodes around the edge are the 18 banks. The size of the circle is the aggregate incomings to that bank. The width of the line represents the size of the exposure. And then you'll see some lines are solid and some are dotted, which indicates whether there's an exposure that goes both ways or only in one direction. So it's very dense. We don't see the sparse periphery. It's only about the core that we see. So on to the model, where, again, it's worth bearing in mind that the model is intended to get at this trade-off between risk and some gains to trade. What we have is a simple model of counterparty risk. So this is a spatial autoregression, a SAR, which is a workhorse network econometric model that basically relates outcomes, so in this case bank default risk, to a bank's fundamentals, its exposures to other banks, and the risk of its counterparties. So, this has been used in finance, but also in many other contexts. So one example I might come back to later is maybe the outcome is test scores. The measure of spatial proximity instead of an exposures network is where people sit in a classroom, and the fundamentals is exam performance or intelligence or something like that. So it's used widely. It is mediated by a spillover parameter that governs how intensely contagion occurs. And we're going to allow this spillover parameter to be heterogeneous in various dimensions. So across pairs in some cases, or in a more simpler parameterization in others. Now, there are many reasons why this could be the case. The most obvious is risk sharing. So I lend the same amount to one bank and to another bank. They are equally risky, but we share risk in some better way, and that bad states of the world for them are good states of the world for me. But there are also other reasons. It could be about the jurisdiction, it could be about the volatility, it could be about the type of exposure, so how much of it is debt, how much of it is derivatives, for example. So there are many reasons to expect this parameter to vary. Then network formation then is going to involve supply and demand. So banks are going to supply exposures, so to lend, in its simplest example, in order to earn a return. They pay a cost to do so, and that cost is going to be a function of two things. One, regulation, capital regulation, which mandates how much equity I need to raise. And two, the risk of the bank supplying the exposure. So you can think about it as regulation being the amount of equity I have to raise, and cost of equity being a function of bank risk. So that is the relationship between counterparty risk and network formation. Then on the demand side, banks demand exposures, they demand funding, if one thinks about it purely in terms of lending, as heterogeneous inputs into a production function. So I'll show you a few equations, but I'll go over it quickly. The only notation you need to know is the following. So C is going to be the size of the exposure, the aggregate exposure. So Cijt is the total exposure of I to J at time t. P is then the default risk of bank I at time t. X is its fundamentals, so something that is purely about that bank and is not through the network. And then gamma is going to be this spillover parameter, which we allow to be heterogeneous. So here then are the equations I'll show you. So that first one is the SAR, the spatial autoregression. The outcome P is a function of fundamentals plus a term that depends on bank I's exposure to other banks, the risk of those banks, and then this network spillover gamma. On the supply side, so in terms of how C, equilibrium C, depends on P, banks lend across a portfolio of options. They are paid an interest rate R, and they pay this per unit cost, which, as I said, is a function of regulation and their default risk. I haven't shown you the first order condition here because it's involved, but you can see by looking at the equation above it, when they take as given the default risk of other banks, then the marginal cost of supplying a bank depends on my risk, their risk, and this intensity of contagion parameter, the gamma ij. Then finally, to close the model, all we need is something that pins down R, the interest rate, where we have linear demand with differentiated products. Differentiated because there's quite a lot of heterogeneity in terms of exactly what type of instruments make up this aggregate exposure. So you can think of the first part of that bottom equation there, the psi ij, for example, as a proxy for technology. Bank I simply needs the types of exposure that are supplied by Bank J and gets some incremental payoff from that. We then allow some form of substitutability which is embedded in the theta, which we're going to relate to this variation in characteristics, but isn't particularly important. So basically what this is it turns a question about how risky banks are into a question about cost. So when a bank lends to another bank, it takes into account the fact that in doing so, it becomes riskier, and therefore it becomes more costly for it to fund itself. So how then does it produce a graph like this? So links can be large either because of what I refer to as technology. So Bank I simply requires a lot of what Bank J is supplying. So nothing to do with risk, or it could be because of risk. So if a given bank, its fundamentals are good, it is less risky, then because of this parameterization of its funding costs, it is cheap. It can supply cheaply. It has a cost advantage relative to others. Similarly, if the bank being supplied the exposures, its fundamentals are good, then it is cheap to lend to. And finally, just like P impacts marginal cost, so does this gamma, this spillover parameter, which because it is pairwise, implies variation in the marginal cost across pairs as well as across banks. Then the last comparative static I wanted to mention was regulation. So an increase in capital requirements has a nuanced effect whereby it has a direct impact, whereby I have to raise more costly equity. But at the same time, the network changes in response, and so does bank default risk, and that goes down. So it isn't obvious ex ante whether regulation stimulates or harms the network. The inefficiency then of the decentralized outcomes comes from this assumption that Bank I takes systemic risk as given. So it takes into account the fact that when it lends, its default risk changes, but it doesn't take into account the fact that its counterparty's default risk will also change because they are exposed to them. So in terms of what this model is designed to achieve, it's clearly written in order to be taken to data. I have left a lot of things parameterized, so it has a lot of degrees of freedom when we take to data, but things like this technology and the source of this variation in the network spillover, if this were purely a theory paper, we would want to explore where that comes from. We would want to microfound them. Here, we're able to estimate them from the data, so we benefit in that case. Obviously, that comes with the caveat that you then need to believe that what we estimate, these parameters, hold constant in the counterfactuals that I'm going to run later. So that's the quid pro quo to microfounding some elements of this mechanism and leaving some as a reduced form. So given then that we are seeking to estimate it, how do we do that? So there are two sets of moments that we seek to match. The first is matching this network data, so matching that graph that I set up there. We have a series of snapshots of that. Our model for a given parameterization implies a series of networks, and we match them. The second set of moments is from CDS implied risk for banks. So basically, when the CDS premium for a given bank is large, we infer that as its default risk as being large. So it directly measures and estimates this SAR model, this spatial autoregression. So there are two sources of information about this key parameter, these key parameters rather, which are these gamma ij. Finally, we need a measure of a fundamental, which we use as local economic conditions coming from bank equity indices. So basically, for the Japanese banks in our sample, a shock to a Japanese equity index is a shock to the bank fundamentals. And then we can infer information about these gammas both from variation in default risk and from variation in the network position. So if you think about the school example, it is very difficult to look at where students sit in a room and look at how their test scores are correlated and infer network spillovers, whether scalar or heterogeneous. That is a difficult exercise. Here, the advantage of having an endogenous network is instead you look at where the students position themselves around the room, and from that you infer the strength of the spillover. So you can think of a shock to a bank fundamental as a shock to the intelligence of a given student. People change where they sit around them, and you can infer something about the extent of the spillover. The advantage of that is twofold. Number one, we obviously have a lot more network data than we do default risk data. The default risk data is n by t by definition, whereas here we have n by n minus 1 by t network links. The main advantage, though, is it allows us to include a much broader range of fixed effects. So in particular, we can control for bank time fixed effects and look effectively only at where banks, relatively speaking, concentrate their exposures. So there are advantages to including this network formation model in order to infer this spillover, rather than looking for it directly in the outcomes. So these are the, there's one parameterization here. We estimate a fully heterogeneous gamma matrix network spillover as an extension, but that's a lot of parameters. It's hard to do with much power. So we also parameterize it there in the middle of the slide as a function of bank-specific gammas. And this is what they are. So basically, this means that there's very broad heterogeneity in the risk and thus the cost implications of a given exposure. Some are effectively costless, and some are extremely costly because they add a lot to the risk. Now that we have this estimated model, we'll answer a couple of the questions I set out to begin with. Now, the first is around systemic importance. So this is important to understand how these network models work. So we have outcomes that propagate through a network. Now, which bank, which node within that network contributes the most? It's also important for regulation because, as we all know, regulation varies according to whether you are deemed systemically important or not. And one of the ways this is done is via eigenvector centrality. So that simply looks at the raw network and it gives you a ranking. This is the most systemically important bank. This is the second most systemically important bank in its contribution to bank default risk. And typically, this is done on the raw network, i.e. just on the size of the exposures. Now, if the network spillover parameter is a scalar, then this doesn't change anything about the ranking. It drops right out. If, alternatively, the network spillover parameter is a matrix, is heterogeneous, then the ranking changes. And importantly, it isn't just white noise how it changes. Why? Because the point of the model is that relatively safe links, so those with a low gamma, are endogenously bigger. So here is the revised ranking. So along the bottom, we have the 18 banks, and you'll see that on the raw network, which is the black diamond, the 18th bank is the most systemically important network, most systemically important node. We then do the same weighted by our estimated network spillover parameter, and it is now down, it drops 2 places. So effectively, that bank is systemically important, or rather has large exposures, but because it is relatively safe. Conversely, you'll note that bank number 17, it doesn't drop in systemic importance, indicating that its size was a function more of technology and less of it being relatively low risk, implied by our estimation. So on then to efficiency in the last couple of minutes. So, the way we would typically do this is we would say, what is the decentralized outcome, and what would the social planner do, and what is the wedge in between those? But the question is here, do we even know what the social planner's preferences are? If this was an IO model of breakfast cereal, we would simply maximize surplus or profits by breakfast cereal producers. But clearly, bank default risk matters for more than just bank cost, as I've modeled it here. So we think about outside surplus as being the real economy surplus that depends on bank default risk. But the way in which it depends on bank default risk is very hard to measure. There are papers that try to map financial outcomes into real economic outcomes, but it's very complicated. The way we get around this is a simple parameterization whereby we say outside surplus, so the real economy effect, is a decreasing function in the mean bank default risk, in systemic risk. So here we have on the x-axis interbank surplus, and on the y-axis mean bank default risk. And what this means is any movement to the southeast improves both interbank surplus and bank default risk, and therefore is welfare improving. Any movement to the southwest we can't conclude because we do not observe this function. We only imperfectly observe the effect of the preferences of the social planner. Now, I've run out of time, Anatoly tells me, so I'll very briefly explain one of the two things that we do on regulation, which is to the left-hand solid line is a homogeneous increase in capital requirements. And you'll see this moves into an area where we cannot conclude whether the social planner prefers it or not, whether it's an improvement or not. The dashed line is a median preserving spread that increases capital requirements for the high gamma links, decreases the capital requirements for the low gamma links. So effectively, we subsidize some and penalize others. And here, even without fully understanding the social planner's preferences, we conclude that they would prefer that because it allows the interbank network to reach a more efficient outcome such that both mean bank default risk improves and surplus improves. So thank you for your time. These are the kind of broader implications. Spillovers are pairwise. Even if you don't believe the wider mechanism, I hope you believe that it is likely that contagion, that network spillovers do vary and aren't to scalars, and that has implications for regulation. Thank you.
Thank you, Patrick. The discussant will be Piero Gottardi from University of Essex.
Thank you very much. Thank you for inviting me to discuss this paper. This is indeed is a very interesting paper. It's a very ambitious paper as well, and I think Patrick did a great job in illustrating the key ideas. So it's making my life easier. So the point. So this paper is trying to combine the analysis of the systemic risks that arise in financial networks with the network formation. And already per se, the network formation is a much less study because it's a much more complicated and difficult problem to analyze. So that paper is moving an important step in trying to attempt that direction to integrate that. And on top of that, it's aiming to connect that to the data. So there is really a lot in the paper in terms of what is done. So the basic idea is that from what we know already from the literature on financial network is that indeed there is a benefit of the existence of network in terms of resharing, but they can also generate amplify risk, they can generate contagion in the system. And as far as the network formation is concerned, there are going to be network externalities that the decision of a bank are going to affect, depends on the risk on the other banks and feedback on the risk on the other banks, so they can generate room for inefficiency and externality. And so let me then just try to go briefly through what are the key ingredients of the model. So there are two parts in the model that, as Patty explained. So the first is the spillover, the effects that the formation of the exposure, the interbank network between the banks is going to feed back into default risk of the individual bank. So that is going to depend on what is the risk on the asset returns of the bank, and then it's going to depend on what is the lending to other banks and the borrowing from other banks. Now, this equation looks slightly different from the one Patrick presented, because I just wanted to point out that in this model, what comes up is that a negative effect on the risk is going to come from a firm borrowing from other banks. So it's going to contribute negatively on the default probability on that bank, while lending to other bank is going to contribute positively to the default probability of a single bank. And I was just trying to see how we can relate that from what is the lesson that we have learned from other models that have been used quite extensively in studying bank formation, where starting with a level of mutual exposure between banks as given. So here I was just trying to rewrite what are the conditions that we get in terms of the default probability, using the same notation as in the paper. And as you see, the default is just the probability that the value of your liability exceeds the value of your assets. And so the implication that we get of this is that, again, you have that, so like in what Patrick presented, is that the default probability of a bank is going to be related to the default probability of the other bank. And the larger the default probability of the bank, the more the default probability of its own bank. So that's the positive spillover. That's a contagion effect. But there is a difference a bit in the sign of the relationship. As you see here, the more is going to be the borrowing from other banks, the more is going to be my default probability. And the more I lend, I increase my asset, the more I am, that is going to improve my balance sheet and is going to reduce my probability of default. Now, of course, we understand that there is also the cost of funding a bit related, but I just wanted to point out that there is here a bit of difference in the way we capture the effect of the incentives of lending versus incentive of borrowing from other banks that are here. And I think it may be useful to maybe to try to clarify this point in terms of how to relate this. Now, moving to the second point, so that has to do with a more sort of classic effect about financial contagion and right? So then the other point, on the other hand, connects to the probably what from the modeling part is the more novel part of the paper, which is the network formation, right? What are the incentives to establish links? And here, again, so there is, so the fight of the, again, so these are the incentives for providing a loan to a bank. And as you see, so here is where you have the externality. The externality is that the cost of funds depend via the regulation on the cost of probability, again, as Patrick explained, of the own bank. But potentially the revenue of the loan may also depend on the default probability of the other banks, and that may enter the revenue, right? So again, I was trying to think in a sense how we can formulate that and connect this part, right? So this is the lending of bank I to another bank J. And as you see, so the main channel of the externality comes through the effect, or the network condition, the network interaction come through the cost of fund, that is interpreted in terms of this cost of regulation. But one can think that there can also be the counterparty risk and default exposure that can also depend on the network, and that may also enter this expression. Right? And again, I wonder whether this way of specifying the model, how that is important for the result and the characterization result. And then there is the other part, which is the benefit of borrowing from another bank. That has to do with the gains on trade, which again are taken as a parameter that then is going to be estimated. Here, it would be useful to try to build and rely on what do we know about what are the incentives of banks to engage in risk-taking activity, what are the determinants to this effect, how do they vary across banks, right? It's trying to go a bit deeply, because there is another parameter that you see here in the second line, is that the cost of funding is also negatively affected by this interaction with borrowing from another bank versus a second one. So that's a component of the network externality, and again, it would be useful to understand what exactly this is meant to capture. Right? All this is just to say is that I think it would be important when we study the model of the network formation to try to go a bit deeply about what are the determinants and what do we know, possibly also related to existing models of the determinants of banks borrowing and lending with each other. And now it's interesting that then in this paper the paper is studying a competitive approach, so there is a clearing rate that determines the network formation, which is the interest rate for borrowing and lending between two banks. And so there are indeed a lot of externalities in the formation of the network, but with price-taking behavior, the price can indeed internalize a good deal of externalities, right? And can improve, in a sense, can limit the possible kind of inefficiency. So where is the main externality that is left, given this sort of competitive approach to network formation? The bank externality comes on the fact that a bank, the way it's characterized in the model, is ignoring the effect that is borrowing from another bank, or possibly lending from to another bank, is going to affect the other bank's defaulting probabilities, right? So that's the main channel that it is, right? Given, as I said, potentially the way one model was set up, there was a positive or negative effect on that. The question is that is this going to lead to excessive lending? I guess that's a quantitative question. That's probably what comes out of the analysis. Now, okay, so just to summarize, so on that basis, one can then estimate the parameters of the model building on the data that he explained, and building on that, one can learn a lot on what is the pattern of relationship that a bank can form with each other. And this is very important because we can understand precisely a network like the one that Patrick showed at the beginning. We want to understand what are the determinants of that, right? So that can help us to understand how the network is formed, and can also help us a lot to design regulatory interventions that are targeted, right? So we don't want to have, so he mentioned something briefly, and some is analyzed in the paper, but clearly, once we understand the net formation, we understand the heterogeneity of the banks, it's important that one can consider doing very targeted intervention, having intervention specifically on some type of exposure, some type of banks, which are precisely a function of their position in the network because of what determines that position in the network. So there is a lot that indeed can be done, right, once we understand the formation of the network. And so that's why I think this paper is great, because we can indeed, right, once we understand this big ingredient, once we understand how the network is formed between banks, when we understand how this propagates, then we can do a lot in terms of designing more targeted regulatory intervention to address the externality, to reduce risk formation and all that. So there is that's why I think this is a very exciting line of work that, yeah, thanks.
Thank you very much, Piero. Maybe Patrick, you can answer some of the comments.
Yes, thank you. I'm a big admirer of Piero's network formation work, so it's a pleasure to hear your comments. So I made a big deal in the estimation about the fact that we can include a lot of fixed effects when we infer information about these gammas from the network formation game. Now, that becomes intractable to include a lot of fixed effects if they enter very non-linearly. Now, that means that the model, because it's designed to be taken to the data in this way, it is a non-linear model, but there are ways in which it is linear that allow us to concentrate out these fixed effects in a tractable way. So two of the kind of vague bits of it that Piero pointed out are designed to preserve this linearity, to allow us to do that. So in particular, the spatial autoregression is obviously quite linear. Now, it's quite nice because it's the workhorse empirical model, so it's nice to be able to link to that literature. But clearly, the theoretical standard for contagion is, like the Eisenberg and No paper that he referred to, is much more nonlinear. So we can't take it to data. In an early version of the model, we did simulate an Eisenberg and No style, more familiar finance spillovers model, and then show that a SAR can fit it relatively well. That also adds some loose micro foundations to when I said that gamma ij, the spillover, can reflect risk sharing. You can put risk sharing in Eisenberg and No and show that it is reflected in this variation in the reduced form parameters in that way. So, that's why we need to take some of the shortcuts, if we like, that we do, particularly for the SAR. But you can, and I appreciate that the version you saw didn't have that, show that these reduced form imitations are good proxies for how the theory finance literature would typically approach them. Thank you.
Time for some questions from the floor. Rafa?
Two questions. The first one is you focus on the bank default risk, but I have missed any reference to loss given default. Are you assuming 100% LGD? That's the first question. The second question is, can you use your model to discuss as a possible counterfactual the introduction of CCP's central clearing counterparts?
There was another question over there.
Thank you. Very interesting. My question addresses the aspiration to inform regulators. My understanding, based on recent papers, is that essentially this kind of problem is an NP complete computationally NP complete problem that would require quantum computers to really disentangle overall effects. That's of the interest of regulators, of course. It is quite different to build up a model of building a network up than addressing a network as it is. Do you think this assessment is correct? I mean, this far-fetched conclusion that this can inform regulators, and rather it can inform approximations like the one suggested by Rafa to design kind of mean field effect solutions like CCPs, etc.
Yes, a concise question related to previous point. When measuring the social value, you focus on probability of default. Then in other kind of models, you would also look maybe to the total volume of credit that is granted at the end to the private sector. So it's possible that in the end translates into more activity, more output. So a possible metric is the total loan portfolio of the bank times 1 minus PD. The challenge in this is that I understand that in the model you have the interbank loans, but not other loans in the bank portfolio. No? So there's a difficulty in making a jump from the total size of the interbank market, which might grow at the cost of reducing other sources of funding, and this jump to the total volume of lending activity to the private sector that this is supporting. So this is kind of a challenge, maybe it's a limitation, but maybe there is some possibility, no? Because then the jump to the real sector, that's what is, I think, totally outside of the modeling capacity. But if it was possible to connect the interbank activity to the size of the private loan portfolio, maybe there is something there. Thanks.
Patrick, please.
Yeah, great. So in reverse order then. So, the idea of imperfectly observing what the social planner's preferences are is that what I called outside surplus is decreasing in mean bank default risk. And that is intended to capture exactly something like the fact that they can then lend more widely. So we don't model it directly, but we do say that if banks are safer, then one of the many benefits that result from that is something like the ability to lend more. So that kind of thing is the intention behind that example. Now, there might be something, because we could get hold of data on lending, we could benefit from it in estimation, but in terms of simulating the effects of regulation, that kind of trade-off is exactly what we had in mind. The question beforehand in terms of the uses for regulation. So, the simulation that I did have time to go through, the median preserving spread of capital regulation, that is based on my estimates of these gammas. So it requires the empirical exercise that I had done, which maybe is not a good input into regulation. But there was another one which I didn't have time to do, which is simply about a cap on aggregate exposures, and in particular the idea that an individual level cap, which is what is in the regulations currently, is less effective than a cap on aggregate outgoings of a bank, precisely because of this heterogeneity, in a way that I would have explained if I had time. But the idea about that is that you can implement that without any knowledge of what the gammas are. The impact of it depends on what those gammas are, but it's implementable without doing anything that's computationally difficult. Then the question on CCPs. So we see some exposures to CCPs. We don't see the exposures held by CCPs, and we don't see their default risk. So in some sense, that is a limitation to a model that is intended to be estimated and to have empirical meaning to these fixed effects and to these heterogeneous gammas. So without knowing those, and they are not empirically available to us, it would be difficult to reach a kind of meaningful conclusion. So, we can answer certain specific things quite well where we know those parameters, but questions like that are difficult to do the way we've set up the model and the estimation. Thank you.
Thank you, Patrick. Thank you, Piero. And it's time to move to the second paper of this session. Quentin van de Weyer from the University of Chicago is going to present it.
All right, thank you so much. So indeed, I'm going to present this paper called Can Stablecoins Be Stable? And this is joint work with Adrian Daverna and Vincent Morin, and both are at the Stockholm School of Economics. So let me start this presentation by just giving you a definition of what's a stablecoin, what do I mean by a stablecoin. So a stablecoin is a cryptocurrency that is pegged or tries to maintain parity with an official currency, typically the US dollar or the euro. And basically the idea here is try to combine the benefits from the blockchain technology without getting the annoying part of using Bitcoin as a means of exchange, which is that it's too volatile. So since we started working on this project a long time ago already, the markets for stablecoin really increased by a lot. So it was around $3 billion in 2019, and it grew to something around $125 billion in 2023. And actually at some point in time was even larger than that, but then the following thing happened. So maybe some of you have followed this event, but in May of last year, May of 2022, the third largest stablecoin platform completely collapsed, and so it started losing the peg, which is what we see in the graph over there, and eventually collapsed to almost zero. So between the collapse of the stablecoin itself and the governance token, or what I'm going to call an equity token, that's supposed to support the value of the stablecoin, around $40 billion were erased at the time, which is actually almost as much as what was erased during the FTX collapse. And so for good reasons, we've seen a bunch of regulatory initiatives in the US, in the Euro area, in the UK, and all over the world by now, probably. Okay, so by now, you might be thinking that stablecoin, we know everything about stablecoins. Either it's a scam, or like the more gentle version would be, it's just a bank, and we have a bunch of models that explains what banks are doing. So why should you listen to me explaining a continuous time model at 5 p.m. after a long conference? Well, I'm going to argue that it's only partially correct, in the sense that stablecoins are actually solving an old problem, but are actually bringing some new solution, new ways of trying to solve that problem. And I'm not saying that it's going to be a miracle, or that they can necessarily do that in an efficient way, but I'm saying it's a slightly different problem. Okay, so what's the problem? The traditional problem is that stablecoin issuers can make money, they can create money, and by in doing so, they can generate seigniorage revenues. And the issue is that whenever you get the privilege to do so, you always have an incentive to overissue, and by issuing, then you're going to devaluate the value of the currency in the first place, and if that's anticipated by agents, then you cannot capture the seigniorage revenues in the first place. So the way this has been solved typically, traditionally, is from creating some form of credibility. And that's why central banks and banks have like this very large, beautiful building, because you need to make sure that people trust you. So there needs to be some trust behind these things. So, but that's exactly what all this crypto world doesn't want to rely on. So they would like to do things in a way that completely dispense some trust. So here, I'm really thinking about stablecoins as bringing three different new technological propositions, three technological tools to the table. The first one is that you can actually create what's called a smart contract, which is going to completely tie your hands to whatever you want to do, you're going to do in the future. So this is going to be like a superior commitment device that does not rely on the legal institutions in a given country. So that's number one. Number two, stablecoins can potentially delegate the issuance to some other agents in a decentralized way. And so they can, and by doing that, there might be a way of like getting along this problem I just described, and that's where I'm going to go. And then the third one is that you can do equity finance open market operations. So a central bank would do an open market operation or by holding some reserves or some liquid assets on the asset side of its balance sheet, and then use that in order, whenever it needs to buy back or remove some of the supply of the reserves in some of the currency in order to maintain a parity or something like that. Here, because the stablecoin can create equity and they can create these equity tokens, a stablecoin platform is going to be able to do this open market operation without holding any liquid assets on the asset side. They will simply use their franchise value and they will issue equity against their franchise value. And so that's how we can see things like algorithmic stablecoins have actually appeared. Okay, so this paper, I'm going to try to answer the following research question: how their design can make stablecoin stable. I'm going to build a model with like demand for stablecoin and supply of stablecoin, and then monopolistic platform is going to try to maximize seigniorage revenues, and the key friction is going to be that the platform will have this incentive to overissue, as I just mentioned, which is close to the Gaussian conjecture, if you know what it is. And the issue is that if you overissue, then you're going to lose the peg. So you need to find a way to commit or to create the incentive so that you don't overissue. I'm going to preview the results quickly. So the first result is that even if you assume the best commitment technology that you can have, so you can commit to absolutely everything, you're still you're going to have then an equilibrium that's locally stable. It's only going to be locally stable. If you have a large negative demand shock, at some point that's going to wipe the equity of the platform, and at that point in time, the peg will be lost. If you don't have that, if you have like only limited commitments, then collateral is going to be able to help, but it's not actually going to be helpful with respect to the commitments. And so what you will need to do is to decentralize the issuance in that case. And decentralizing the issuance in a certain way is going to create a platform that maintains the incentive not to overissue. And I'll explain why in a couple of seconds. Okay, so let me go briefly through the model. So it's continuous time. There's a common discount rate R for everyone. And then stablecoins are these infinity maturity assets that pays an interest rate delta T and that have a price PT. And there is a mass one of users that value the stablecoin in their utility function. So I'm not going to model why, I'm just assuming that there is some value for holding the stablecoin, only as long as the stablecoin is actually stable. And so this creates a demand for the stablecoin and pricing equation for the stablecoin that's going to have both the interest rate that the platform is paying and the flow of utility that people get from holding the stablecoin. So this is the U prime. And because the U prime is going to be really key, that's going to be basically my demand function. I'm going to give it a little name and little symbol. That's going to be LT. And LT will be a function of PT times big CT, which is the total quantity of stablecoin outstanding. Okay, so I'm also going to assume that this demand for stablecoin will be shocked. So there's like an exogenous shock that can happen. So I'm going to index the demand with a variable that I'm calling A. And this is going to follow this geometric Brownian motion with jump process. And mostly you will see that the jump is going to be what matters the most. So you have some probability, there's a Poisson jump that happens, and then the demand or the valuation for the stablecoin goes down. And then there's the pegging assumption. I'm assuming that you only really get the liquidity benefits whenever the stablecoin is actually stable. When the stablecoin is outside, does not maintain the peg, when the price of the stablecoin is not 1, then you don't get the liquidity benefits. But anytime it's equal to 1, then you get the liquidity benefits. So it captures some extreme preference for stability here in a reduced form way. Okay, so I'm going to start with a centralized case. And then I'll go to the decentralized case later on and see what that changes. So in a centralized case, the stablecoin platform, which is this monopolist that maximizes its own revenue, will have to choose 3 policies. The first policy is that at any point in time, it has to decide how much stablecoin it issues or buybacks. So that's the supply policy. And something important is that whenever you do an operation, you have to do it at the market price. That's the only way you can do it. Then the stablecoin platform is going to pay some interest delta T. And what's important here is that it's paying in stablecoin. So instead of like creating a side payment using a bank account in the real economy, it's just going to credit the stablecoin account with some more stablecoin that it creates whenever paying the interest rates. So this gives us a law of motion for the quantity of stablecoin, which has 2 components. First component is how much do you issue willingly at a certain point in time, and then how much do you need to issue in order just to pay for the interest rates that you have in stablecoin. The last policy tool is this collateralization ratio. So you can decide to collateralize your platform. And here the assumption we are making is that you only make that choice once. So you choose a collateralization ratio at the beginning when you create the platform, and then you need to abide by the collateralization ratio that you decided, which is denoted by this variable rho. The assumption here is that the collateral is going to be fully safe and liquid, which we also take as then the collateral asset already has some form of convenience yield on it, meaning that the return you get on the collateral asset, which is this mu k, is lower than R, the discount rate. And so that's going to give a cost for holding collateral in the platform. So the monopolistic platform overall is going to internalize the effects of the policy it chooses on the equilibrium prices, taking as given the demands. Okay, so let me go to the full commitment case, and I'm going to start with what I'm calling an unlimited commitment benchmark. Here, the idea is that there is no friction at all, in the sense that you can always, whenever you commit to a policy, you can always abide to that policy. And so this is equivalent to basically assuming some form of unlimited liability, and I'm going to relax that later. But that's just as a benchmark. So in that case, the monopolistic platform problem is going to simplify into the problem you can see on the slide here. So you're going to maximize the value of the equity at time 0, choosing the policies. And you will see the delta is actually trivial, so I actually removed it from here now to get the simplified specification. And it has like a very intuitive interpretation. Basically, you are going to maximize the present value of your seigniorage revenue flows, which are going to be all of the liquidity benefits that you can create, and then you are going to capture them. Minus the collateral costs, the fact that whenever you own some collateral, instead of getting the interest rate R, the discount rate, you only get the lower interest rates mu K. So that's the cost of the collateral thing. So you maximize that, subject, you take into account the demand function. And in particular, a constraint will be that you can only generate these liquidity benefits whenever the price is equal to 1. So you take that into account. Okay, so that's what the policy looks like. So the policy is such that, in that case, you're never going to put any collateral. So phi is equal to 0, just because collateral is useless, you have a full commitment in this case. And then otherwise, what you are going to try to do is basically target a certain supply depending on the demand. And so you'll maintain a ratio of C to A that is constant in order to maximize your profits. And then you are going to use the interest rates rule, the delta, in order to make sure that the price is always equal to 1. And so there's a very nice representation. So here I represented this function L as a function of big C, the total supply of stablecoin, and basically the platform is acting as a monopolist, so it maximizes, chooses the rectangle under the curve that's the largest possible. And so if there is an increase in the demand, then you're just going to issue some more stablecoin accordingly, and if there is a decrease in the demand, then you're going to remove some of the stablecoin from the supply. And you're going to implement these operations, some open market operations, using your own equity to do that. But until now, I was like implicitly assuming that whenever the platform would become undercapitalized, there would be some automatic recapitalization. In practice, you have some form of limited liability because everything is anonymous. So you're never going to recapitalize the platform whenever it's insolvent. So I'm now going to solve the same problem, but I'm adding a limited liability constraint. So equity can never be below 0. And so here in this case, I'm also assuming there is no collateral. And so everything that backs the value of the stablecoin is the future seigniorage revenues. That's the franchise value of the stablecoin platform. And so what happens here is that, again, you're going to do this implementation by open market operation in a sense that you're going to swap stablecoin for equity. Whenever there is an increase in the demand for stablecoin, you're going to create some more stablecoin, and you're going to use that to either pay dividend to your equity holders or to just buy back the equity token. And then the more threatening case will be whenever the demand goes down. And whenever the demand goes down, then you have to buy back the stablecoin in order to make sure that there is not too much supply of stablecoin and maintain the bag. And in that case, you're going to do that by issuing some more equity tokens and diluting the value of your equity base. But there is a limit to how much you can do, because as we can see, the platform is effectively leveraged. And because the platform is leveraged, if you have a large enough demand shock, that's going to wipe the value of the equity. And when the value of the equity is wiped, then you cannot issue any other equity in order to do the buyback operations. And then you lose the peg. So that's what's happening here, and we can see that graphically. So here in the graph, especially I want you to look on the left graph, which is the little e is the scaled equity over the total value of the platform. And so the black line here is the case where you have full commitments, and in that case, you're always going to remain at the start point. So you're never going to move away from there. And whenever there is a shock that tries to move you away, you're always going to jump back to the star. The blue line represents this limited liability case that I just described. What happens is that whenever you reach the equity goes to 0, then you cannot do these buyback operations anymore. And so at that point in time, the peg is lost. And that's what we can see on the right side. So we can see that the price starts to go below 1 in this case. And so whenever you are above this threshold, this bubble point, you're going to always jump back to the star point. But whenever you have a jump that's too large and the equity is 0, then the peg is lost in this case. Okay, so let me move on. So there is a role for collateral. Actually, collateral is going to help you in this case, because whenever you have collateral, you're backing up the stablecoin with more than just the franchise value. So it means that you're going to be able to sustain larger shocks. But there's also a cost of collateral. So the optimal collateralization ratio from private perspective of the platform is going to be an interior solution. So they are not going to always want to fully collateralize the platform in that case. Actually, there is a theorem we have which is a condition for the profitability of the platform under full collateralization, which is going to be that the convenience yields on the stablecoin that you can generate has to be in equilibrium at least as large as the convenience yield in the collateral asset. Otherwise, you're basically taking something that's more valuable and transforming it into something that's less valuable, so it's not profitable to do that. Okay, so I really don't have much time left, so I just want to introduce very quickly what's the time consistency problem, or at least the intuition for that. The time consistency problem is coming from the fact that if you cannot fully commit to this issuance and redemption rule, that means that you can re-optimize at any point in time. If you can re-optimize at any point in time, you're going to consider the value of your equity at that point in time t. And as we can see on the slide here, that's going to be the collateral plus the present value of the seigniorage minus the value of the debt. And so in that case, you're going to have an incentive to basically keep issuing beyond the monopolist's optimal point, because that means that you're going to devalue the value of your debt if you do that, because the price of the debt is going to go down. And so you basically, another way of saying that is you don't internalize, once you issued a stablecoin, you don't internalize the future effect of issuing some more on all of your past issuances. And that creates a problem. Then I'm going to show you that decentralization can actually help. So I'm moving from a case that's fully centralized to a case that's decentralized, in a sense that the platform is not going to do the issuance directly, but rather is going to allow some arbitrageurs to create something that's called a vault or decentralized position, where anyone can just take some of the collateral assets and then pledge that into a smart contract and then issue stablecoin against these collateral assets. And when that's the case, the platform is still going to make revenues because it's going to charge fees on this arbitrage position, on these vaults. And what's important here is that that's going to change the whole incentive structure for the platform to overissue, because in this case, the fees are going to come as a flow. So the profits are going to come as a flow. At any point in time, yeah, I'll just need 30 more seconds if you don't mind. You're getting your profits as the fees you're charging minus how much interest rate you are going to pay on the stablecoin. So you're going ST minus delta T as the fees, and that's going to be proportional to the quantity of stablecoin that's outstanding at the given point in time. So overall, the main difference between the centralized case that in the centralized case, you are gaining your profit at each time you are issuing some new stablecoins, and then you don't care what's happening about these stablecoins later on. Whereas here, you're getting your profits as proportionally to the total stock of stablecoin at a given point in time. So you have an incentive to maintain the monopolist quantities at each point in time. And this is actually exactly equivalent to the rental solution in the Gaussian conjecture problem of the durable good of monopolies. And I'm happy to elaborate on that if you have some question.
And I'm going to conclude by saying that the goal of the paper is to provide this general framework to analyze the stablecoin of the stability of stablecoin. And what we find mostly is that whenever you have full commitments, you're still vulnerable to these large negative demand shocks. Whenever you don't have full commitment, then you have this incentive to overissue, which is an issue, which is a problem. And decentralization can help, provided that you actually design it in a way that preserves the incentive of the platform not to overissue.
Thanks. Thanks, Quentin. Let's move swiftly to the discussant, who is Mathieu Bouvard from Toulouse School of Economics.
Can I get the
Yeah, sorry for that. There you go.
Coming.
Okay, thanks a lot for the invitation. So, as you just saw, it's a paper which has a lot of results, and I'm going to be a bad discussant in that I'm not going to give justice to all these different results. So instead, what I'll try to do is, what was actually extremely useful for me is to use this paper as a framework to understand this question of stability for stablecoins. So, so Quentin gave you the Brownian motions with jumps. I'll do what I can do, which is pictures. So can these stablecoins be stable? I think the interesting case is when you have this kind of partial collateralization. And so what you can see from this balance sheet, so this is something that's also in the paper, is that, so if you have only partial collateralization, what this implies is that the stablecoin is going to be a claim which is in part on future seniorage revenues. And so to the extent that this future seniorage revenue is uncertain, subject to a demand shock, which is the case in the model, it's not going to be possible actually to have something where to have a stablecoin where you're never going to lose the peg. So imagine that you have a shock to this demand, okay, so your future seniorage revenues are going to shrink, which at this point means that your equity tokens, your equity is completely wiped out, and the problem is that the equity is the only way that you have, at least under limited liability, is issuing equity is the only way that you have to raise resources in order to repurchase these stable coins and maintain the peg, right? So if this happens, you already know that the peg is going to be lost, and then the value of the stable coin is going to go down. It doesn't mean that it goes all the way to zero. It could rebound, in part because collateral is generating revenue, so you could rebuild your reserves, and you could also so this demand might bounce back, but it means that at least temporarily you're going to lose the peg. And that's even without any commitment problem, right? So we have this first insight that if you don't have full collateralization, there's always going to be a probability that the peg is going to be lost. The second insight I've actually found interesting is this idea that if you have, again, a token which is a stablecoin which is only partially collateralized, this is going to be viable only if you expect the demand for this stablecoin to grow over time. And again, you can see the intuition in this balance sheet, right? So the stablecoins you have on your liability side, they're already out there, right? They're actually being used, exchanged by people, generating all these convenience yields. So the future seniorage is going to be additional, at least in expectation, additional coins that you're going to put in circulation, right? So what that implies, so for these coins to have a value, it has to be that future demand has to be higher, right? So in a sense, this is going to be viable only if there's enough growth in this demand for token. So let me insert here a first comment. So obviously collateral here is very, very important. Now, in practice, one issue is that it's not completely clear that this collateral is observable, even for very prominent stablecoins like USDT, for instance. Now, so just to be clear, I'm not suggesting that you should write a model in which this collateral is not observable. I'm just saying that we actually have already a framework where we can see all the potential problems that non-observability or partial observability of collateral could pose. So there's the basic problem that, of course, you could hold less collateral than you're supposed to. There's perhaps a slightly more sophisticated problem that you could also alter the composition of this collateral, right? So from a stability standpoint, what you want is to have safe collateral. In fact, even if you could have collateral that moves in the opposite direction from these demand shocks, that would be even better. But now, of course, if you are these equity token holders, you might actually want the opposite, right? So what you might want is to have something that moves in the same direction as your demand shock. So if you have a positive demand shock, futures and wage goes up, collateral value goes up as well. Of course, it would go in the other direction if you have a negative demand shock, but you have limited liability, so maybe you don't care as much. So I think we all understand risk shifting here. All I'm saying is that it seems that, in this particular case, this would be relatively easy to do. Now, just to circle back to the paper and the very last point that Quentin made on decentralization. So decentralization solves some problems related to commitments, but it's going to make this verification of collateral harder, right? So if you have a central entity that holds collateral, you can hope maybe that through some kind of auditing, you'll be able to monitor this central entity. If you decentralize this to potentially hundreds of thousands of small agents, that's not going to be possible, which means the only way you can do it is through the blockchain. But that implies that the collateral has to be native to the blockchain. It has to be a token. And then we start running in circles because you want stable coins because tokens are too volatile, but then the only way you can collateralize these stable coins is with tokens. So in practice, the way this is done is you have to over-collateralize, right? So you could think of these decentralized solutions, but they are actually quite costly. The second point I wanted to make is something I find interesting in the paper is the instruments that the platform is using to maintain the peg. So you have actually two instruments. You have purchases, issuance and purchases of the stablecoin, and you also have an interest rate. And it wasn't, a priori completely obvious to me. Like my naive intuition was that if you just with repurchases you should be able to maintain the peg. But it's actually not the case. And there are two reasons why this is not the case. The first one is that, so if you want the value of this stablecoin to be worth 1 today, this is the present value of what you're going to get tomorrow. If you have any kind of discounting, you need the value of what you're going to get tomorrow to be higher. But you can't deliver this through a capital gain because you have to maintain the peg. So it has to be that there's a flow that comes in, and that's the first element you see here is kind of the interest rate you could get elsewhere, net of the convenience yield. There's a second reason why you need this interest rate is because you need to compensate the token holders for the possibility that the peg is all going to be lost. So there's a bit of a it's not really a risk premium, this kind of expected loss, which is there also in this interest rate. And the broader point I wanted to make here is that, to some extent, it sounds very familiar. We think about, monetary policy, you have interest rates on reserves, and then you have open market operation. I think it's something that it's an analogy that you make. But I think in the way we think about these two instruments is very different. We think about many different transmission channels, different maturity of interest rate you're trying to target. Here you have a completely different explanation, and I think that's something you could potentially leverage a bit more. Now, on the flip side of this, right? So if you want to be able to do this in the model, you're going to need this interest rate to react to this demand shock, right? So in practice, it's hard to see, at what frequency these demand shocks would move. But you need this kind of commitment, and so you talked a little bit about smart contracts. The problem you're going to have there is that these demand shocks are probably difficult to observe. Maybe you could infer them from prices, but they are definitely not something which is going to be information which is in the blockchain. Right? So, and if it's not in the blockchain, if it's not native to the blockchain, what it means is that using these smart contracts is going to be something that's going to be difficult, right? So you will need to import this information through an oracle into the blockchain, but then that's yet another source of potentially of vulnerability. This could be manipulated. And so, you know, is this something that you can actually do? It's not completely clear, right? So then what you also show is decentralization removes this commitment requirement, but then, you know, as we discussed earlier, decentralization comes with other kind of costs. So just to conclude, again, that was an extremely useful, I want to stress this, an extremely useful framework for me to think about stability implementation issues for stablecoins. Maybe some insights are valid beyond stablecoins. My personal takeaway is more kind of pessimistic. It seems to like highlight how difficult it is to privately implement this kind of stablecoin. And so, you know, I don't have, I mean, in general, it's sometimes hard for me to see, you know, why CBDCs could be so useful, but that might actually be one use case. If you're saying, okay, so there's really a value for having these stable coins which can trade on a blockchain, which are programmable, given that it seems relatively difficult to achieve with private solution, maybe one way out of this is to have directly central banks providing this service. But yeah, I'm going to leave this to the central bankers in the room. But again, great paper, and again, if you want to understand anything about stablecoin, I highly recommend it.
Thanks, Nadia. Wendy, maybe you can answer some of the questions.
Yeah, no, this is all great. Thanks a lot. Yeah, just a couple of things. So, yeah, I agree on the collateral not being observable. So, basically, there are two types of stablecoin in that respect. You have some that are doing everything on the blockchain, and then in that sense, they are free transparent. But then there are other problems associated with that. And then we have things like Tether, which is exactly at the other end of that, where for a very long time we didn't know at all what they had on the balance sheet. And that's it would be actually potentially, I think, even if you told us not to do it, I guess we could think about doing that, like thinking about what's going on when you cannot observe the collateral assets. So that's a good point. I would like to comment on the two instruments. So on the why do you need two instruments? Actually, I don't think you, strictly speaking, always need the two instruments. So in some cases, if you fix one instrument, let's say like Tether, you pay 0 nominal interest on reserves, you are still going to be able to create, for some parameters, still going to be able to create a stablecoin platform that's profitable and that maintains the peg, if you have full commitment or these other things. It's just that you're not going to maximize, you're not going to be able to maximize your profit. Basically here, you have the reason why it's useful to have two instruments, because you have two objectives. One objective is to maintain the peg, and the other objective is to maximize your profits. If you only have one instrument, well, you need to use that instrument to maintain the peg. That's the only thing you can do, and then the profit is going to be the result of that. And so sometimes, as you mentioned, that profit might actually be negative. In that case, the stablecoin is not going to be profitable at all. Another thing, you mentioned that the demand is not observable. And that's exactly correct. And it's another piece of motivation for this decentralized implementation. So instead of actually writing a contract on something you cannot observe, you can just let the market, in a way, issue or redeem stablecoins in a way that's efficient. So that's a way out of that thing. Maybe we should emphasize that point a bit more. And on your very last point on the conclusion, so I'm also more on the pessimistic side, in the sense that I think this technology is actually dominated by what central banks are doing, except if you cannot rely on a good central bank, which is the case in some countries. And so I think most likely going forward, stablecoins are not going to be particularly useful in Spain or in the USA, but they might be helpful in countries that are facing hyperinflation and want to get some form of dollarization. And in that case, it's unlikely that if the Fed creates a CBDC in the US, in dollars, it's unlikely that it will not abide with the KYC rules. And so in that case, it's not going to be directly accessible. So it's possible that stablecoins would still be valuable as a second best option in certain circumstances. That's what I would think.
Thank you. Questions from the floor? Carlos.
Question a bit moving a bit outside of the model, could you give us some flavor of what would be the consequences of introducing some competition? When looking at this, I first thought, well, maybe this is a discipline device, but then I thought maybe of a special situation where it's not, especially if you are first a monopoly and then you have the expectation of greater competition later. That might give more incentives to overproduce, and maybe you could see the CBDC as this future competition, so that could lead to some instability before it's introduced. So I thought this interesting beyond the model that itself was very insightful. Thank you.
No, exactly, that's a great point. So one possible interpretation of like this negative demand shocks would be the introduction of some competition, possibly coming as CBDC. Another thing I want to mention is like you cannot really, so it's not only, that comment is not going to be specific to stablecoin. I think in general, all of the cryptocurrencies are supposed to derive some of their value from some form of scarcity. And here's the idea is the same. If you want to maintain the peg, you need to create scarcity so that the price is always going to be equal to 1. So like perfect competition with free entry without any friction is basically going to lead to an equilibrium where you cannot create stablecoins. Unless if you have something like network externalities, which is something that we allow with the functional form of the L. I didn't really have time to show that, but possibly you can have a demand function that's initially upward sloping and then downward sloping to capture some network externalities. And so that would be the way to introduce competition in this setting. And that relates to other work as well.
Javier.
Thank you for the presentation, and I didn't read the paper in advance, and I'm not an expert on the topic, so maybe my question is naive. Would it make sense to consider the possibility of existence of non-stable stable coins? In other words, any levered institution that makes nominal promises is subject to the same possibility of negative shocks leading eventually to default, right? So a bank has promises and with some probability in the future goes bankrupt. So I think every bank in the world has a non-negligible probability of going bankrupt. Any money market fund in the world has a non-negligible probability of not being able to fulfill its one-to-one promise, no? So would it be a problem if stable coins are not stable? And in that case, what will be the arrangement that makes non-stable stable coins welfare maximizing?
Right, but banks are maintaining parity, and that wasn't always the case, right? So the banknotes, like private banknotes that used to circulate, so Gary Gorton has a paper on that, like back in the, and so to that extent, I would think there is some analogy, and so basically what happens in the model is that you compensate for default risk with the pricing. So interest rates are going to move as well. And so, but the price, you can still maintain the parity in that setting, like a bank would do on the deposits. It's not that you expect that there is the secondary market value of your money market fund share, if you could trade them, would be at some point below par. It's more like now there's going to be an event, and if there is that event happening, there's going to be some form of default, and then you get less than the parity value. I don't know if I answered your question, but yeah. So I can hear anyway. Yeah.
In the stable coin setup,
yeah,
your episodes that take you to say the stable coin is not stable are probabilistic, right? So is a positive probability of that episode killing the existence of stable coins all the way to that episode or not?
Okay, so let me try to go back
to
an
existence. So you say stable coins do not exist, but do unstable coins exist? Or the thing fully collapses.
No, they
exist, no? The unstable.
These are the ones we have. These are the ones we
exactly.
have.
Exactly.
No, so it depends what.
I don't know.
So
sure.
I mean, if we were requesting stability to banking, banks will not exist. Any bank in the world has a positive probability of going bankrupt.
It's a semantic issue. So the semantic issue semantic point I wanted to make, I think, is that by stable, I don't mean, or I don't think it means always stable. It means that it actually conditionally on not having a default event, a catastrophic event, it actually maintains the peg quite well. But that's a conditional statement. It's just like, it's completely polarized settings. Like, it's either it goes to almost full collapse, or it maintains the peg quite well. And so that's what I'm saying.
So, I have a question as well, elaborating on, also because inspired from those nice pictures of the balance sheet of stablecoin, looks very much like the balance sheet of any firm or a bank. And then the kind of collapse or loss of peg you are considering makes me think of a sort of fundamental default of the stablecoin. But if I'm not wrong, what you are not modeling, and which is something very scary with banks, is that there can be panics. And the stablecoin, by construction, is funded with totally callable upon demand liabilities. So, is my intuition right? This is just for the analogies, fundamentally driven defaults, and you are not considering panic-driven coordination problems between the holders of the, and if that is the case, then also, I mean, the stability of quote-unquote stable coins in reality will be much lower than that of those in reality that, as we have seen, are not very stable.
Yeah. No, that's fully correct. So that's a result we have on the paper as well, which is that, especially with the algorithmic stablecoins, you always have a second equilibrium that's a non-monetary equilibrium. Like, this is basically fiat money. So it means there's always an equilibrium where the value of the thing is going to be zero, and there could be some coordination towards that equilibrium. We just don't, but in order to model that, you need some global game type of approach, and like somebody can do that. For now, we decided to focus on that's correct. For now, we decided to focus on the studying the equilibrium that's locally stable, basically trying to stack all of the chances in favor of the stablecoin, and see what happens.
There was a question by Alonso as well. Sorry.
Very nice paper. So probably it's just a clarification question. So it looked to me that you are taking demand, and this related. You're taking demand as given, but that demand, I mean, I guess if the investors in this market are rational, those demand would depend on the probability of the peg to be maintained or not. So if you allow the demand to be more endogenous, would your results on stability survive or not?
Right, so it's also a little bit semantic. So demand is fully endogenous in the sense that it actually takes into account all of the future action that the platform is going to be taken, and everything is anticipated. It's more that there is a shock to the endogenous demand that is exogenous. And so that shock, so something we don't do is what I just answered to Anatoly. We don't do coordination towards the other equilibrium. But for the rest, the demand is endogenous.
Okay, so thank you very much. There are no other questions. Excellent paper and discussion. And now we move to the last paper of the
Could I have the clicker?
Of the day. Yeah. Peter Hoffman from the ECB is going to be the presenter.
Thanks, Anatoly, and thanks to the organizers for a great conference and for putting the paper on the program. So this is joint work with my colleagues Tony Arnart, Agnese Leonello, and Davide Porcellacchia. Since we all work at the ECB, there's also a disclaimer, which is the usual one, plus there's a little add-on that also emphasizes that the ECB is running an official digital euro project, and we're not part of that project. We all work in the research department. Okay, so motivation, I can keep it very short. Maybe some of you also looked into the various newspapers yesterday. So yesterday there was a flurry of op-eds on the case for the digital euro, but more broadly, I guess many of you will be aware that there's this active thinking by many central banks around the world about toying with the idea of implementing central bank digital currency. So the BIS regularly surveys these efforts, and so there's about 90% of the respondent central banks, they do some form of research at least. Many go much further, so there's some that have a pilot. There's very few CBDCs that are active or live. So there's one in the Bahamas, one in Nigeria, I think another one in the Eastern Caribbean, but there's many others in the pipeline, and that pipeline is growing fast. So it's likely to become a reality in a substantial number of economies sooner or later. And so, of course, the widespread adoption of CBDC, in particular, actually, a retail CBDC would certainly entail major changes to the financial system. And so, before going there, then it's just rational behavior dictates that we should work on understanding where are we actually going and what does it mean for the financial system, right? So, as the title already says, the paper asks a relatively straightforward question, which is what's the effect of CBDC on financial stability? Policymakers have actually been thinking quite publicly about this, so there's also some publication by, I think, 7 central banks, which was coordinated by the BIS, and so there's a report that voices these concerns that CBDC could be an ultimate store of value, and that could amplify the risk of bank runs, right? When depositors are concerned with the stability of banks, that's the optimal place to run to would be the central bank, right? So we have a model that speaks to that. And then also we go a little further. We try to go a little further, and we try to think about are there particular CBDC design features that can possibly mitigate some of these concerns. And I've actually already talked to several people here that have been asking me, so there's one particular proposal which is sort of to establish holding limits on CBDC, so I'll try to speak to this at the end as well. There's some other proposals that go in a similar but not quite the same direction. We try to think a bit about that, depending on time. Okay, so what we do in the paper, so we incorporate CBDC in an otherwise rather parsimonious model of bank runs. I don't want to say standard because, so it's a global games model, so it has a few features that are quite attractive for us because it allows us to connect the default probability of banks, or the risk of bank runs, to the deposit contract that is offered by the bank, which is a monopolist in the model, and of course CBDC, which affects both of these elements in equilibrium. And so the headline result of the paper is that the relationship between remuneration on CBDC and bank fragility, or the probability of a bank run, is U-shaped. So in other words, sort of the overall effect is ambiguous and could go in either way, and that overall effect is basically the combination of two forces that pull or push, however you want, in opposing directions. So there's the direct effect, and that is pretty much in line with, I would say, the narrative that's been out there, that if we hold the deposit contract fixed and we just offer a more attractive remuneration for those that want to run on a bank, well, that would increase the risk of bank runs, right? If you have a more attractive outside option, well, you will eventually go for that, holding everything else fixed, right? But so the bank is not an innocent bystander in the model. The bank actually will react, and that gives rise to an indirect effect that goes in the opposite direction, right? So basically, given that consumers have the option to run into CBDC, which is a more attractive outside option, well, the bank will take that into account because the bank only makes profits when it is not insolvent, right? So the bank will react to this improvement in the outside option by offering a more attractive deposit contract, and that more attractive deposit contract, at least on the margin, will keep investors with the bank, and that will lead to a reduction in bank fragility, right? So we have these two forces that pull in opposite directions, and then literally what happens in equilibrium is, well, one effect will be stronger than the other. That depends on parameters. Okay. Then, as said, we try to explore different CBDC design proposals. We look at the holding limits that I mentioned, and we show that they have an ambiguous impact, and that is very much in line with the headline results, because basically what holding limits do in our context is that they change the effective remuneration of depositors outside option. And so that means holding limits, the effect of holding limits can also go in either way. right? So they're not a silver bullet very much. And then we also look at something that we label contingent remuneration. There have also been some loose proposals out there, and we show that under some conditions they can improve financial stability. And then last but not least, I won't be able to talk about it, but let me mention here, we also do some extensions of the model, so sort of the, I would say, usual suspects in that literature you can look at. One is imperfect competition. Since we have a monopolist bank, we also look at imperfect competition in deposit markets, and we look at risk-taking on the asset side of the bank balance sheet, and sort of our results also hold up in that context. Okay, so let me not say much about the literature, except I'm very grateful to have a global games expert like Javier as a discussant. And so we speak, of course, to the literature on CBDC, and then more broadly to things people have been doing in global games. So let me jump to the model. There's a typo on the first line, so there's 3 dates, but they're not labeled 1, 2, 3, but 0, 1, 2, as you will see slightly below. And the setup to begin with is fairly standard. So there's a single good, it's perfectly divisible. There's 3 dates, there's no discounting. Everybody's risk neutral. There's a monopolist bank that is profit maximizing. And then there's a continuum of investors. They have 1 unit of funds each. And then at the beginning of the game, the bank tries to raise funds from depositors and offers them a demand deposit contract with interest rates R1 and R2. So R1 is what depositors get when they withdraw funds at t equals 1, and R2 is what they get if they stick to the end, t equals 2, when the risky project that the bank invests this fund in materializes. And so this project returns R times theta at maturity, and there is a cost of premature liquidation, which is a payoff of L that is less than 1, right? So early liquidation comes with losses. That is, of course, where much of the interaction, strategic interaction happens. So this payoff is a composite of 2 variables. R, which is greater than 2, is just the return on lending. But more crucially, especially for this type of model, is there's theta, which is a random variable, and that represents what's called the fundamentals of the economy, right? So the larger theta is, the more profitable is the project, or the opposite. Okay. And so then we get to, that's the bank, so then we get to depositors. At the beginning of the game, they decide whether they want to put their money into the bank or they want to keep it outside the bank. So as said, the bank offers this deposit contract, for which we'll have to solve, of course, or alternatively, keeping money outside the bank, depositors, investors, they can keep their savings in CBDC or cash, right? And so we assume that CBDC pays a remuneration of a gross return of omega per period, right? So omega denotes the CBDC remuneration, and cash pays 1. So as soon as omega is strictly greater than 1, basically CBDC strictly dominates cash, and there will only be CBDC in economy, while in the limit, if omega is equal to 1, people are indifferent, and then CBDC doesn't have any other function, right? So the only thing that CBDC does is it offers a more attractive, safe remuneration, right? So think of it, if you want, as remunerated cash, which digitally we can, of course, do nowadays. Okay, and then at the interim stage, at t equals 1, investors can decide to withdraw their funds or not, right? And as is typical in these global games type of models, they all get a noisy private signal that is equal to this economic fundamental theta plus an individual noise term, and that if investors decide to withdraw prematurely, then the bank has to liquidate part of the investment project in order to pay out those withdrawing investors, right? And there's some technical stuff here, so to make things simple, we assume that noise is vanishing, and also we assume that when the bank cannot serve, either because of liquidity or an insolvency, there's full bankruptcy costs, so everything, all output is lost. Okay. And then we solve for the equilibrium of the model in 3 separate steps. So in the first step, we take the deposit contract as given, and we solve for the endogenous probability of a bank run, theta star, which of course is a function of the CBDC remuneration omega, as well as the deposit contract offered by the bank. Then in the second step, taking into account this endogenously determined probability of a bank run, we solve for the bank's optimal deposit contract, which again, of course, is a function of CBDC remuneration, because in the end, CBDC is the competition that the bank faces, right? So if I offer very poor terms, then investors will not fund the bank. And then finally, we put these two pieces together, and so then we can express the equilibrium probability of a bank run as a function of omega CBDC remuneration directly, but also the equilibrium contract, which again in turn depends on the remuneration of CBDC. And then to gauge the overall effect of CBDC remuneration on this, well, so we need to disentangle this direct and indirect effect, right? So we have that it depends both directly and through the contract on omega, the CBDC remuneration. Okay. So since I'm assuming that not everybody is familiar with this global games methodology, I'm going to skip a bunch of details, but just to say a few things. So typically you solve this by establishing sort of a failure threshold of this fundamental, which basically means that the unique equilibrium is characterized by everybody running on the bank if the realization of this economic fundamental falls below a certain threshold, right? So if the public signal or the private signal that is given to individuals is very low, they will run. If it's very high, not really. And then to solve for this threshold, we basically establish indifference of depositors between sticking to the bank. That is the left hand of, that's the right hand of this. So sticking to the bank means you earn R2, which is conditional on the bank being solvent at t equal 2, or withdrawing prematurely, in which case investors get R1, again conditional on the bank being liquid at that time. It will never be insolvent, but it may be liquid. And then the proceeds that investors get, this R1, they will stick it into a CBDC account for an additional period. That's why you have this term omega in the integral on the left-hand side, and that immediately tells you already that if I increase CBDC remuneration, I increase the benefits from withdrawing at t equals 1, right? And so then, thank you, one can solve this, and then we can solve for this failure threshold, and we can do it in closed form, which I put it here, and basically then you can work out quite easily, since L is less than 1, and R1 must be, well, it will be 1 in equilibrium, it can never be less than 1, that the direct effect is positive, right? So basically, offering investors a more attractive outside options increases their propensity to withdraw funds prematurely because they have access to suddenly they have access to more attractive storage technology, and that is very bad for bank fragility. Okay, given this, we can then solve the bank's maximization problem. So the bank basically makes profits that are equal to the payoff of the risky project minus the cost of deposit funding, conditional, and that's what you have in the integral, conditional on the bank surviving, right? So conditional that the realization of theta is higher than theta star. That is the profit, subject to depositors or investors' participation constraints. So the bank, of course, needs to offer a deposit contract that makes sure that depositors will actually put their money into the bank so that the bank can invest into the project. And so that you have on the right-hand side, which is basically the expected payoff. So it's kind of like the probability of the bank survival times R2. That must be greater than omega square, which is basically investors' ex ante outside option at time 0 when they decide to put money in the bank or not. That is omega square, right? We have the per period remuneration omega, right? And then we can impose some parametric conditions in order to ensure that the solution to the bank's maximization problem comes from the depositor's participation constraint, which is what the proposition below says. And then you can immediately see, so suppose that weak inequality is actually an equality, then you can immediately see if I increase CBDC remuneration, the right-hand side goes up, so then the left-hand side must go up as well, so the bank must offer a more attractive contract if the outside option becomes more valuable or more attractive and the participation constraint is binding, right? So then we can put all of these things together. We have the direct effect and the indirect effect. I can ignore R1 here because it's equal to 1 as the previous proposition has shown. So then we have that the direct effect is positive. Again, a more attractive outside option induces more withdrawals. That increases fragility, but then we have this countervailing effect that the bank takes this into account. As a result, it will offer a more attractive deposit contract, and that works in the opposite direction. Then we can work out some sufficient conditions, but let me skip over it in the interest of time. So putting these things together, here's a numerical example, and then we will typically have a U-shape, right? That basically the effect of increasing CBDC remuneration on bank fragility, which is sort of a measure of financial stability here, that it's U-shaped and can have a different sign depending on where we stand in terms of the level. And also actually tells us that there could be a social optimum, right? So in this model, actually maximizing social welfare is equal to minimizing financial fragility, so you can even have an optimal level of CBDC remuneration. I have about 2 minutes, is that right? 1, okay, good. So then we look at these 2 design proposals that I mentioned, and maybe just let me, in the interest of time, just talk about the holding limits. So holding limits, one way to think about it is basically that we have a limit of what is the proportion of their wealth, or we can also do it in nominal terms, since depositors have exactly 1 unit, it doesn't even matter. So suppose we just restrict that, and whenever depositors withdraw, they can only keep a fraction of their wealth in CBDC, and they must hold the remainder in cash. And so what that effectively does in the model, it reduces the remuneration that they receive on their outside option. And that means, we move either to the left or to the right on this picture, and basically means there's some region, which is when CBDC remuneration is above the optimal level, then, it will be actually a good idea to reduce this effective remuneration of the outside option, and that can raise financial stability. However, if we're below already, if you're already to the left side of the optimum, to the local minimum there, on the global minimum, then that would be counterproductive, right? So that means that, holding limits in line with the headline result, they can have an ambiguous effect on financial stability, and that directly works to their effect on the overall remuneration, right? So let me stop here. So we try to, take things seriously in putting CBDC remuneration in an otherwise rather parsimonious model of bank runs with global games. And we model CBDC as an improvement in investors' outside option. So there's also, of course, other interpretations, but it's kind of a straightforward one. And we find this U-shaped relationship between CBDC remuneration on bank fragility based on these 2 countervailing forces that I've talked about. And then we try to talk a bit about design, which I had to keep short in the interest of time. So thanks a lot.
Thanks, Peter. So now it's time for our last discussant of the day, who is, there is no need to introduce him.
Yes, thank you very much. I have prepared a light discussion in the anticipation that we would be tired at the end of the day, and the absorption capacity is limited after so many good papers. So in a nutshell, the paper is very interesting. I recommend to read it. It's quite, I think, elegant in the modeling, and easy to understand the drivers, and I think many more things can be done. Just quickly, let me tell you a little bit, a quick review, and then some comments. So We know that central banks are exploring the cost and benefits of central bank digital currency. There is this potential concern on adverse effects on financial stability, as well as credit provision, although this is not the object of this paper. The concern on that the CBDC may increase runs, it could be even worse if the CBDC is remunerated, right? Because then there is an extra incentive, maybe to be there at least face value, So the paper presents this model, kind of a global games model of bank runs with a monopoly bank and a remunerated CBDC. So, as it has been well explained, so I'll go very quickly, an increase in CBDC remuneration has two effects in the model. It makes interim withdrawals more attractive by increasing the payoff from storing funds in the CBDC for future consumption. This is a direct effect. That's the first intuition. It makes the bank more fragile, consistent with the general concern, if you want. The second, it induces the bank to offer more attractive deposit rates because consumers would otherwise not provide any funding. As a result, consumers or depositors have lower incentives to withdraw their funds, and this is the indirect effect. The total effect then depends obviously on the relative strengths of the two countervailing forces and under some parameter conditions, so maintain assumptions in principle the bank investment opportunity is sufficiently profitable and the CBDC remuneration is not too large. We have this U-shaped relationship between bank fragility and CBDC remuneration that has been shown. Okay? Bank fragility is minimized and welfare in the economy maximized for a strictly positive level of CBDC remuneration. Okay, but now let's introduce, in fact, an extension that Peter has not had time to introduce. We have, if we introduce competition, then the situation may change, and this is what I think is a robustness check they do. The U-shaped form on the top is the monopoly, okay? But then, as we increase competition, in this case, the bargaining power of the depositor, okay, model this way, it keeps going down until, if you want, with perfect competition, you have just that increasing CBDC remuneration, you increase the theta star, which is the critical threshold below which there is a run, and so, or the bank fails. And therefore would be counterproductive. And so the general message here is a decline in the bank bargaining power dampens the impact of CBDC remuneration on deposit rates. What happens is when the bank is a monopoly, it pays very low rates, okay? And then the competition introduced by the CBDC counteracts that, okay? So that's that. Okay, second set of results. Quickly, on CBDC design. When a central bank faces no restrictions on setting the CBDC rate, then holding limits do not lead to additional benefits, okay? Because the central bank can achieve already the best outcome by setting the CBDC remuneration, as we have seen. Otherwise, holding limits may help in implementing the optimal outcome, as it has been mentioned. And then in terms of contingent remuneration, that's to say, that depending on how many withdrawals do you have in the first period, you may change the remuneration to the CBDC in the second period, may help. Okay, so this lower reduced remuneration during the financial turmoil, that's to say if there have been too many, if you want, withdrawals, can lower bank fragility. Okay, so that's a possibility result. Then another result, which he has not had time to explain, is that with risk-taking on the asset side, that's to say the bank monitors loans, let's say, and then but can't take risk on the asset side, and this is important, a fixed deposit contract, okay, increasing CBDC remuneration increases monitoring by the banker and may increase stability, okay, and I will comment on this in a moment. So, the evaluation is already set. It's a very interesting paper. President Lagarde said that in Sintra that a decision on CBDC, a first decision will be taken in October, at least for an experimental phase. So it's getting some traction, as you know. Also, the financial commissioner in the European Union also is is talking about that and is moving. So it's a tractable theoretical contribution with a plausible narrative, and it's the main result is quite nice. Now, one first comment is the last bullet point. It would be nice to have a calibration of the model with some realistic parameters to see what rates you have to promise to avoid a run depending on CBDC remuneration. Because my first impression is that you have to promise a lot to avoid a run. Okay, and so maybe your effect is true, but then in practice, no, what does it mean in practice? So that's one for big picture now, and this I think it's an important slide. So, and this is more general, so outside of your model, okay, but I think it's important to put it on the table. What market failure is CBDC addressing? So according to the House of Lords and Mervyn King, for example, is it a solution in search of a problem? So this was the conclusion of the report in the House of Lords. You know? I mean, most people say that the CBDC is mostly a defensive response to a new private forms of digital payments that may become kind of a monopoly. This was triggered by Facebook, Libra, etc. No? And then the main question is, if the benefit of CBDC is to increase competition in payment systems, or to avoid potential monopoly positions in digital payments, or maybe facilitate cross-border payments, then the question is, can the goal be achieved with other means, for example, regulation and competition policy more effectively? This is a little bit the position we took in the report we wrote. Every year we write a report with ESN CPR on the banking initiative. Basically, we urge caution in its development, and we show clearly support to improve what we could term wholesale CBDC, okay, so the rail channels, okay, but we would urge more caution for the retail CBDC. And then, but going back to the paper, what is the market failure that CBDC is addressing in your paper? Because you have CBDC, fine. And you know why I know why you have it, right? But if we look from a theoretical perspective, what is the market failure that it is addressing? No? Okay. Yes. So in a sense, the benchmark of comparison, if we are worried about potential monopoly positions in digital payments, you should have a model with a potential monopoly position in digital payments, then introduce I mean, in fact, well, you are aware of that, I think. I'm just repeating something maybe obvious. No? A second point is that, as we have been discussing recently, we have we see that with digital technology, social media, concentration of deposits, I mean, deposits fly very quickly. CBDC may make this go faster. Then, and connecting to the model. Here then, particularly, maybe the vanishing noise assumption, which is standard, is not so good, right? Because if we think of people getting these signals from social media and withdrawing, probably this will is not a vanishing noise case. Then, if we look with more substantial noise, you reintroduce multiple equilibria, but this is fine. I think this can be tackled, because basically then the structure, we know how to deal with this, we know how to deal with the equilibrium set, comparative statics in the equilibrium set, and basically the extremal equilibria have the properties that you want. And then comment on the asset side result. This result, I am pretty sure that it cannot be robust, because once you endogenize the deposit contract, which makes sense, obviously, then I think the following will happen. CBDC will induce an increase in deposit rates. This will reduce the margins of the banks, and this will decrease typically monitoring, because the banks have less on a stake on that, if you want. And then, as many people have shown, and David and Rafael in particular, this will increase risk-taking. Okay. I have some other considerations, which I will do very briefly before I am being completely stopped, which I think are things that you know. So, liability structure. Okay, so the analysis abstract from changes in the type of funding of banks. Maybe if we introduce CBDC, and you raise the cost of deposits, maybe they will go more for wholesale funding, which is very unstable. Okay, so that's another impact on the potentially in the liability structure. There are general equilibrium effects which are known from the literature, which I will skip in the interest of time. But I would like to say something on the moral hazard issue, because this may be an interesting connection. Typically, we think that bankers and bank managers have a moral hazard problem, which may be insufficient effort or maybe too much risk-taking. Here, if we think in terms of an incentive-efficient solution that you have to intervene when the moral hazard problem of the banker is too high, okay, and the way to intervene is basically, since the banker wants to continue, is some form of restructuring, etc., then one potential trigger of that is precisely a run. So not all runs are inefficient, right? And this is what with my paper with Jarsal also we showed. And here, since CBDC may change this potential intervention point, it could be an extra tool, in a sense, to implement an incentive-efficient allocation. Okay, so that's, well, this is it, but let me not do it. Final comment, I have to end. But I
Please go on.
It's a technical comment, but I think it's...
we risk a mutiny by the audience, but...
No, they want to hear this technical comment. The technical comment is that as in most of, or at least in some of these global games, we assume an upper dominance region, so if you don't know what it is, forget about it, but it's not a good assumption. So it's not, it's a convenient assumption, but it's not a good one. But now let me point out there is a new paper by Anil K. Shap and co-authors, which is forthcoming in JPE, that they do having a similar global games model, but they can do without. So that's to say, they provide a good rationale for the upper dominant region in a model where the banks also do some monitoring. Okay, so I suggest to look at it because it's maybe a way also to improve the paper. I stop.
Thank you very much, Xavier. This was more of a lecture rather than a discussion, but thank you very much.
Sorry.
And Peter?
All right, let me be brief, except thank you. So that's super useful. So I think there's a few points we had already been discussing, but we know we still have things to do. So let me just choose a few points. What's the inefficiency? So I think inefficiency is the bank actually chooses to be too fragile in equilibrium, right? Because the bank doesn't internalize anything what happens to depositors' funds. And so that actually, sort of competition through CBDC can help there by adding some discipline, basically, to make the bank be less fragile in equilibrium. The efficient runs is definitely something I remember talking to my co-authors, so I think they mentioned that, so I think maybe that's some direction we want to push in further, right? Because you give us basically a lot of different alleys we can go to, and I think we need to choose. I'm not sure I'll speak much to why CBDC, so that's kind of the beauty of the paper, that we don't have to deal with that question, which is, of course, maybe the bigger question. So I think this paper is more like, if central banks go that way, these other things to be taken into account. Then you mentioned something about SVB and the ease of withdrawals. So that, if you want, is actually a possibly different interpretation of the model, right? So it's a real model in the end, but so of course you could in principle also think maybe Omega is not a CBDC, but it's sort of a convenience or a lack of disutility, right? So you could think of like when you actually withdraw cash, you have some inconvenience costs associated with that, and sort of Omega would be the benefit you derive from not incurring that inconvenience. So I think it speaks to that as well, and yeah, pretty much pretty much that. I think I'll stop here. Maybe we have a question or two, since we're kind of out of time.
Questions from the floor? Veronica?
Description of CBDC, I was all the time thinking of money market funds. And I don't see any fundamental difference in the way that is modeled with money market funds, and the source of instability is very much what has been discussed this morning, bad interest rate, risk management, and too much of uninsured deposits, which are the ones that fly very fast. So maybe related to what Xavier was referring, is this in where we should think of CBDC as a disruptive force? Is it in the speed at which that happens? Is it a force for introducing competition in payment technologies for retail? What is the main thing that is captured in these currencies?
Maybe one follow up on that one. So especially given that now the money market fund have access to the reverse repo facility, which would be basically giving direct access to retail to the central bank anyway. So it seems to be like a relative statement, given that we already have that, especially in the US, like in Europe, it's another story. But.
Yeah, I would like to follow up on a remark made by Xavier, when we mentioned that he didn't believe that the result would be robust when you include asset side considerations. But actually, my problem is still, takes place earlier. Other than based on your recent remark that remuneration of the alternative option would incentivize efficiency, I do not see that how the indirect effect can lead to an interior solution and still to the extreme solution. So if this is correct what I have interpreted, what would be how do you model here the efficiency gains from internal efficiency gains from CBDC remuneration?
Peter, you can answer.
Okay, so let me connect, since Conta jumped at the end on Veronica's point. So I think it's not the first time we hear this comment, and I kind of agree. So pretty much what we have is a remunerated outside option. And in principle, you can also think of, this could be financial markets, a money market fund. And so I think in principle that's true, and it's a possible interpretation. There's, of course, a few things that are outside the model that wouldn't very much matter for the debate on CBDC. So money market funds, they're not a medium of exchange, right, nowadays. We could think of technology getting us somewhere, so that maybe if I go into a shop, I don't pay with money, like fiat, maybe I pay with money market fund shares, right? So if we go somewhere there, which I guess technologically that's not so difficult anymore, not necessarily very difficult, not that I know much about that, but sounds plausible to me, that would be a different interpretation of exactly the same thing. What matters here is the bank faces some sort of more fierce competition, right? In the standard model, there's just cash, which is a very nice competitor from the perspective of the bank, right? And it's the reason why deposits are remunerated so low. But of course, it doesn't have to be CBDC in that sense. It could be anything that is a more attractive outside option and that provides payment offers. It could also be content stable coins in that sense as well, as long as they're stable, of course, right? I'm not sure I've exactly understood your remark on the risk taking. Basically, the way it would be modeled is, the bank monitors, and then the bank can decide how much effort to put in monitoring, and of course, the outside option of depositors affects these incentives as well. So if we want to say anything sort of semi-analytically, we make quite a lot of effort, but of course we can't do so without, and also at the same time endogenize the deposit contract, because then you have like an increasing number of cross terms. So basically the way we went right now is sort of, I think, what we can do, and I think there we have something that still, to us, it makes sense. But I'm not sure I fully understood your question, I must be fair. We can maybe take it up after.
Okay, so thank you very much again, Peter and Xavier, for these last contributions of the day. So it's over for today, even though I don't see any decaying interest from the audience. So, but I think we can stop for today, and tomorrow we are going to continue with the conference, and starting at 9 in the morning, a little bit later. There won't be Chair Powell, and that's why we are going to be able to sleep a bit more. And maybe that's all from my side. Maybe Rafa has some organizational details that has to give us regarding dinner or whatever.
Yeah. Where is the dinner?
Yeah.
That's
exactly.
This is the question.
Told that the big door where we enter will be open, and dinner is going to be in a place on this floor. So you just have to come back here, and someone will take the speakers and discussions.
8 or 8:30?
8.
8.
8 or 8:30? 8:30.
8:30.
Okay. I thought it was 8. Okay.
Oh, it's very early for local stuff.
Yeah, very early. Muy pronto para mí.